Show with the top headlines. US President Donald Trump denies that Iran talks are underway and labels the Strait of Hormuz as the new US territory while maintaining the naval blockade. Iran's Foreign Minister Abbas Araghchi meanwhile says Washington is now seeking talks on Tehran's terms.
Crude extends gains for a fourth straight session as US and Iran show no signs of reaching an agreement to end the conflict, keeping supply concerns elevated. Meanwhile, gold holds a decline pressured by elevated global bond yields and amid the growing fiscal concerns and persistent inflationary pressures.
Wall Street ends lower, dragged by chip stocks with the US 30-year yield hitting a 19-year high. Bond yields also climbed to multi-year highs across Japan, Germany and France. Asian markets follow Wall Street lower while the GIFT Nifty is pointing to a slightly subdued start for our own markets.
India considers relaxing rules to boost foreign direct investment. Individual ministers could be empowered to approve proposals worth 15,000 crore rupees, also weighs easier rules for downstream investments.
An IPO action stays in focus on Dalal Street. Shiprocket is set to make its debut today with a strong possible listing. Meanwhile, Horizon Industrial Park's IPO closes today with the issue subscribed only 25% by the end of the second day.
Those were the top headlines for today, but let's take a quick check in terms of what's happening in the Asian markets, right? US was not anything exciting. We saw red coming in for the US markets, and Asian markets too are following the suit. We're seeing Taiwan index that's down 1%, Hang Seng is trading with cuts of around 0.5%, Kospi, whether you look at Nikkei, all of them are trading with cuts. Even ASX 200 is trading in the red. So all the Asian indices are trading in the red. Why? We're seeing all these chip makers, whether in US or even on the Asian front, whether Japan or Korea, they all are seeing a fall coming in. So SK Hynix, Samsung Electronics in Korea were seeing a fall as well. In Japan also, the chip stocks were seeing a decline, and that is what the pressure is coming in from. Nasdaq also saw one of the biggest falls versus the other benchmark indices. So that is why we're seeing red. And let's look at the Indian markets. We've seen 6 consecutive days of red for the Indian markets. As of now, a bit of a muted or red start is what we're watching out for. Around a 20-point downtick is what the Nifty implied open is indicating as of now, Hormuz.
You know, that may not be the headline. I'll tell you the headline of the morning, though. There is a company in China called Unitree. It makes robots that backflip and they dance. It listed today at a 542% premium to its issue price. That's the headline of the morning. Unitree, a 542% premium, and it makes robots that can backflip. That's the kind of market that...
I think we were used to somersaulting and black flipping on our own, but now I think that's the robots that are doing the job.
Over that one as well now. But yeah, that's the headline of the morning in Asia. But on to updates from West Asia then. The US President Donald Trump says that no conversations are taking place or are scheduled to take place with Iran, while maintaining that the US naval blockade remains in full force and mines in the Strait of Hormuz have been cleared. On the other hand, Iran's Foreign Minister Abbas Araghchi said that the US is now quote-unquote begging to negotiate on Tehran's conditions after failing to force it to surrender. Meanwhile, the UAE's defense ministry said that Iran launched 2 ballistic missiles aimed at maritime traffic, with one landing in the UAE's territorial waters and the other falling outside of them into the sea. However, Iran's foreign ministry spokesperson Ismail Baghei has rejected UAE's accusations as baseless, adding that such claims harm good neighborly relations and undermine regional trust. The UAE's foreign ministry announced that all trade, commercial, exchange and financial transactions with Iran are suspended until further notice. Meanwhile, Iran's parliament speaker Mohammad Bagher Ghalibaf said that the Strait of Hormuz will remain closed until the US fulfills the conditions of the country's interim deal, which included lifting of the naval blockade and sanctions, as well as releasing frozen Iranian assets. Let's in fact listen in to those comments.
Let me make it clear. Until America implements its commitments under the Memorandum of Understanding, including lifting the blockade on the release of frozen assets, lifting the oil sanctions, ending threats and military operations on all fronts, and other conditions that America has agreed to under the understanding, the strait will not be reopened.
Based on all of these developments, oil prices continue to remain at elevated levels. Manisha Gupta is now here with all the updates from the commodities market. Manisha, good morning.
Morning, and absolutely. Fourth day of straight gains coming in for the crude oil prices. We are holding above $91 to a barrel. as U.S. and Iran show little indication of reaching an agreement, and Strait of Hormuz continues to see lower supply movement as well. The U.S. has also said that there is no ongoing transaction or negotiation with Iran, and that the U.S. naval blockade remains in effect there. The Iran forces also have intensified hostilities. We've seen 8 attacks on vessels transiting Hormuz in the month of August itself. But it's not just the crude oil prices. With the kind of run-up that we've seen in the global treasury yield markets, there is some pressure that you've seen come back in case of gold and silver prices. So 2% decline in gold, 2.5% of a fall in silver prices is what has been registered in the overnight markets. Same goes for the base metal prices, where copper, aluminum, zinc are trading off their highs. Markets are looking at backwardations easing a bit. There is more metals now supplied into the LME, and that's weighing onto the markets therein. But one thing that you need to really watch out for is the soft commodity market as well. The sugar prices are trading at a one-year highs. You have edible oil prices trading at multi-month highs as well. Corn, cocoa, coffee, all of these commodities also trading at multi-month highs. So weather, of course, is one concern. And on the other side, markets also are looking at supply concerns because of various waterways being blocked. That is what is keeping the prices higher as well.
Absolutely, Manisha. Thank you so much for giving us those updates in the world of commodities. But now let's bring on board our research team, who is going to tell you how these overnight cues are going to be impacting our Indian markets, set you up for trade, stocks to watch out for, cues in the world of F&O. All of that to take us through is our research team. First up, let's go across to Hormuz, who's here to tell us the market cues that we're keeping an eye out on. Hormuz, over to you.
It doesn't look very promising, does it, in midweek trading? GIFT Nifty is indicating a subdued start, yes, but well, the GIFT Nifty has not had much of an impact of the way the markets have opened in the recent past. So still 21 points lower. We are coming on the back of 6 days of losses in oversold territory is where the charts are. So we might just see a bounce from lower levels, maybe. But if you take a look at the 6-day losing streak as well, the Nifty has lost well over 400 points from levels of past 24,500. We have broken below every possible support level, be it 24,300, 24,250, 200. We closed below the 24,200 mark yesterday as well. But there are plenty of things to watch out for that are not in our favor. The fact that crude oil prices continue to remain higher, as Manisha was just highlighting. Brent is now nearing 92. NYMEX is nearing 86. That's one. Bond yields continue to remain on the higher side. So watch out for a reaction on our bond yields as well. They've remained fairly stable as of now. The currency is something that needs to be watched out for, continuing to hover around that 95.60, 95.70 range as it closed even in yesterday's session. And of course, the supply of paper, which continues in the market. Aster DM is one such name that is having a block deal today, so keep an eye out on that as well. With every possible support now being broken, the next level on the downside for the Nifty is now at 24,000. But on the upside, there is no definite level that you need to watch out for, because you're constantly making lower highs. The first thing that needs to stop is the fact that the streak of lower highs we've had for the last 8 to 9 sessions, that needs to end. And the intraday high of yesterday was 24,266. That's the first level that you need to watch on the upside. That is something you need to watch out for. The Nifty Bank continues to remain in the range as well. Buying interest emerging at lower levels, supply emerging at higher levels as well towards the 57,500 mark. So for now, a subdued start is what the GIFT Nifty is anticipating. The sandwich session between the two expiries generally turns out to be a trending one.
Okay, so we'll watch out for what happens in the trading session, but a subdued start as of now. Thanks so much for that, Hormuz. But across to Ananya, who's here to tell us the stocks to watch out for in trade this morning. Good morning, Ananya.
Good morning, Winnie. So let me walk you through the same, starting with CG Power here. Now, what happened is the company reported a suspected cyber incident, but its core systems and operations were not affected, the company mentioned. Coming to HEG, they will be in focus after NCLT approved its restructuring plan involving HEG Graphite and Bhilwara Energy. Now, Jubilant Ingriva will acquire a 40% stake in Zeta One Technology, expanding it into electronics manufacturing and the chip making space here. Now, coming to IDFC First Bank, they has priced its first $500 million international bond issue with a 3-year tenure here. Now, Shilpa Medicare has recalled nearly 28,000 bottles of a cancer medicine in the US due to unusual discoloration. No adverse events have been reported, the company mentioned. Now, Railtel received a 167 crore 1-year order extension from EPFO. Now, GR Infra Projects saw the Rajasthan High Court dismissed a GST-related case here involving around 70 crore. HG Infra received an order intent for 2 major facilities in Uttar Pradesh. Now, ONGC has connected its Assam gas facility to the Northeast gas grid. And finally, Interac won an order from a major global consumer company, while EMS became the top bidder for 2 NHAI toll contracts worth around 42 crores. So watch out for these stocks in today's trading session.
Ananya, thank you for that update. Then over to Sudarshan with the all-important FNO update. Sudarshan, good morning.
Good morning, Ramaz. So market has been down for the last 6 straight days, and what has happened yesterday is Nifty has slipped below the key level of 24,200. But if you take a look at the options data, all the plays that we are seeing, it's still happening above the level of 24,000. So in all probability, Nifty should protect the level of 24,000. If we breach 24,000, next support comes around only at 23,700. What about the market indicators? Both you and Manisha were talking about the crude has remained elevated. Brent is around $92 per barrel. But if I take it in a different way, yesterday when we left at 3:30, Brent was at $91 per barrel. Now, despite all the comments we have got from US and Iran, we have seen a rise of just $1. So it's at $92 per barrel. Now coming to the rupee. Rupee has been depreciating, but depreciation, it's not a huge quantum. Just 3 days ago, it was at 95.50. Now it's at 95.68. So just 18 paise depreciation we have seen in the last 3 sessions. Lastly, FIs were net buyers in the cash market, but that can be attributed to the 2 major block deals that we had seen in the Paytm and Grow. Now coming to FIs data, both in the index futures and in the stock futures. Index futures, they were sellers of more than 2,000 crore. In the stock futures, they were sellers of more than 1,700 crore. Now, their exposure on the short side is the highest that we have seen since July 29. Now, that can be taken positively. If there is any positive news flow, we can see a major short covering. They continue to add positions on the short side. Yesterday also, we have seen addition of almost 13,000 contracts. Now, short side exposure has increased to 90%, long side has reduced to 10%. Come to the options data. On the put side, 24,200 and 24,000 have seen maximum change in the open interest, and on the call side, 24,200 and 24,500. So, it gives you a range from 24,000 to 24,500. That's the reason. First support 24,100, next support 24,000, resistance would be 24,400. Those four stocks are in the band: Bandhan Bank, SAIL, Manappuram, LIC. Some of the stocks that I'll keep an eye on. First one is Bosch has been saying addition on the long side. The stock is at record high. LTFH had seen addition on the long side, and today there is a positive note from Macquarie. And lastly, Asian Paint, because of the sharp spike that we have been seeing in the crude, Asian Paints has been seeing addition on the short side.
Okay, Sudarshan, thank you so much for that. Those were the important cues in the world of FNO. But on that note, we're going to sip into a very short break. We'll come back after the break and tell you the cues on the what's on Wall Street. Stay tuned for that.
Welcome back. On to action from Wall Street. Then indices fell on Tuesday. Rising yields stoked inflation worries. CNBC's Kate Rooney gets us a wrap of all the action on Wall Street.
U.S. markets were down across the major indexes in Tuesday trading after a rise in Treasury yields over concerns about inflation and high oil prices. Dow was down 116 points, S&P 500 fell 53, and the tech-heavy Nasdaq shed 355 points. That is a more than 1% drop there. Opening statements got underway in California Tuesday as Meta now faces a landmark trial over accusations that it addicted young people to social media. A bipartisan group of 29 states sued the social media giant and in opening statements said Meta intentionally sought to addict kids to its platform in pursuit of profit. Meta's lawyers countered that the company wants to improve its services, not make them dangerous. The states are seeking potentially hundreds of billions of dollars in penalties and changes to the way Meta does business. And Disney's ABC network sued the Federal Communications Commission Tuesday, alleging that the agency's effort to challenge its broadcast license and regulate talk shows such as The View are illegal and an effort to quash speech that the Trump administration doesn't like. ABC is asking for a preliminary injunction and restraining order to halt the license renewal process. FCC Chairman Brendan Carr launched that investigation last year, saying it was meant to determine whether Disney's DEI initiatives violated the agency's prohibition on unlawful discrimination.
Kate, thank you so much for that. But staying with Wall Street, let's listen into what market experts have to say on the outlook for the U.S. markets.
Corporate earnings have been extremely strong. I think 86% of the S&P 500 during the second quarter beat consensus. And the macro data, the macroeconomic also continues to be strong. You know, the second quarter GDP print, which I think was 1.5%, was misleading because of a lot of noise in it. I think when you get the 10-year right around 475, you're approaching a danger level. And for the moment, the stronger forces on the earnings and the macroeconomic side have the upper hand. We'll see how long that lasts. If you ask me to bet, I'd say yields are going to go higher. And after all, in Japan and Germany, they've gone quite a bit higher in percentage terms. So we'll see. But this is this giant tug of war. It's like King Kong versus Godzilla.
We have a pretty high conviction view that the 10-year Treasury is going to have a very, very hard time sustaining rates much higher than here. So 5% or higher. Why? Because we don't really believe that the Federal Reserve is in a tightening cycle, right? Right now, we're at a point where there's like this game of chicken between the bond vigilantes who have like risen from the dead and the Federal Reserve. And we'll see what happens on September 16th and the reaction function of the long end. But that's going to resolve itself either way. Either the Federal Reserve is going to throw this token hike and establish credibility if they need to, or they're going to pause. Why? Because the last two pieces of data that we got in a very data-dependent world showed absolutely no inflation pressure from the labor market and core CPI at its lowest level of the year.
We'll take a short break. On the other side, we tell you how the government is weighing FDI rules overhaul to boost foreign investment. Stay tuned.
Welcome back to Power Breakfast on CNBC TV 18. Now, India is considering relaxing the FDI norms to boost foreign investments. The government may allow individual ministries to approve investment proposals of up to 15,000 crore rupees without a formal cabinet level clearance. Now, earlier the cap stood at around 5,000 crore rupees. Abhimanyu is here to decode more on this one. Abhimanyu?
FDI equity inflows into India had increased over 18% in FY 25-26, and several other measures are being taken by the union government to make the prospect more attractive for foreign direct investment flowing into India. Now, a proposal is in the works currently in which the government is trying to make the prospect more attractive, more lucrative for foreign investors, in which the proposal has indicated a higher threshold for FDI proposals, which will remove the rupees 5,000 crore cap on FDI proposals, which currently require to be approved by the Union Cabinet. Also, the proposal is indicating that the rupees 15,000 crore cap is also going to be removed, which till now required the approval of the Cabinet Committee on Economic Affairs. The proposal involves removal of multiple clearances for FDI into subsidiary companies, which till now required different clearances, separate clearances, and the proposal has indicated that only the parent company will once require an approval, post which no further approvals will be required by any of the subsidiary companies to bring in FDI into India. It remains to be seen how early the proposal is going to see the light of the day, how early it's going to be implemented, and also more details are awaited about which sectors are possibly going to benefit from this proposal.
Abhimanyu, thank you for that update there. Just before we call time on the show, take a look at how the Asian markets are faring. We started off the show on a negative note, continues to remain so. The Hang Seng is down around 0.3%. The Taiwanese index too down around 1.25%. But the Kospi was the big underperformer, still down around 5.25%. The Nikkei too holding on to losses of close to 3% as well. The GIFT Nifty was indicating a subdued start for our own markets, continues to remain so as well. So 16 points lower is what the implied open is suggesting. We open around about those same 24,150 levels on today's trading session as well. There are plenty of stock specific activity, block deals, IPO action, listing. There is a lot to catch up for during the course of the day, for which Bazar Morning Call will take you through all of that on the other side of this break. From Vinny and me, thank you for watching this edition of Power Breakfast.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. Welcome to Bazar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Nigel, middle of the week, and the cues are cautious. Hi.
Well, that's right, Reema. A bit of a tricky start is what we're going to see overnight. Actually, the cues ain't too good. Asian markets are in the red, but our markets, as is, have been under a little bit of pressure. So let's see how we combat this sort of news. But interesting trading session coming up. So let's get straight to it.
Well, indeed. So a couple of things markets have to combat. Crude prices, higher bond yields, and the fact the Indian markets themselves have been trading very lackluster with a negative bias. So all three things in focus. But let's begin with the top. As we said, could see a cautious start today. It was another red day on Wall Street as escalating tensions in the Middle East have pushed up crude prices and bond yields. Net, the Dow was down 0.2%, the S&P 500 lower by 0.7%. This is the third consecutive day of losses for the S&P 500. Nasdaq fared the worst of the lot, down 1.3%. But the bigger concern is the sharp rise in yields. So the US 10-year yield is now back at 4.7%. The 30-year yield has climbed to its highest level since 2007. That's a 19-year high. And this is not just a US story. Japan, Germany, France are all seeing long duration yields at multi-year highs. The question is this in a way flashing a warning sign? Is this something which can derail equity markets? US markets are pretty much at record high levels. So that's the big macro signal to watch. Why are yields rising? One, of course, is inflation, crude prices, and even compared to yesterday's level, crude is slightly higher, in fact, almost nudging the $92 per barrel mark. And secondly is fiscal deficit and rising government debt in the US. But again, that's not a new story, but it comes back into focus every time the bond yields rise. Markets are worried about rising Middle East tensions. It's raised fears of another energy shock, which could keep inflation higher. Just look at the story that's playing out in the Strait of Hormuz overnight. Well, UAE said that they fired 2 ballistic missiles into its territory. Iran has denied it. They've denied launching any missile towards UAE, according to the Foreign Ministry spokesperson. At the same time, Donald Trump on Truth Social has written, there are no talks, there are no conversations going on or scheduled with Iran. The naval blockade remains in full force and in effect. So basically, where is the off-ramp? What's the end line, the finish line? But, Trump also goes on to say, right, the Strait of Hormuz is open and operating. All water mines have been removed and detonated. But back home, as we've been saying, right, the Indian markets themselves have been so sluggish. We've been down now for the 6 straight sessions. Yesterday, in the last 6 days, we've lost close to about 430 points. Yesterday, we closed around the 24,150 mark broadly. The support will be the psychologically important level of 24,000. Perhaps a breakdown below that could accelerate the selling pressure. In terms of cues to watch, it will be the FOMC minutes, but domestic cues on the lighter side.
Well, that's right, Reema. Yesterday we had, in fact, the weekly expiry that did play out. And in fact, there wasn't a big move, which is good because otherwise you don't want that volatility in the CAS session. For yesterday, well, in the CAS session, the Nifty ended lower by only around 11 points approximately. And the important one was, since it was the weekly expiry, you were wondering whether or not there would be some big tricks on the option side. Not too much, but just one strike stood out. The 24,200 put, well, at around 315 odd. It was at around 17 rupees towards the end of the trading session. 328 odd, it went to around, that 28 bucks or thereabouts. And it closed at around 45 rupees or thereabouts. But not too many tricks. And remember, in the last few expiries, you've seen suddenly the premium shoot up or down in a big drastic manner. That wasn't really the case yesterday, so that was par for the course. This morning, we're waking up to cues that are not exactly bullish because you have the Troika that's not in favor. You have the Brent crude prices that are up. The dollar index, well, that's holding at around that 99.5 odd mark. But the 10-year yields as well and global bond yields have spiked up. So the Troika, not really in favor of, Indian equity markets for today. But if you look at the flows, they haven't been too bad on the institution side, and that's heartening to see. What did the FIs do, though, in the F&O market? Well, they went ahead, they added shorts, both on the index as well as on stocks. So on the index itself, they added close to around 13,000 short contracts. On stock futures, they went ahead and they added close to around 30,000 short contracts. You have to be careful what you wish for. You wanted some shorts in the system. That's precisely what you're getting. And now the short positioning has moved from ballpark around that 86% or thereabouts, it's moved back towards that 90% odd mark. And if I pull up a chart, in the last few trading sessions, the FI short positioning has moved from around 1.5 lakh contracts on the short side. It's moving closer to around 2 lakh contracts on the short side. So in a matter of a few trading sessions, there's been close to around 45,000 short contracts added from the FIs. And clients, they have done the exact reverse. So in the last few trading sessions, they have added long positions. Close to around 45,000 contracts is what they have added on the long side. So the FI and the DI positioning, the FI and the client positioning is diametrically opposite, and sometimes that combination is actually good. So we'll have to see how that goes. For the time being, the FI is piling in the shorts. The clients, they are adding the long positions. Moving to the Nifty levels, that we're looking at, the important strike is the 24,200 call as well as put. It appears there's a short straddle taking place out there. What is that? You write the call as well as the put of the same strike. You pocket the premium, which in this case will be ballpark close to around, the 250 bucks or thereabouts. So just plugging in that particular, level, you're getting a broad range that you're looking at, on the Nifty. The 100 as well as the 20 DMA, they become the goalposts now just in the near term. For starters, we start off on the back foot, but then I think, the bulls will want to take it from there. So that's the goalpost that you're looking at on the Nifty as well as the Nifty Bank. And the problem for the last few trading session is we've been making lower highs and in fact, lower lows as well. So that's going to be important to track for today's trading session as well. We'll keep an eye out on that.
Well, indeed. Let's take it right back from the top in terms of global cues and the impact on India. We've got Matt Orton, Chief Market Strategist at Raymond James Investment. Matt, thank you very much for joining in. The big story is a surge in global bond yields, not in the US, but all over the globe. Well, it's not new, right? US 10-year has hit levels of 4.7. The 30-year has comfortably crossed that 5% mark. We know the debt, the US debt, well in excess of $1 trillion has been a problem for a while now. But it's not that it's broken the equity markets. Should equity investors be fretting about what's happening with the bond yields?
Hey, good morning, Rima. And I don't think equity investors need to be worrying too much, at least not yet. Today's session, I think, was more about positioning, more about geopolitical worries. Perhaps investors were looking for a little bit more coming out of Anthropic. But most of the pain in today's session in the U.S. was concentrated in semiconductors. The broad market itself was actually in pretty decent shape. And when you look around the rest of the world, the story with respect to global bond yields, like you said, Rima, is nothing new. We've been seeing elevated bond yields, particularly in the US and Japan, has been a story all year. It was particularly challenging for Europe earlier this year. So I don't think this changes the narrative with respect to earnings growth mattering the most for equity markets. And as long as earnings continue to deliver, which they have been so far in really, really good numbers, I think that allows investors to feel comfortable buying the dip, which is exactly what we try and do and encourage our investors to do the same thing.
But you said equity investors should not be worried just yet. At what point is there a line in the sand in terms of bond yields which would worry you and we need to sit up and take notice?
I think it's the duration of how long you stay at these very, very elevated levels. Because in the past, we've had these really sharp moves upward. They've tended to relax. Things have tended to come back down a little bit. And then you've stabilized, maybe at higher levels, but not. It's the speed at which we are increasing and not knowing how long we're going to stay at these levels. If we have global bond yields, especially in the U.S., remaining on the 30-year, 5.3% and above for an extended period of time, I think that perhaps starts to challenge valuations and really puts the onus on earnings growth to have to deliver. But you take out the ability to really see good multiple expansion for the market. So again, not a challenge in this elevated growth environment, but when you inevitably start to see the rate of earnings growth start to slow, that becomes more of the issue. But we're not there right now.
All right. Hi, Matt. Good morning. Good to see you. And Matt, but what are you making of this global setup? Normally, if you have yields move up in the manner that they've moved up, you have crude as well moving up, someone starts calling out taco. Do you think, we are bracing for something similar? Because we have seen this in the past, right? Global equity markets get a little bit jittery. The yields move up, which for them, for the US economy itself is a big risk. And, they don't want higher crude prices as well. So do you think that, we're closer to that point of time where we hear something from Mr. Trump, kicking the can down the road, saying they were trying to work out a deal or something to that effect?
It's going to be interesting to see when and if that happens, Nigel. It's never an investment strategy to depend on taco or depend on investors to buy the dip, because that can go on for longer than you might expect. But we just had primary elections here today across most states in the U.S., so perhaps we're clearing a little bit of a political hurdle. We're maybe standing up or saber rattling, gets a message across, and then you have a little bit more time before the election season really sets in October. So perhaps we'll start to see that going forward. But I think the main message that we should be paying attention to right now isn't what the White House administration might do. It's really thinking about what are the highest quality investments across the AI CapEx complex that have sold off, that continue to show accelerating earnings growth. Those are the types of names I would want to buy in a dip to continue to be a little bit overweight growth in portfolios. But then looking across the rest of the world and across different sectors and industries, how else can I balance my portfolio to weather some of the challenges that we have? Because going back to what I mentioned at the start, the entire market is not going down. There's a lot of dispersion. Correlation is very, very low across the market. So if you are selective and lean into the right places, there's a lot of things you can do to insulate yourself from perhaps some of this volatility in the market. So looking to areas in the US and Europe like financials, looking to industrials in Japan and industrials across most of the emerging market complex, looking to sectors in India that are a little bit more levered to the consumer that are sort of rallying like an Eternal or a PTM. There's definitely things investors can do to continue to have growth, but also not lose big on days like today.
All right, and if you could get some weakness, it'll be a good opportunity to get stocks that you want at your price. So what's on your radar?
So I think right now, a lot of the names that we've discussed in the past, I mentioned Paytm, Eternal, those have both done very well. I have my eyes on Bharti Airtel. This has been an underperformer so far this year, but it is a quality compounding asset. They've continued to post good growth. They're not in a CapEx expenditure cycle, so I think that's a name to watch on weakness. And then also keep an eye on Bharat Electronics, because the defense complex across the world has really sold off. And it's interesting because we're continuing to invest more and more in defense, and we're in a multipolar world. So this is an area where I would expect to see earnings resilience, and I think valuations look pretty fair. So that's another name I have on my radar.
Matt, we'll leave the conversation here. Thank you very much for that. Well, Bharti Airtel, for the last 1 year at least, has been very, very sideways, just given a return of close to about 5%. But we are seeing moves in the industry suggesting that a potential tariff hike could be on the anvil, perhaps after the Jio IPO. Matt, great chatting with you as always. Let me tell you the interactions lined up on the show today. So coming up at 8:35, we'll get the management of Indomim to discuss the June quarter numbers. It's the first results post their IPO, and the stocks had a blockbuster IPO and a good set of numbers. So the road ahead coming up with the management. 9 a.m. we'll be joined by Probal Sen of ICICI Securities to talk about OMCs as crude prices continue to inch higher. 9:20, Sanjeev Prasad of Kotak Institutional Equities will be the market master for the day. 9:35, the management of IFL Finance will join in. Following that, the management of Supreme Industries will talk about the FY27 outlook. And towards the end of the show, Lata will speak to Nikhil Gupta of CLSA on India's slowing income growth. Stay tuned.
Time to slip into a short break. We've got a lot of stock-specific action track for you. Get at that in just a bit in our special Top 10 segment, where we're looking at ONGC, IGL, MGL, Gujarat Gas, HEG, Jubilant Ingrevia, Railtel, as well as Atlanta Electrics. They'll all be reacting to positive news flow, while you'll have Aster that will be reacting to negative news flow, and crude sensitives will see a mixed reaction. Take that break, come back. We get into further detail on all of these names. Stay tuned. Welcome back. Hope you're having a good morning. Well, as promised, we're going to run you through all the top stocks that we're tracking for today. And we have our team that comes up for you on the screen. Let's start off proceedings with Vivek, who's joining in to tell us about Aster DM, another large trade. Vivek, you're tracking?
That's right. Good morning. And last evening, there was a block deal launched and we accessed the term sheet. So what we understand is that there's going to be quite a large block deal as far as Aster DM Healthcare is concerned. The seller is Centella Mauritius, an entity that held close to 9.9% stake in the company at the end of Q1. This particular entity actually belongs to the TPG Group, which received the 9.9% stake in Aster DM because of their holding that they had as far as Care Hospitals was concerned. Now, for the offer floor price for this particular deal is at 766 rupees a share, a little over 6% discount to yesterday's closing price. And the total offer size at the offer floor price works out to almost 4,780 crores, indicating that a little over 7% of the total equity is expected to change hands. After this particular block deal, there is a lockup of further 60 days on further sale of shares. Going with the red on Aster DM, given the large equity supply that's expected in the session today.
Thanks a lot for that, Vivek. Well, let's go across to Sonal. She's tracking a couple of counters, ONGC and City Gas Distribution Companies. Hey, Sonal, good morning.
Good morning, Nigel. For all these stocks, I'm going with green today. Let me start with ONGC first up because they have connected Assam gas to Northeast gas grid, which is an important milestone as far as gas consumption is concerned. It has commissioned gas evacuation facilities at Koraghat in Assam, and gas produced by ONGC in Assam can now be transported through the Northeast gas grid. What would it mean? It would mean that new connection can utilize nearly 1 lakh standard cubic meters of gas per day from this particular pipeline. So in high volumes for ONGC, going with green here. For city gas distribution companies, now remember government had reduced APM gas allocation for these companies few months back. Now the company is planning to allocate an additional 200 SCM of domestic PNG use. So you can get that domestic gas only to produce PNG gas, and there has been a big push for PNG post the West Asia crisis, and the company is focusing on expanding PNG across the country. Additional gas allocation could help city gas distributors meet rising household demand, and this is something which would also mean that margins would improve because gas will come in at a lower cost. So margin improvement is something which city gas distribution companies will enjoy from this decision of the government.
Okay, all right. Thanks a lot for that, Sonal. Well, let's go across to Vinny. She's here to tell us about some more stocks in the news that she's tracking. Vinny?
Hi, so first up, I'm keeping an eye out on Jubilant and Gravia. The company has actually entered into a binding agreement to acquire 40% stake in a company which is involved in electronic designing, manufacturing platform of integrated capabilities, mainly for electronics and semiconductor industries, what they focus on. Zetawan Technologies is the company they've acquired. Cash consideration of 189 crore rupees. It will be in 2 tranches, will be completed by September 2027, both the tranches as well. And the company has managed to see a turnover of 98 crores in FY25, FY26. Will be interesting to watch out for how this actually plays out for Jubilant and Gravia. Next one, RailTel, we'll expect green here as well. They've received an order of around 166 crores approximately, which is from the EPFO. There's also an extension which is going to be possible in this order as well, in the existing order, for infrastructure as a service, which RailTel will provide to them as well. So keep an eye out on that. Green expected here. It will be executed by February 2027. Atlanta Electricals, that's the last one. We're expecting green here as well. They've received a letter of intent of around 193 crore rupees from Aptransco to supply 12 units of 160 MVA on 220 as well as 132 kV of auto transformers, kilowatt of auto transformers, which they'll be providing them. And that is why all these stocks today, we'll see some green here.
Got it. All right. Thanks a lot, Vinny, for that. Well, I'm looking at HEG, and we are at CNBC TV 18 had give you a heads up on this possibility late in yesterday's trading session on closing bell as the stock was buzzing around. That's precisely what's come about, actually. It's officially come that the NCLT has approved the composite scheme of arrangement between HEG Limited, HEG Graphite Limited, as well as Bhilwara Energy. Now, MK says that they view this development as largely neutral from a near-term valuation perspective. Remember, the total enterprise value is closer on 18,000 crores or thereabouts, as we explained yesterday. The NCLT approval is positive, but they do not see a meaningful near-term value unlocking. That's what MK has to say. They say that HEG Greentech's growth engines are still in the investment scale-up phase. so they're yet to contribute materially to the earnings, and the material value would depend on successful execution of the entire plan that they've laid out in terms of the renewable energy push that they've been talking about, and also the push in terms of anodes, graphene, and various other businesses that they're looking at. So for the time being, going with green on this one, though the stock has already priced in some part of the good news with the move that we saw in yesterday's trading session.
Okay, now let's go across to Manisha because crude prices are rising. So all the crude sensitives will be in focus. She joins in with the latest here.
Thank you so much for that. Well, it's a fourth straight day when we are looking at gains continuing in case of the crude oil prices. You have $92 a barrel taken off in the Asian markets right now as US and Iran show little indication of reaching an agreement. And the Strait of Hormuz continues to see lower supply movement as well. From double-digit vessels passing via Strait of Hormuz to the tune of 30 to 50 in the previous week, it has come down to nearly 5 to 8 vessels passing in this week. So that really is what is giving some premium to the prices. And then the US also has said that there's no ongoing negotiation with Tehran, and the US naval blockade remains much in effect. The Iran forces also have intensified hostilities. You have 8 attacks on vessels transiting Strait of Hormuz in the month of August alone, and that is where the prices are seeing support from. Most of the experts now believe that we are looking at $88 a barrel as a strong support, and 95, 98 is what you could perhaps see in the month of August if the narrative and the rhetoric continues the way it is.
Okay, thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are ONGC, IGL, MGL, Gujarat Energy, HEG, Jubilant and Greva, Railtel, Atlanta Electricals. Aster DM could open up in the red, while crude sensitive, it's going to be a mixed picture. Get into a break. On the other side, the management of Indomim will join in to discuss their June quarter numbers. Welcome back. Let's now go across to Sudarshan for the brokerage call of the day. Sudarshan, what do you have?
So first one in L&T Finance, there is a positive note from Macquarie. It has initiated coverage on the stock with an outperform call and target price here is 400 rupees per share. It says company is a diversified retail lender and has fixed its legacy issues and now targets peer-like growth from a largely retailized book. Stock is attractive, trading at a 35 to 50% discount to larger peers, and this is despite comparable AUM and earnings growth expectations. Strong earnings growth and ROE improvement will drive re-rating as per Macquarie, and believes that company can deliver 28% EPS CAGR over FY 26-29. Next one is TVS Motor. Jefferies maintains buy call and increased target price to 5,425 rupees per share. It says annual report highlights 4 focus areas: global, electric, premiumization, margin and technology. So now it is delivering well on exports, EVs and margin, but overseas investments in Norton and e-bikes are yet to deliver results. Subsidiary investments rose at 29% CAGR over last 5 years, but free cash flow has improved in FY26 despite high investments that company has made. Agrochemicals, HSBC has come out with a note. It believes that agrochemical stocks are trading at a wide discount to historical averages, and now valuations have become attractive. It says sector is trading below its 10-year mean multiple of 24 times, and that reflects a deep discount. It has only briefly traded at similar valuations 4 times in last 10 years. Domestic companies can unlock most value when macro headwinds go away. It maintains buy call on Dhanuka Agri, UPL, Bear Crop, SRF and Rallis, and hold rating on PI Industries and Tata Chemicals.
Got it. Thanks a lot for that, Sudarshan. And another one that Sudarshan was explaining to us yesterday was Indomim. So let's invite the management then, Mr. Krishna Chivukula, the whole-time director and chief executive officer at Indomim, who joins us. Hi, sir. Good morning. Good to see you win. Well, what do you have to tell your bankers? You know, the stock from listing date is almost double.
Yes, I think everyone.
Do you think they should have priced it more aggressively?
I think that's water under the bridge at this point. And now, like we have in the past, we need to focus on the future and what we need to do as an organization to continue growing and prospering in the markets that we're in.
I like your style. Well, let's focus on numbers then. As you said, time to look ahead. Margins in the last quarter were very, very good. What is the margin band we should be working with? Can you maintain this sort of margins? And how much of this margin improvement is because of currency depreciation? The rupee was weaker. Does it have an element to play?
It does have a little bit of an element to play for sure, I think the other thing that's really important is the product mix. We make many different types of parts, and sometimes when the mix of those parts changes, it will also affect the numbers depending upon the margins and what's coming in from where. But definitely the depreciation of rupee is also playing a factor.
So the margins, that you've recorded in the past quarter are in the vicinity of around 33%. Do you think a more realistic number will be closer to around 30%?
Yeah, that's the guidance that we've given. I mean, that's what we think steady state is, more of the long-term sustainable number between 28 and 30. That's the guidance that we've given on that. And then we're going to stick to that. Currencies will fluctuate, but at the end of the day, you're going to be grinding out a solid earnings position by maintaining operational efficiency and doing all the other things that we've done over the past 15, 20 years to sustain the earnings of the company.
Revenue growth was about 9% year on year, though sequentially it looked better. For the full year, what should we expect? Because I remember in our last conversation, you sort of said that long-term growth rates should be 10 to 15%. For FY27, where do we end?
The guidance we're giving is we're expecting about 20% growth. Right now, based on the Q1 numbers, it sort of looks like we've got a good increase over the previous quarter. Good increase year on year, good performance on basically all the key parameters. Right now, what we're looking at, if you base it off of Q1 numbers, about 4,800. Our budget and our target is 5,000. So I think we're well on the way to doing there, and we'll hit budget of 5,000 crores.
Okay, so 20% top line growth with a absolute number closer to 5,000 crore rupees. What was the growth in defense and aerospace in Q1?
Aerospace was up about, I don't have the exact number, but it would be up about 15% at least over the previous quarter. And then I'm sorry, what was the other one? Defense? Defense is up. It depends on where you're talking about. For the United States, that's up significantly. Depending upon which factory and what kind of programs you're talking about 15 to 25%.
Okay, all right. So let's focus on a smaller vertical. That's the consumer electronics business. I think as a percentage of your mix, it's in low double digits. I think 11, 12% approximately of your mix. Could you give us some details? Globally, what is your market share? X of China, that's a small part of your business right now, but it has tremendous potential. So if you could give us some color out there, do you have clientele like Apple, Samsung as well under this consumer electronics vertical?
I can't really mention customer names, but we're very active in this segment. We've been active in the consumer segment for the last 15 years, but obviously the onshoring and the emergence of a much more robust consumer electronics supply chain in India is creating a lot of opportunities in this segment for us. And we expect it to grow in the future, and it's an area of focus for us.
All right. And, if I had to put a number to it, X of China in the consumer electronics vertical, globally, your market share could be more than double digits. Would that be fair?
No, our penetration in consumer electronics would be very small.
Very small globally.
Very small compared to the rest of the,
got it.
Compared to China.
And margins are better in consumer electronics?
Margins are lower. It's a tight business.
Cool.
Okay.
A lot of focus on operational efficiency, a lot of focus on scale. So, obviously you have to be very sharp in terms of how you're engineering the components or the systems. But, we've got the skills to do that. We're going to continue doing it. And it's an area that we expect to grow in the future.
Correct me if I'm wrong, but I believe you are setting up a new iron powder manufacturing facility in Karnataka?
Yes.
Yes, and that comes on stream sometime in FY27. Could you put a timeline to it? And it's important because I think this is one of the key raw materials, so it helps you with your backward integration.
Correct. That project's on track for completion at the end of Q1 fiscal 27 or the beginning of Q2 fiscal 28. Currently being built and pretty much on track. Very much on track in terms of the technology and getting the plant erected.
Okay, so this will be in June of 2027, correct? It comes on stream in June 20.
Yeah, commissioning should be happening between April and June 2027. I would like to get it commissioned a little earlier, but let's see. But yeah, June 2027.
And can you tell us the importance of this? Because if it is backward integration, does it boost your long-term, medium-term margin profile?
It's going to help with margins for sure. Obviously, we're going to be doing this at a significant cost reduction compared to our European and other suppliers. But it's also important for security. We use huge quantities of these powders. They're very significant for certain segments of the business. We've had to stop using overseas suppliers as a result of U.S. trade sanctions over the last 6 or 7 years. So this has been in the back of our minds as a long-term project that needs to get done since all of these things, both for cost stability, but also because there's not a lot of places you can get these powders. It's a critical raw ingredient for us. Having that ability and having that supply under our belt provides a lot of long-term security as well as additional opportunities to sell those powders in external markets.
So one of the key driving is ensuring long-term security of this essential raw material. But you also said it should be margin accretive. To what extent? Once it comes on stream, say in FY28, does it push up margins by 50 basis points or more?
That's a good question. It's going to be how many basis points will put margin? Let me think about it a different way. How much money will it save? I think that it will definitely increase margins by at least 50 basis points. But, once again, we got to run it. But, there's going to be significant cost savings associated with the plant, and as well as significant opportunities to sell. When do we see the impact of that margin on the numbers will depend upon, how long it takes for us to really get approvals in place to use those powders with our customers and things like that.
All right. How far are we from hearing about the next big capex plan? Because at peak revenue potential, I think you can do close to around 7,000 crores. You end this year with close to around 5,000 crores. So sometime in FY28, I guess you'll be laying out the next capex plan for the next leg of growth. You're growing at a clip of around 20%. So in all probability, I'm saying it and not you because I want your FY27 numbers. By FY28, you could be in the vicinity of around 6,000 crores plus. So in FY28, do we hear about the CapEx plan?
Absolutely. We've got factories. A lot of very interesting and exciting programs are going to be ramping across the board, whether that's in aerospace machining or, advanced robotics applications, turbocharger applications. Definitely, we're seeing, strong business development and a strong pipeline of new projects coming in and launching both this year and next. That to me means that some capacities may get filled, which we'll keep a close eye on. I'm not sure if it will fill for MIM, but definitely it could be filling for the casting plant. MIM may have another year, but planning will start next year for these. I mean, definitely there'll be some sort of expansion that's going to be required if we're going to continue to grow the way that we're growing. That will probably include an expansion in aerospace machining, maybe in MIM in a couple of years if the numbers keep going the way they're going right now. Definitely our casting plant is going to need expansion in the immediate future. We're picking up a lot of business there. It's been very pleasing and to see the team there, really grabbing these opportunities and converting them.
Okay, all right. Very quickly before I let you go, where are you joining us from? You're in India or you're overseas?
I'm in India. This is my residence in Bangalore.
Okay, all right. Thanks a lot for joining in. Have a good remainder of the day. I was wondering whether or not you were in the United States and joining late at night, but it's early morning for you as well. Have a good day and congratulations on a solid set of numbers. Maybe a call to the banker and telling him, hey, what about the IPO pricing?
I'll join at any time for you anywhere in the world, so don't worry.
Thanks a lot. We appreciate you at CNBC TV 18. All the very best, sir.
Have a good day.
Well, time to take a short break. Then on the other side, we'll ask Deven Choksi about a lot of stocks that we want to discuss with him. Stay with us. Welcome back. As promised, Hormuz as well joins us to tell us about all the big movers in trade yesterday, and some of them backed with delivery. Hey, Hormuz, morning.
Morning, Nigel. And yesterday, of course, being the weekly expiry, and that shows in the turnover of the cash as well. Well over 1,600 crore rupees yesterday, possibly the highest since the implementation of this. And the stocks as well saw significantly higher turnovers compared to Friday and Monday. Of course, Bharti Airtel topping the charts yet again, turnovers of 111 crore, but the stock ended below its reference price in yesterday's trading session. ICICI Bank too saw turnovers of nearly 100 crore, ended nearly around about the same price as its reference rate. HDFC Bank continues to grind lower but still finds a mention among the top 5 on the cash. 82 crore worth of turnover in yesterday's session. Reliance Industries too close to 73 crore, ending around about its reference price as well. And Infosys too making it to the top 5 in yesterday's session, turnover of close to 60 crore rupees. But if you go beyond cash, there were stock specific movers in the broader markets. Tube Investments was one of them, and the top gainer on the Nifty 500 yesterday. The stock was up 8%, close to 50 lakh shares were traded yesterday on Tube Investments. The 20-day average here is only 3 lakh shares. So very significantly higher volumes. Now on the delivery front though, only 16% of those were marked for delivery. So around about 6.5 lakh shares compared to a 20-day average of 1.7 lakh shares as well. Aegis Logistics surged on the back of a newspaper report yesterday. The stock was up 7%. The volumes around 31 lakh shares traded, around about 4.5 times its 20-day average, which is close to 7 lakh shares, and 13% of those shares were marked for delivery. So the delivery front was nearly about the same as its 20-day average, 4 lakh shares compared to a 20-day average of 3.5 lakh. And lastly, the defense stocks were up and about in yesterday's session. Paras Defense was one such name. The stock surged 10% in yesterday's session. Close to 55 lakh shares were traded. The 20-day average of just over 10 lakh shares, and around about 27% of those were marked for delivery. So 14.5 lakh shares on the delivery front. The 20-day average here is around about 3 to 3.5 lakh shares.
Got it, Hormuz. Before we get to the next piece that you want to put out, today's a special day for you.
No,
what is it?
It was just being together for almost a decade now.
What is it? It's the anniversary or it's the proposal day?
The proposal day, yeah.
All right. Congratulations to you and the BV. I'm sure you have some big plans this evening, Hormuz. Maybe biryani or cooking up something. Hormuz at his best. For the time being, you tell us about Bernstein. They made some changes to the model portfolio. Tell us about that.
Some interesting changes Bernstein has made to its model portfolio. And this time around, they are tweaking their portfolio to focus on stocks that have visible catalysts. But they have gone on to say that their additions include those names that have been recent outperformers as well. And that shows in the list as well. Now, they have included Eternal, where they have said that it continues to outperform and demonstrate competitive strength in a sector where raising capital has become increasingly difficult, and shares of Eternal over the last 1 month have gone up by almost 10 to 12%. So that is an addition to the portfolio. Paytm is an addition to the portfolio on the back of the MDR related catalyst. That stock too is up around 15% in the last 1 month, barring yesterday's block deal where the stock fell. The stock was almost at 52-week high levels as well. And they have also introduced Adani Ports. Now that's an exception because they have introduced Adani Ports after the recent correction. The last 1 month the stock is down around 9%. So that is an addition to the portfolio as well. On the flip side, they have removed Avenue Supermarts from the portfolio. Now they're saying that following its recent outperformance and its growing risks to urban growth due to quick commerce, and that is something that the management also highlighted in its recent analyst meet where they called it a structural challenge as well. So Avenue Supermarts has been excluded, Eternal, Paytm and Adani Ports have been added, and based on that their portfolio now looks around about 13 stocks are a part of that now as of August. They include L&T, NTPC, Titan, PFC, Axis, HDFC Bank, Nuvama, Home First Finance, M&M, Zydus Life, and of course the 3 new additions being Eternal, Paytm and Adani Ports.
Got it. All right. Thanks a lot for that, sir, and have a special day. Proposal day, you might as well deliver this evening. Thanks a lot, Arvas, and all the very best. Well, let's get in Deven Choksi then. Hi, Deven. Good morning. Good to see you in Indomim. We just had the management sounding very, very confident about the way ahead. First quarter, the growth has been 9%. Margins are around 33%. They're telling us that for the year, they'll do 20% of growth, which takes them to around 5,000 crores, with margins in the vicinity of around 30%. 20 to 30% is what they're talking about. Your view on the stock, it's up more than 90% since listing day, which was just a few sessions ago.
Nigel, good morning. Well, I think at the time of IPO, we did see this particular company. Subsequently, I think we never got a chance to basically enter into the stock. So frankly, at this point of time, I think there is no view per se as we see it. Of course, I think the numbers are validating the strength of the business. I think that is what we can gather at this point of time. But haven't done enough amount of deep dive into it, so we'll be keeping it for some other day to discuss on the subject.
Devin, what about Milky Mist? Did you get a chance to participate or in the IPO or on day one? Well, it was expensive to begin with, but after closing up with the kind of gains, it's now trading at more than 40 times forward multiple FY28. So it's trading way above what dairy companies trade at in terms of multiple, but it's now closer to consumer companies like a Britannia, etc. What are the prospects and how comfortable are you with the valuations?
Well, I think, good morning. The point here is, I think valuations definitely remain expensive, and the companies are getting categorized into the FMCG baskets, and that's where probably I think the higher valuations are being justified. The important part here, what I'm observing, is not more from the fundamentals of the business. At the same time, I think I'm seeing most of the fund have got the appetite to add companies into the FMCG space. Whole day here it is a dairy company, but I think they are talking about the FMCG space. So as a result of which, I think the additions are happening into the fund portfolio, and that is where probably we are seeing the higher amount of action in the market, resulting into higher P. Not too sure immediately whether I think one would like to go into this stock. Maybe a couple of quarters of working, and then one will get a little more confidence about the consistency in the business.
Okay, all right. Devin, any view on HEG? They've announced that demerger, the stock has run up, but some part of the street says we need to still see numbers coming from green tech to give it a fair valuation. But we had put out a few numbers yesterday on the core graphite electrode business. Say they can do around 1,000 crores in the next 3 years or so. That's by 2029. And on the green tech business, the management told us that they could do close to around 1,000 crores. But they'll have close to around 40% stake in Bilwara Energy. So out there, maybe you account for around 200, 250 crores approximately. So it appears, on a consolidated basis with the entity still together, you're getting the entire entity at around 10 times, 18,000 crores of enterprise value and ballpark around 17 to around 1,800 crores of EBITDA. Do you think much of the value is already in the price, or do you think this demerger can unlock further value?
I think during the roadshows also recently, I think the company definitely spoke about this entire demerger and the potential thereafter. So certainly one would like to buy that in a very positive manner. And as you rightly said, I think the valuation-wise, they are not sounding too expensive at this point of time. Maybe I think the demerger could be one chapter, I think, on which probably the market would be a little bit, I think, overhang. It will be there. But otherwise, I believe that I think should be considered in a fair manner as far as this stock is concerned. So we do not have the immediate inclusion in our PMS portfolio, but we would like to see this company a little bit more closely going forward.
What stocks have you recently added in your PMS, David?
So we continue to add our weight into some of the companies. In last 2-3 months, I think we added some weight into the likes of Minda Corp. We added some amount of weight into even, I think, companies like Steel Lotus Developers, where we believe that I think the fundamentals of the business remain extremely strong. So there is a situation wherein I think the market has given, I think, immediate upside after the result. I think market has cooled down, but prior to result, this company has given an upside. So such kind of opportunities, when the market comes down and gives correction, they become, I think, a good buy opportunity. Similar situation from Indacorp. I think their result also is suggesting from the first quarter that larger amount of kit value is increasing in every OEMs. And that's where probably I think one would like to buy this company from at least I think next 3 years point of view, where I think the shift is also happening for auto ancillaries going into a larger segment of EV at the same time. So we like, I think, such kind of propositions buy into the portfolio.
Got that. Any other auto ancillary companies? Because many of them are now also entering into other allied sectors which involve precision manufacturing. So a Sansera, a Craftsman Automation, they're all doing very well. Bharat Forge, of course, is the big one with its entry into defense. But other than Minda Corp, any other auto ancillary that you like?
We continue to like, Minda. At the same time, I think when we look at Minda Corp, I think we simultaneously have the liking for even this company, Indomim. That is again, I think, a company where the larger amount of kit value is increasing in respective verticals in which they are operating, be it in the wheel segment, be it in the electronic segment, or for that matter, even seating segments. The kit value per vehicle is increasing, and that is keeping us, I think, more happy with the kind of proposition that these companies are building. So we like, I think, such a proposition where, because at the same time, during the transition phase from IC engine to the EV, most of the OEMs, I think, they rely on their existing suppliers, and where the kit value for existing suppliers starts increasing, and that is where we like this kind of businesses.
Okay. Any new age tech companies that are on your radar?
We continue to look at, I think, the companies like Eternal, among others, but frankly, not adding any kind of inclusion in the portfolios. We still feel that the valuations are better, I think, when the market gives a deep correction. But at this point of time, we are not seeing that happening. So just wait for a while, I guess. But we continue to like this business.
Any other interesting small cap stock in your portfolio which we haven't spoken about before, Deve?
So we have been liking this one company, which is a really small cap, I think, which is a Jaro Technologies, or Jaro Education, as they call it as. A fantastic business model. They cater to the entire education segment, online education included, and largely catering to the students or the enrollments which are for the high skilling in the corporate world. So that tie-up is with IITs, the IIMs, and some of the big names in the universities, including the Wharton and MITs, where they secure the enrollment for them on one side, and on the other side, I think they provide the complete online education infrastructure to these companies. So company is reasonably growing. Last quarter, they have had about 48% kind of a growth, and at the same time, a larger amount of business model is unfolding. So we like such kind of niche play, which are, I think, operating in a very systematic manner into their respective segments.
But sorry, this is not a stock that I've analyzed or heard about even before, but I was just saying the company did its IPO only in September of 2025, and I think the IPO price was $890, which means it's halved in less than 1 year. So what makes you now attractive? What went so wrong, and what's going to go so right?
Maybe I think the current valuation at 10 times price earning ratio, I think downside is protected. So that probably, I think, saves your capital from going down under. Post IPO, why the stock price went down? Maybe I think our markets probably discovering the businesses. I think they have probably, I think, got some reservation as far as, I think, edtech is concerned. That is what we gather from various discussion. And that's where probably, I think, because many of the education tech companies have not been very successful in the marketplace, they are not rewarded enough to the investors. And that could be one of the concerns for which I think the stock got beating post IPO. But I would think that, I think, everything is in price. Today, I think the business is growing well and valuations are attractive enough. The downside risk is limited, and that's where we like to buy into this company.
Okay, Deven, we'll leave the conversation here for now. Thank you very much for that. That's an interesting stock, Jaro Institute, and some of the other stocks that he likes. Uno Minda is one, and the other one is Sri Lotus Developers. That's the real estate, small Mumbai-based premium real estate company he's liked for a while now. Great chatting with you. Get into a break. On the other side, we'll come back with the pre-opening. We'll also get in Probal Sen of ICICI Securities to discuss the outlook on OMCs and oil producers.
Welcome back. Well, we're going to be getting the pre-open rates just a bit from now. For the time being, though, let's pull in our technical experts, Sudarshan as well as Mitesh, join in this morning. Good morning, gentlemen. We've been on a bit of a losing streak. We've moved to the lower end of the range. Do you think we're cracking now? Sudarshan, you go first. We're down to around 24,155.
Yeah, good morning. Well, we broke down below 24,200 yesterday, and that tells us that the range is breaking on the downside. Now, the problem is that it's not decisive. It's not as if we fell 100, 200 points and said, okay, the range is broken. It was a minor break, but I don't think this is bullish. So the view is that it is possible that we can drift towards the next support level of 24,000. Short side trades are not recommended. Longs are not justified. So wait patiently. There's something else, Nigel. This market range will also end. Whenever it ends, and I can't say when it will end, the markets will break out, and this compression should see a 2 to 3 year Nifty bull run. You have to be patient to wait for that. Currently, just accept that it's not working out, be patient and focus on stocks.
Got it. All right. So it appears the bias is on the downside, and for the time being, you'll step aside from the headline index. Got it. Coming back to you, Sudarshan, for your picks, but Mitesh, what do you think? 24,155 is where we ended yesterday. And all probability, we start off with a bit of a softish start. Your trade on the Nifty.
Yeah. So on the Nifty, good morning, Nigel. On the Nifty, breaking and closing below 24,200 is a mild negative for me. Now, we are oversold on the intraday chart because we've been falling for the last 6-7 days. So there could be a pullback. But I think eventually this could see the markets, head towards 23,900, 850 zones with some volatility. So now I think in the short term, bounces should be used to exit long positions on stocks and try and identify some short trades also, so that traders can possibly look at gaining from the declining movement which could occur.
Okay. Good morning, gentlemen. Good to see you as always. Mitesh, what stocks would you go with?
Yeah. On the stock side, I have a mix of buys and sells today. On the buying side is MCX. That's a stock which has shown a lot of relative strength in this market and is seriously giving you signs of an up move. So MCX is a buy for me. Keep a stop below levels of keep a stop below levels of 2090, 2085. 2985. And a target of 3150 odd could be looked at. Sell on JSW Energy with a stop at 560. Here I would look for targets of 525. Buy on L&T Finance with a stop at 317.5 for targets of 340. And Marico has broken below all its averages. That's a sell with a stop at 858 for targets of 805.
All right. Sudarshan, what about you?
Well, it's a mix. Dr. Reddy's is a buy with a stop under 1305. Nykaa is a buying opportunity with a stop under 270. Astral is a sell with a stop above 1575. And Dabur is a sell. It's a very disappointing chart, all for so many years. Dabur is a sell with a stop above 465.
Okay. Thank you very much, gentlemen. We'll come back to you for 9-10 calls. Let's move on and talk about the other big story. India is considering relaxing FDI norms to boost foreign investment. The government may allow individual ministries to approve investment proposals up to 15,000 crore rupees without a formal cabinet level clearance. Earlier, the cap stood at 5,000 crore rupees, so they are looking to increase that to 15,000. Abhimanyu Sharma, T-Codes.
FDI equity inflows into India had increased over 18% in FY 25-26, and several other measures are being taken by the union government to make the prospect more attractive for foreign direct investment flowing into India. Now, a proposal is in the works currently in which the government is trying to make the prospect more attractive, more lucrative for foreign investors, in which the proposal has indicated a higher threshold for FDI proposals, which will remove the rupees 5,000 crore cap on FDI proposals, which currently required to be approved by the union cabinet. Also, the proposal is indicating that the rupees 15,000 crore cap is also going to be removed, which till now required the approval of the Cabinet Committee on Economic Affairs. The proposal involves removal of multiple clearances for FDI into subsidiary companies, which till now required different clearances, separate clearances, and the proposal has indicated that only the parent company company will once require an approval, post which no further approvals will be required by any of the subsidiary companies to bring in FDI into India. It remains to be seen how early the proposal is going to see the light of the day, how early it's going to be implemented, and also more details are awaited about which sectors are possibly going to benefit from this proposal.
All right, thanks a lot for that, Abhimanyu. Well, let's hop across to Probal Sen, the oil and gas analyst at ICICI Securities, who joins us on the show. Hi, Probal. Good morning. Good to see you. When crude oil prices have spiked, let's get that out of the way first. What is the band that you're working with in your estimates with regard to crude oil prices? And then comment also on these refining margins. You know, they've been rock solid, doing very, very well. The core refiners actually have had a great run, CPCL, MRPL as well. What are the margins you're working with on the refining side?
Yeah, two questions. I think crude and I think refining margins probably reflect the kind of uncertainty that still exists with respect to what is happening in the Strait of Hormuz, even more than what crude prices do. If you look at the kind of spreads that we are seeing, I mean, we have not really seen this kind of diesel spreads ever. At one point of time, diesel spreads were actually higher than the physical crude price, reaching almost $80 or $90 against a WTI crude price of 85. So that is the kind of pressure that real product prices are seeing in the market. Crude prices continue to rise up steadily, but our sense is that there is more bullishness probably in store, particularly if this dispute continues to be in this kind of absolute uncertain environment where we don't really know what the negotiating positions are and what the actual flows through the strait are. The actual crude that is still flowing through the strait, I think there are conflicting opinions. So what we believe is that $90 to $95 is, I think, something that will persist for a period. For the full year, we still are kind of optimistic that, some resolution will be reached and therefore there could be a decline or a moderation in the second half. So our average estimates are closer to between 85 to 90. But in the near term, we would expect that, prices will continue to rise up. And, probably, I mean, frankly, there's not really any particular cap that one can work with, given how uncertain things are. With respect to refining margins, I think this is something that we've been seeing and we've been saying earlier as well. It's not just the impact of the events in the Gulf, but also what is happening in the Russia-Ukraine conflict. If you look at the kind of refining capacity that has been impacted in Russia because of Ukrainian drone attacks, there's almost 2 million or 2.5 million barrels a day of refining capacity that has been knocked offline. Now, obviously, there would be varying estimates of when that capacity will come back online. But in the meantime, I think product balances continue to be much tighter than even physical crude balances. And that should keep margins at elevated levels. Having said that, for Indian refiners, what caps it a little bit is the calibration of the export taxes, which the government has been doing proactively to keep margins under control. And the second thing is the unofficial RTP cap, which is basically a negotiated price at which refiners are selling to the marketing segments, whether it's the OMC's own refineries, the independent refiners, or even private refiners that are selling to the OMCs. So that sort of keeps margins in the $12 to $15 range, despite theoretical margins probably trending at the $30 mark at this point of time.
Sorry, so when we look at the reported GRMs for BPCL, etc., I think it was above $41. For HPCL, it was closer to $23, $24. For the full year, refining margins, you're saying will be?
I would think that it would probably still be in the $12 to $15 range, because the way that they reported it, I think they mentioned very clearly that it was excluding the impact of the SAED, which is your export taxes. And, some impact of RTP capping also is not very clear in terms of what the exact impact is of that negotiated pricing. So which is why I'm saying that the net margin that is accruing would probably still be a more moderate number, because the higher that product spreads remain in these extremely high levels, I think the taxes and the kind of RTP cap would probably still continue to go up and sort of make refining margins at a more normalized level, in our opinion.
So what's the call, Probal, on oil marketing companies from here on? Because what we saw in Q1 is refining margins were strong, but they were offset by weaker marketing margins and LPG under recoveries. So now going ahead, what would be,
Yeah, I think it will be more of the same. Nothing really has changed. I think refining margins continue to be extremely strong. And obviously, some part of it will continue to flow through. But if you look at integrated margins, while as of now, I think retail margins, particularly in July, had been in positive territory that might start to reverse with the kind of strength that we are seeing in absolute product prices. But the real worry also is that what happens to LPG losses. If you look at LPG losses in the first quarter, they were actually half of, they were equivalent to the entire LPG losses in FY25 and almost half of the LPG losses in FY26 at about 20,000 crores. So if that continues to build and LPG availability continues to be tight, then I think that can be a drag on integrated margins. Other than that, I think refining margins are definitely stronger, and retail fuel margins, despite the strength in product prices, are doing definitely better in Q2 versus Q1 levels. So to that extent, I think things are little better. It's only the LPG losses, I think, that are a little bit of a worry. So we would probably still be constructive on the OMCs, but this is now clearly a 12 to 18 month play. FY27 earnings will be under varying kinds of stress. Putting an exact number is very difficult right now, but profitability will remain under stress for FY27 for the OMCs.
Okay, all right. What about the producers? ONGC, Oil India, we had the management of Oil India and they were guiding for much better times in terms of production. In a few years, actually, things haven't moved too much. But now they're saying they're scaling up capacity as well as production, both on the oil as well as on the gas side. Your view on both these two names?
I think Oil India remains a preferred pick for us. Very clearly, if you look at the first quarter run rate of around 0.995 million tons, and they're talking about getting to about 1 million tons per quarter, that alone gets them to about 4 million tons versus average levels of 3.2 to 3.3 million tons of oil production every year, if you look at the last couple of years, which in itself is a big jump. Gas production was a little bit weaker and has been a tad weaker in the last couple of quarters. But, once the Indradhanush gas grid is up and running, they have got the Duliajan-Numaligarh pipeline connectivity also done, except for a small part that remains. So once monetization options are actually in place and monetization infra, rather, is in place, I think gas production can also rise substantially. The guidance suggests that from levels of around 8 MMSCMD, they can easily get up to somewhere around 12 MMSCMD by the end of FY28, which in itself is almost a 50% jump. Realizations continue to improve or stay stronger for crude, and even for gas, this incremental 3.5 to 4 MMSCMD will be eligible for new well gas pricing, which, as you know, is at about 12% linkage to crude, and therefore is at, even at around the $85 level, can be about $10 versus the $7.2 to $7.3 that you get from your normal domestic gas. So for them, I think there are multiple triggers. NRL expansion is going online. The capex has already been spent mostly. So leverage will also start to, moderate over the next couple of years. And as and when that expanded capacity comes online, I think that delta will also come through from NRL, where I think EBITDA can actually potentially go to something like 7.5, 8,500 crores at a $25 GRM, inclusive of the excise duty benefit. So I think Oil India remains a fairly strong play in the market at this point of time.
Very quickly, since we're out of time, on city gas distribution companies, the government has planned to allocate an additional 200 SCM of gas. This is to boost piped natural gas connections. How material is it? Because stocks like Gujarat Green, earlier Gujarat Gas, have fallen about 30% in the last 6 months.
See, I think Gujarat Energy is a slightly different play, while the allocation of additional gas will definitely benefit the likes of IGL and MGL because they have been struggling, and the numbers showed that the margins are obviously struggling with having to source much more LNG than before, particularly on short-term basis, because long-term LNG supplies are obviously constrained due to Qatar Energy being out of commission. As far as Gujarat Energy is concerned, I think there the game is very clearly Morbi volumes. The management themselves stated that against 5.6, 5.7 MMSCMD of volumes that they did from Morbi out of the 12 odd MMSCMD that they reported in Q1, the numbers have again fallen to 3 MMSCMD because LPG or propane availability has improved. So I think till that dependence on Morbi remains, I think the stock will continue to probably be sideways. But having said that, valuations have turned extremely attractive at these levels. And if you take a slightly longer term view with the 11 to 12% CNG growth that we are seeing from the company, and with the higher penetration in the domestic segment, thanks to the new CGD regulations, I think from a 2 to 3 year perspective, it does offer value. But FY27 earnings again can remain fairly volatile based on propane availability and the economics of propane versus gas, which will keep Morbi volumes under check.
Got it. All right. Thanks a lot, Prabal, for joining in and giving us your view on the sector. Have a good day ahead. Well, we're getting into market opening, but let's hop across to Vivek. He's updating us on the large trade that he was tracking. Vivek?
Well, that's right. Aster DM Healthcare will remain in focus. There was a block that was launched last evening by TPG under the name of Centella Mauritius, where they own close to 9.9% of the total equity. They're looking to sell up to 7.2% of the total equity at an offer floor price of 766 rupees a share, which implies a discount of over 6% to yesterday's close. This particular block, if it happens at the floor price, indicates that TPG could mop up over 4,780 crore rupees, and there will be a lockup of 60 days on further sale of shares. Expect some pressure on Aster DM today.
Thank you very much for that. We'll watch that very closely. Here's a quick recap of the stocks that we covered earlier this morning. You should watch for ONGC, IGL, MGL, Gujarat Energy. Gujarat Energy was earlier called Gujarat Gas, HEG, Jubilant Increva, Railtel, Atlanta Electricals, Aster DM, and Quality Care. But stocks like the oil marketing companies like HPCL, BPCL, IOC could also be in focus on the back of the rise in crude prices. But I think the one, Aster DM, is the one where you are seeing the biggest up move. Just waiting for the bell to ring, and the bell has gone, and the first tick on the Nifty is absolutely flat. It's blinking red and green. The Nifty is open at 24,160, now slipped a bit, 20 points lower, 24,130, 24,135. But again, it's a very quiet, flat opening. We've had 6 days of losses where the Nifty cumulatively has lost 430 points. So today seems to be a session of pause. The Nifty Bank is also down close to about 0.2%. Midcap index opens in the green. The cuts are not deep anywhere, though the advanced decline ratio is in favor of the losing side. To run you through some of the drags, well, metal names are losing. So the top two losers are Hindalco, Tata Steel. Interglobe Aviation are hurting on the back of the rise in crude prices. We should pull up in Asian Paints as well. Bajaj Finserv, M&M, Geo Financial, Dr. Reddy's. As I said, these are all stocks which are down 0.5%, 0.7%. No deep cuts coming through. On the way up, well, IT stocks are actually on the way up. So you've got HCL Tech, Infosys, TCS, Wipro. Remember, IT stocks in the last two trading sessions sold off nearly 3.5%. So there is a bit of rebound taking place. In fact, now IT stocks are gaining some more momentum. You've got a Tech Mahindra, TCS also now back in the green. And these are stocks with gains of 1.5%. So the top gainers are IT. Outside of that, you've got green on Eternal. BSE, which was under pressure for the last two trading sessions, has also seen a bounce back. But all in all, the Nifty is now inching towards the 24,100 mark. The question is whether it will breach the 24,000 level as well.
Well, couple of stocks actually, Rima, that deserve special mention today. Zaggle Prepaid, that stock has opened up with a gap up more than 10%. Yesterday, we had noted investor Mr. Vijay Kedia, who bought 20 lakh shares of Zaggle at around 164 rupees. The total cost was around 30 crores or thereabouts. So we're seeing a big pop on that one. Remember, the stock had rallied to more than 500 rupees and came back to its IPO price. And Mr. Kedia has come in. The street is a little bit excited on that front. We'll have to see how that goes, and we'll look forward to speaking to the management rather soon. Next up, Milky Mist. It listed yesterday. It had a 30% gain, but it's not done. It's moving up yet again. It's up close to around 9.5% as we speak. Value-added products as a percentage of the mix are better. They've been growing faster than the market, and that's why a DAM Capital note said that it deserved that sort of valuation premium that it got. Now, post this big run, we'll have to see how that goes because it's rallied 40% in just 2 sessions. IGL, a bit of a positive news flow that came in overnight, and that's clearly set that stock up and about. Railtel is another stock that's gaining big time. So that stock, in fact, is seeing a big, uptake in trade, up close to around 6%. The trade that Vivek was eyeing, that is Aster DM, that's got out of the way, 11% equity, changing hands out there. So Aster DM has got knocked out, and that's why, in fact, that stock, in fact, is down. Now we'll have to see, since this large trade is cleared out, how it moves from here on. What else? I think that's about the list, Rima, in terms of the large movers. Finiotex Chemicals, volumes are very, very large just for the initial, few minutes. That stock, in fact, has opened up with a gain. Finiotex Chemicals, I think we should get that one up for you on the screen. Good move is what we're seeing on that one. And volumes actually very, very large. We'll have to keep an eye out on that particular name as well. And Saman Capital. Yesterday, we had told you that the news flow that was coming in appeared to be negative. But the source-based information that we got from the clarification that we got from the company suggested that actually it wasn't a negative. And that explains why, in fact, the stock yesterday, after being down close to 5%, I think, so at the lows, it recovered yesterday, and today it's putting on more weight volumes as well rather large because the official notification came in on the exchanges yesterday that actually doesn't affect the company whatsoever. And if you are to read it through, then it clears some part of that uncertainty. So explain why that stock as well is up in today's trading session.
Well, Milky Mist, look at that. It's up another, 10% now, almost at the 200 rupee mark. So valuations would now, I guess, closer to 45 on Milky Mist. And IGL, MGL too have started off with strength, up close to about 4.5%. For the Nifty, 24,115. Sanjeev Prasad, Managing Director, Co-Head, Kotak Institutional Equities, is now here with us on the show. Sanjeev, morning. Always a pleasure to have you. Now that the earnings season is done, take us through the market construct.
It's pretty much the same in the sense the macro outlook has become better, but fairly volatile, I would say, depending on what's happening in the Middle East and crude prices in particular. Earnings outlook looking a lot better. We're looking at about 79% growth in net profits of the Nifty 50 index for the current financial year. And 1Q numbers were also pretty decent. Similar kind of growth as far as the Nifty 50 index is concerned. And if you look at the rest of the market that's beyond the Nifty 50 index, the numbers are again coming out to fairly strong. So no worries about the earnings outlook for now. Having said that, valuations have run up, particularly in the mid-cap and small-cap names in the last 3-4 years, 3-4 months. And large caps continue to struggle given sector-specific and company-specific issues which have been affecting many of the sectors and the large cap names in particular. Yeah, so all the action is really outside the large cap names looks like currently.
Hi Sanjeev, good to see you and Sanjeev. But as you said, the first quarter earnings actually were a little better than what the street was working with. For the year, what kind of Nifty EPS growth are you working with? And do you have a rough advance, the number of upgrades to downgrades ratio that could have changed in the first quarter, if you have a rough number?
I don't have that. But if I look at our overall numbers, as I said, for Nifty 50 index for the current financial year, looking at about 7.5% growth in net profits. It is pretty much unchanged actually for a long time now. For the last 7-8 months, it's been in that range only 17 to 18%. So at least, that's one good thing this time around that you're not seeing that level of earning downgrades. In fact, at least our numbers seem to be holding up reasonably steady compared to FY25 and FY26, where you saw a lot of earning downgrades, which is one of the reasons why the market very struggled over the last 2 years. So at least earning outlook is looking a lot healthier. Nominal GDP growth has picked up, on the back of both real economic activity being surprisingly resilient actually compared to the macro concern which was there 3-4 months back. Economic activity continues to be fairly robust both on the consumption investment side. And of course, given the fact that you have tailwind of inflation this time around, the top line growth is looking fairly strong. On top of that, you have fairly high commodity prices, which is helping drive the numbers of the commodity sectors such as metal mining, oil and gas. They have been big contributors, at least for the first quarter numbers, and even for the full year, we are looking at pretty healthy contribution from there. And then, the domestically economically sensitive sectors continue to fine, despite all the concerns around possible slowdown, etc. So far, at least the high frequency economic activity indicators seem to be holding up fairly strong.
Can we expect such strong earnings growth to sustain beyond FY27? As you said, this quarter and perhaps this year is supported by commodity prices. So for FY28, FY29, considering we've had 2 rough years, 2 years, FY25 and FY26, we had very low EPS growth. Is this the start of a very strong double-digit earnings growth cycle for the Indian markets?
Well, this year at least is looking better given the fact that you had a low base in several sectors. Plus we have higher commodity prices and we are seeing at least a fairly strong economic activity, I said, in both consumption and investment side. So at least this still looks fairly fine. 7.5 is what we're looking at, as I said, for the net profit growth for the Nifty 50 index. Next year we have about 14% for now, assuming some more recovery in the economy. And more important, banks starting to come back, because if you look at one of the drags as far as the Nifty 50 index is concerned, even this year, we are looking at only 8% growth for the profits of the banks in the Nifty index here, despite 7.5% growth for the overall index. So once this NIM ratio stabilizes, hopefully, we'll start seeing reasonably healthy contribution from the banks also. So next year also we are okay for now. 14% is fine. Beyond that, it's hard to comment really. For at best, we work with nominal GDP growth of around 11% in the longer term, and work on that basis.
All right. What about tech, Sanjeev? You have an equally bullish and bearish argument out there. Which camp are you in? Some are arguing that valuations have come to those levels that you want to dip in for the longer term. The other side is saying you don't know what's going to happen next. How relevant are these IT companies that have done very well in the last many years, in terms of their growth? You don't know whether they're going to grow from here on. You don't know how the businesses are going to evolve from here on. So which camp are you in? Will you be selective or will you avoid the sector, or do you think it's time to get in?
We are being bearish, and I continue to be in the avoided cap. The arguments about historical valuations, honestly, I don't know why people keep on insisting on it. I mean, things are going to be so different in the future compared to the past, so why even bother looking at historical valuation? That's been one of my prime, worries with this market for the last 7-8 years. I've been saying the same thing. So much of disruption happening across sectors. Why do we keep, falling back on the crutches of historical valuations? They were valid in a certain context of, growth, market structure, etc. Things are going to be a lot different. So why bother about historical values to start with? With that, if we look at the changes which are taking place in the sector, in the short term, of course, we have a very uncertain demand environment. On top of that, the customers are spending a lot more on hardware, tokens, etc., which means the IT budgets, even if they're growing modestly, are getting diverted to other areas, which means the amount an enterprise is left with to spend on the traditional IT services has anyway come off. So that is anyway a challenge in the short term. In the medium to long term, given the rapid progress of AI, and that is not going to stop. It's going to be faster and faster only. So what is the relevance of it in IT services sector? How it will evolve in the new ecosystem? Who knows? Where Indian IT services fits in. And one thing to keep in mind over here is in an environment where the growth itself starts to struggle, you have to keep an eye on margins, because when I look at the assumptions of the analyst community, most of the analysts seem to have factored in some slowdown in growth for the next couple of years, and then pick up in growth after that. I don't know where this confidence is coming from. And more important, margins are more or less stable, which I doubt, to be honest with you. If I look at any market, wherever you start seeing slowdown, a large number of players, margins have to come under pressure in my view. And that is my bigger issue, which I think the market is completely ignoring for now.
It's a competing brokerage, Sanjeev, but there's a CLSA note, and they're basically saying that AI volumes could supersede the deflation impact only by FY30, which means a very long period of low growth. Already we've had 3 years of very low single-digit earnings growth for the IT companies, and that now could get extended till FY30. And only in FY30, they move from low single digits to mid-single digits. So double-digit is not in the picture, at least as of now. But you have a hawk's eye on the valuations of particularly mid-cap, small caps. At some point, it's caused you a lot of consternation as well. You almost, when you look at the markets, you feel like there are two different markets. Some of these small cap, mid caps have been in their own bull market, while the large caps have been struggling. So take us through the valuation picture now for small caps, the themes which are overheated, not justified right now. What's your view now?
Again, I would request everybody to stop looking at it mid cap, small cap, by the standard definition of companies falling in a certain market cap. Honestly, it has start making any sense, because if you look at the so-called defined, universe of mid-cap stocks, which is the 150 stocks, 1 to 250 based on market cap, it's a completely, random, honestly, assessment in my view, for the simple reason, what is this construct that says that 101 to 250 stocks should be mid-cap stock? The market cap of so many stocks have gone up so much in the last 5-7 years, but somehow this 105, 101 to 250 should only be mid-cap names. I mean, where does this come from? I have no idea, but somehow it's been defined as mid-cap universe. Second more relevant point is, look at the construct of the mid-cap index by itself. It keeps on changing so dramatically, for the simple reason you have some theme or narrative which catches the fancy of the market. And then, you have a whole host of stocks and, which play on that particular theme, which come into the mid-cap index. So the index itself keeps on changing so dramatically. You compare the composition of the Nifty 50, Nifty 150 mid-cap index 5 years back to now, there are only 46 stocks which are common, by the way, in that 150 stocks. So many stocks come and go. What are we comparing also? I don't know when we talk about mid-cap. It's better to focus on sectors and stocks on a more bottom-up basis rather than looking at this, so-called artificial concocted version of this mid-cap and small-cap universe, which honestly doesn't make any sense to me.
Okay, Sanjeev, what do you like then? Which is that theme you like? I think you're bullish on select themes like data center plays as well. So how would you play that theme? If you could help us out, a couple of two themes that you're quite positive on.
There are so many themes. One is positive one in India. You have to ultimately put that in the context of valuation, right? Like I've said this previously also. What do you want to own in India on a 3-5 year time frame? Ultimately, you want to own, consumption story which play more on the discretionary, spending, which will increase as we go forward. So basic thesis for India is what in the next 10 years, presumably our GDP per capita, which is $3,000 now, or some 3,000 will go to about $5,000 per capita, assuming 7% CAGR in dollars per capita terms. Where will the additional spending go on? Or presumably it will go on, discretionary services, which is healthcare services, hospitality, which includes travel, tourism, transportation, retailing, etc. And that would include financials also in the bucket. So that's one bucket to play on. The second bucket to focus on is the domestic manufacturing theme. Again, you have a whole host of sectors, which can fit in this theme. You have, capital goods, CDMO, defense, electricity, electronics, and so on and so forth. But of course, you have to always overlay the valuation argument. Things will definitely grow in India. There's no doubt about it. So if you just ask me in isolation, yeah, you are bullish on everything in India, right? More or less. But if you overlay the valuation argument, then the investment universe in the short term diminishes significantly because, things have run up pretty sharply in the last 3-4 months, particularly in the so-called mid-cap and small-cap names.
Okay, all right. Well, appreciate you joining in, Sanjeev, and giving us your view on a lot of sectors, themes, and how do you see the earnings as well pan out. Have a good remainder of the day, and we catch up soon. Well, let's focus on another company then, IIFL Finance actually. That's been one of the outperformers in the last 3 months or so. The stock has seen a good rally. Some part of the street believes that valuations are still very, very cheap in comparison to some of its peers. So let's welcome Mr. Vikas Jain, the CFO of IIFL Finance, who joins us on the show. Hi Vikas, good morning. Good to see you in, and thanks a lot for joining in. Well, the street seems to be bidding up the stock price and they are expecting better times ahead. We had a bout of turbulence for a bit, and then you're getting the pieces together. Now, if I look at it in the last quarter, your gold loan portfolio grew despite gold prices coming down. So that's telling us that the tonnage growth actually went up. What kind of growth are you working with on the gold portfolio itself, if you could help us out with that? And also yields, when we speak to some of the other larger players, say like a Muthoot, yields have come down for them, but they were at very, very elevated levels. How do you see your yields pan out in this sort of a competitive environment?
Yeah, so thank you so much for having me on your show. The first thing which we are happy to inform that we have been, upgraded from the Fitch ratings from B+ to BB- stable outlook. And last month also we have received a Ba3 ratings from the Moody's rating. So quite a good developments are happening in terms of our credit profiling or the rating profiles in terms of our last 1.5 to 2 months. Coming back to your specific inputs or questions which you have is that how we are looking in terms of our gold loan portfolio yields and so on and so forth. So yes, we are growing in a very decent space at a 20-25% on a kind of this growth, and consistently we continue to aspire to growth in directionally for this year as well. Yield side, yes, we have on a quarter-on-quarter basis around 39 basis point improved from the last time to this time, and we continue to remain similar kind of yield segment, and that is what I will say on this side.
All right, just one point with regard to this yields, what is it at post this improvement in terms of yields, if you could tell us? And if I got that number correct, on the gold loan portfolio, you're talking about a 25% growth, right?
Yes, on an overall consolidated basis, it will be 20-25% overall AUM growth, which we are aspiring for the year. Obviously, gold loan will have a little higher growth depending on the macroeconomic environment, gold prices, and the market demands, and remains overall size of the market keep increasing, which we are seeing from the last quarter-on-quarter basis. So, if these are the benign conditions, yes, gold loans may have a little more increase on a AUM growth side. But on an overall basis, put together consolidated basis, just to give you the perspective, we have improved our profitability matrices from last year on a full year basis, 817 crore to 713 crore in a Q1 basis. On an asset quality side, there is a significant improvement which we have registered from a 2.4 basis to now it has come down to 1.6 on a GNP, and NNPA has come down to 0.8 basis. OPEX to AUM is again from a peak of 4.2, it has come down to 3.1, and overall PCR is also in a very, very decent, healthy side, upwards of the 90%, and ROE of like 3.1 and 19.5%. So our guidance is that yes, we will continue to remain this kind of numbers only for the financial year 27.
Okay. So are you being conservative, Mr. Jain, in your guidance? Last year, you did 38%. In Q1, a similar AUM growth, yet you're guiding for 20-25%. Is that being conservative, or are you sensing that going ahead, there will be a slowdown?
So this is naturally an outcome of two things. One, as I said, gold prices. So like if you see the from Jan to now, there is almost 25-30% gold prices correction has been we have noticed. But still, despite of the gold prices correction, whatever is the market benign condition and the clear regulatory framework and the operating environment being very, very supportive, there is a growth among all the players, including us, and we have registered similar kind of a growth. And yes, we will remain focused in terms of the growth orientation. The only perspective which is there is that being a little global macroeconomic headwinds, West Asia crisis, there may be a little bit turbulence in the gold prices, and gold prices have a very direct linkage sometimes in our growth path. But still, we continue to remain on, as I said, this kind of guidance.
Okay, and this Fitch upgrade, what we began the conversation with, how much will it help your borrowing cost and access to overseas funding? Some numbers?
Yeah. So on a steady state basis, the rating improvement will definitely bring around 40 to 75 basis point of improvement. And also this is will be dependent largely, the global economic headwinds where the hedge levels, if goes little competitive, and the overnights offer and the spreads will definitely come down. So if everything remains benign and the conditions remain, so we may want to, aspire to tap another round of funding. Recently, we have done 500 plus 300, 800 million kind of GMTN under GMTN program, the fundraise in the dollar bonds, and the issue was very, very successful under the social bond tranche, and it has oversubscribed to 3.4 times. So that has been very, very wonderful. We have seen the participation coming from across all the world, including the Asia, Europe, and the US market.
All right, Vikas, the street obviously likes what you're doing in terms of business. But obviously, it's something like Dil Mange Mo, right? They're expecting some kind of unlocking to take place. Is there any kind of fundraise plans? That's the buzz that probably IIFL Finance, either in the parent company or in one of their subsidiaries, are looking at getting in an investor. Probably a foreign investor as well could be the case. Is there any equity raising plans as of now, Vikas? Is it likely? Do you want to deny it totally? Or do you want to say it means, probably?
So I will say we have shareholders approval coming in last our AGM about our fresh equity capital raise, which we have on the 24th of July. And now the organization is in the process of, doing this kind of a fundraise. But at an appropriate time, board will consider the overall scheme of things and will come to know in terms of this. But right now, it is under consideration and discussions at different levels.
By when do you think this plan can get firmed up, and what could the quantum of this fundraise be?
So it is definitely an outcome of two, three things. One, how the good valuations at this point of time, how it will bring to that level. Second, obviously, we would like to have a more capital support with our growth aspirations plans for next 2 to 3 years. So that should also help us in terms of doing that. And third, it should also have a good margin of safety in our capital overall adequacy side on a regulatory capital. So we considering all these three things, there will be a kind of a good, decent amount which we will be working on that.
So by Q2 results, we should hear about this.
Sorry?
By Q2 results, we could probably hear about this fundraise plan or prior to that.
I will not want to commit any timelines because this is something, an outcome of 2, 3 things. As I said, the market conditions, how the investors look at and this thing. But what I can assure you is that we will continue to grow with our internal approvals and healthy, business credit profile of the customer segmentations, which we are doing, improved asset quality and the bottom lines. So that is definitely the guidance which I can confirm.
At least as of now, you're telling us that yes, there is some kind of fundraise plans. We'll have to see how that goes, the quantum and when that comes about. So we'll wait by for that. Just one more question with regard to value unlocking. The housing vertical, the AUM I think is around 30,000 crores. You could correct me on that number. But is there a probability that you look to unlock value and list that entity separately? Is there a scale, size or timing?
So housing number on an overall basis, 43,000 crores the AUM is. And again, the question which you are asking is that the value unlocking in terms of the housing side. So as we speak, we have started a very decent growth in terms of our overall, affordable housing segment where PVC criteria is of affordable home loan and then rest is our lab business MSME secured, which we have approximately average ticket size is like 15.5 to 16 lakh. So in case of any opportunity comes or something comes, definitely this can be an under consideration thing. But as we speak, in short to near term, there is all options are open, and depending on the scenarios which you earlier mentioned, whether it can be a subsidiary unlocking or a fresh capital infusion in terms of the IFL finance at a holding entity level. So we are working on this side. So possibly board is under evaluation process of doing these things.
And just to complete that point about gold loans, and are we seeing an increase in the competitive intensity which is putting pressure on pricing? While for now your yields have gone up, as you said, yields have inched up sequentially. But has there been a material increase in the competitive pressures? Are you seeing competitors undercut to get loan growth?
So competition is always good and welcome as organizations, what we have always encouraged on that side. But what we believe is that ultimately who will be able to succeed is that wherever we are able to give a good customer experience with the superior tech quality and a kind of AI things initiatives which we are leading for the customer, this thing to make sure that you may have a minimal turnaround time for the customers branch walk into final disbursements which we are doing on that side. So all these things will actually make a good repeat franchise customers which as organizations which we have, and gold having a very very sentimental value for the Indian families. So we continue to believe that though the competition is there, but our customer franchise will remain very very sticky, and we will continue to serve those customer segments where we have always been focused, especially on the retail loans, which we always encourage on that.
All right. So besides operational performance, we've got two things clear. Fundraise could be on the corner, sometime, as well as you could potentially look at listing the housing finance vertical at some point of time. So some are value unlocking on your mind. Final question, the multiple you'll get will move up if the ROAs as well as ROEs improve. What's the target for both those two?
So ROA, ROE, we have committed, given a guidance kind of thing for the near term is the 3.1 to 3.3, and on let us say short to medium term is 3.5%. So on a steady state basis. So that is what we are saying. ROE side, we are aspiring for like 16 to 20%, and definitely in a short to medium term is 18 to 20%. So that is like our aspirational, and we should be able to make this happen. That is what we firmly believe on that side. And definitely this will have a good impact on the value multiple improvements incrementally on our prices, stock prices.
Okay, Mr. Jain, we'll leave the conversation here. Thank you very much for joining in and talking about a whole host of issues today.
Thank you so much. Thank you.
Okay, for the markets, we've dipped below the 24,100 mark on the Nifty. This would be the 7th consecutive day of weakness and losses for our market. And do keep note of the Asian markets because pressure is mounting from Asia. The Korean market's Kospi is down nearly 6%. The Japanese market down 3%. Shanghai market is down nearly 2%. So there is pressure from the shores and that's also hurting the sentiment. If you look at the stocks which are dragging, I think barring an IT sector, the rest of the markets is weak. So the defense index is a cut of 1.5%, energy complex, metal complex, realty, commodities, all down close to about 0.7, 0.8%. But what's doing well today is perhaps the IT index. It's the Seoul index, which is up in the grain. FMCG is flat, but the Nifty IT index is up 0.8%. Now, yesterday at the CNBC TV 18 NASSCOM event, we had some fascinating conversations. And the question was all about AI, the ROI on AI, the cost of AI, what is the disconnect between what the companies are telling us about the AI opportunity and what the market seems to be pricing in. So this is, let's just quickly cut across to some of the comments that we had. Here are Microsoft India's head, who's Puneet Chandok, who believes that nobody's better positioned than the Indian IT to benefit from AI. Arundhati Bhattacharya of Salesforce was also a part of the conversation, and she says this whole SaaS apocalypse narrative has been proven false.
This industry will go through bad times before it gets better, as I always say. So I think we're going through that turf at this point in time. People always ask me, will the industry pivot? The industry has nothing to pivot here. I think the individual companies will pivot. Will all the industry players will pivot? Probably not. 80% of them will pivot. Maybe some of them will not pivot. But the opportunity you saw in those charts, the TAM that we are talking about, the opportunities that for the services company to truly cross the chasm, if you may, that's for real. And I don't believe that the markets have actually priced in yet.
We look at a few transitions, and possibly our industry is experiencing one right now. And it's a transition of two pivots. I think that was also spoken about in the first presentation of what's under pressure and what's new. And the growth of opportunity in the new is something that we have been reporting quarter on quarter. It's been last 3 quarters we've been reporting, and that's a mark of confidence and conviction. The path that we have taken, the path that we have chosen.
Every headline has been screaming about the SaaSpocalypse. Now, how do you, sitting at Salesforce, deal with this?
I think, our results are expected very shortly. So really can't speak about that in as clear a language as I could. But I think that that narrative has already been proven false. The thing is, we are all in a stage of transition. And let me make this comment regarding this outcome-based pricing. When this outcome-based pricing really starts working, they want to go back to the license-based pricing, okay? Because the outcomes are so many, they don't like it then.
I was with a client recently and he said, some of these frontier models that I'm working with, they're like brilliant strangers. I said, can you explain this to me? He said, they're brilliant strangers. They know everything about the world. They know nothing about me. Can you get me a familiar friend? Can you get me a child who grows up in my organization, understands my context, the knowledge turns, what does a good work look like, and then get that to answer questions or do work for me, which is where the new value pool is, and Naushir spoke about, right? Which is translating this enterprise ontology, the enterprise context into these frontier models, and getting these models to work for you on your own terms versus the other way around. Satya spoke about the reverse information paradox. Don't pay for these models twice. So I think that is where the real value pool is, and I don't think there's anybody better positioned than the services companies in India who have the context, who have the domain knowledge, who know how to do this at scale.
Okay, what a fascinating conversation there was. But let me take the IT discussion forward and talk about the CLSA note that's come in from IT. So basically what they're saying is this whole AI technology transition is going to create winners and losers. And according to them, mid-cap IT companies are better positioned. So they believe they're better placed to take advantage of the technology changes given the stronger management, the execution, and the ability to adapt faster. So which is why CLSA has a high conviction outperform on Persistent and Coforge, and they also have an outperform rating on two other stocks, Hexaware and LTIMindtree. But for large IT services company, they say the picture is tougher because they are dealing with AI-led deflation in their legacy business. There are macro headwinds like geopolitics, inflation, interest rates, and weaker discretionary spending. So therefore, CLSA has downgraded TCS, Infosys, Tech Mahindra to a hold, while Wipro and Mphasis have been downgraded to an underperform. But I think this is perhaps the most important takeaway from the report, right? Everyone is wondering when that AI inflection point will come, when the net benefit from AI will supersede the net loss on account of AI, which is basically deflation. And according to CLSA, they're saying this will happen only in FY30, when AI volumes will supersede the deflationary impact. Which, other words, it basically means that this industry is going to be stuck in a period of subdued growth for several years before the AI volume is large enough to offset the revenue deflation. Remember, the Indian IT companies have been, seeing very low growth for FY24, 25, 26. FY27 was expected to be the fourth year of weak growth. And now CLSA is basically saying that this perhaps could extend even till FY30. Now look at the numbers, what they're saying. And I think this is for the first time we are seeing any brokerage talk about it. Now for TCS, the AI revenue is currently expected to be about 10%. It's about 8.5%, 9% as of the current quarter. They're saying by FY27 it will be 10%. This goes up to 33% by FY30. And only when that happens will the growth move from 2.5% in the current quarter to in the current year to 6.1%. Low single digit becomes mid single digit. Even for Infosys, AI revenue goes up from the current 9% to 32%. And that will help push up growth from 2% to 5.6%. And again, the similar number for HCL Tech. So today, AI as a percentage of the overall revenue is in terms of mid to high single digits. By FY31, it goes up to 30% plus. And when that happens, we will see growth move up from low single digits to mid single digits. So basically, in a nutshell, they're saying that the low growth period will persist. Valuations, they're saying, are balanced. The risk reward is balanced, but there are three structural headwinds. GCC, they're not gaining market share over global peers. They're losing out to hardware and software companies in the global AI rollout. And some of the target prices will also come up for you on your screen. As I said, the high conviction outperform is in Persistent Coforge. On Hexaware, LTIMindtree, it's an outperform. A hold call on TCS, HCL Tech, Infosys and Tech Mahindra, and an underperform on Mphasis and Wipro. So that's the CLSA call.
Got it, Rima. Thanks a lot for that. For the time being, though, we'll slip into a short break. The management of Supreme Industries is waiting for us on the other side. Stay tuned. Welcome back. This is Corporate Radar, and on the Nifty itself, we're seeing a tad bit of a recovery from the lows of the day, and even on the mid-cap index, I think some kind of a bounce is what we're seeing, which is good news. Let's focus on Supreme Industries, though. We have with us Mr. Taparia, the Chairman and Managing Director of the company, who joins us on the show. Hi, Mr. Taparia. Good morning. Good to see you in, sir. Always good to have you on the show. Well, let's focus on a couple of aspects then. PVC prices, they've seen quite a lot of volatility in the last few months or so. What is the price move that you've seen of late on the PVC side of things? And with the MIP being imposed, it gives you some protection, I understand. So what's the direction in terms of pricing?
The volatility has been now contained. It has started from 1st April, between 1st April to 1st August. the price has gone down by 20%. Now we believe with MIP coming, the volatility will come down dramatically, and the business are on growth path.
Okay, all right. So you're saying now the prices are on recovery path, right?
Yeah, right.
All right. And the MIP that was imposed, that's helping out.
You are talking MIP?
Yes, some protection was announced, right? For players
MIP curtailed the volatility because in India we are dependent too much on imports. Right. Around 68% requirement is met through import. So the volatility price, it was against investment to make PVC raw material domestically. We believe that this containment of volatility will spur investment in domestic production. It's very much required that domestic production must go up. We are very uncomfortable that 68% requirement is made from import. That is not desirable. PVC is a very important building material. So more and more production must be made in our country.
All right. And what about your sourcing, sir? A polymer, on polymer? How much of it is imported?
What do you say?
How much of your raw material, sir, is imported? How much of it is sourced domestically?
No, as I told you, PVC raw material, 38% is only available locally.
Got it.
32% and 68% imported. And even we are buying the maximum quantity from local suppliers, but local supply got limitation. As we are converting around 500,000 tons of PVC, I have to import large volume also.
Okay, got it, sir. Could you help us out in terms of the volume outlook for the year? Q1, as you said, well, it was marked because there was volatility in PVC prices and demand as well was a little bit softish. So Q1 was soft. But you're expecting a good recovery on volumes from here. Tell us what is the overall volume growth that you're working with for this year? And on pipes, what is the volume growth you're looking at?
We maintain our volume growth on plastic piping between 15 to 17%. As you are aware, in first quarter, we had a degrowth of 15% on plastic piping system, but the degrowth of 15% has come down to 3.5% after the month of July. So we maintain our volume growth guidance. If any question is required, we will talk only after the first half is over.
Got it. All right. And so pipe growth should be 15 to 17% and overall growth should be in the vicinity of what, around 12 to 13%?
We maintain 12 to 13% overall volume growth will be maintained.
Give us a sense in terms of demand. Has there been, is there stocking that's taking place yet again? Has demand improved on ground? What are the channels suggesting to you, channel checks?
And demand in piping sector, demand is a setback in the first quarter of the year in agriculture segment because the prices came down dramatically in the month of April. But we believe that coming from September, middle of September, the demand in agriculture will also come up. Infrastructure demand is still not started. Now the budget has been cleared and the flood situation are coming under control, hopefully. We believe that from October onward, the demand from infrastructure segment also will come properly.
Okay.
Housing demand is maintained.
Housing demand is maintained. Got it. All right. And what is your split, sir, between the housing demand and agri, if you have that split?
Sorry?
For your pipes, how much of it is to various industries? Do you have that split with you?
No, we supply in all the segment in agriculture, housing and infrastructure.
Correct.
But our agriculture pipe are used many places in housing also. So I cannot segregate the demand segment. How much is housing, how much is agri? But we are large player in housing only. Agriculture is number 2 and the infrastructure is number 3.
Got it. At least we've got it in terms of, what is the breakup. Now, I was looking at your piping EBIT per kg, sir. You can correct me on this number, but in Q1, I think it was 16 rupees.
Sorry?
The EBIT per kg, if I look at your piping segment.
Sorry, kg, I don't know.
The pipes EBIT per kg.
You can see our operating margin, we maintain it is going to be between 14 to 14.5%.
Okay, 14 to 14.5%. Yeah, I was trying to get it on a unit basis, sir. On a kg basis, I think it was 16 rupees, 16. But you're saying that margins you'll maintain at around 14 to 14.5%. Is that correct?
And our turnover we anticipate to maintain with 12,500 crore to 13,000 crore.
12,500 to 13,000 crores for this year with margins at 14 and 14.5%. Got that. What about return ratios? You have been making an attempt and you have given a guidance as well that return ratios will improve from here on, ROCE. Tell us how does, where are we at and where is it likely to move?
Our ROAC last year was around 27.5%. Yes. This year we expect it should be close to 30%.
Okay. This you're talking about the ROCE?
We work on ROAC.
ROAC, got it. All right, because your ROCE last year I think it was around 20%, and you're expecting.
Last year it was around 27.5%.
Okay.
This year we anticipate it to be close to 30%.
Got it. All right, and you're focusing on value, operating leverage as well as value creation as well, which is going to help you get there. Final question, sir. Export market, how big a opportunity is that for a company like yours? If you could help us out, what is it as a percentage of the contribution right now? Where is that number headed as well?
No, I don't follow. Export, we are focused on export, as we told our in the annual meeting. Our export last year was $26.5 million, and we are planning to take it to $150-200 million, for which we have appointed more human resource. We are participating in more exhibition. You will see from first half of this year only, our export will go on rising every quarter. We are participating in more exhibition and we are getting good inquiries from export market.
Got it, Mr. Taparia. Always a pleasure speaking to you. Thanks a lot for joining in. Wishing you and the team all the very best in terms of the growth outlook that you've given us, the profitability, and as you said, there is stability that's coming out in terms of pricing, demand as well as bouncing back. Wish you and the team all the very best, sir.
Thank you very much. Okay.
Okay, all right. Well, before we get to the new listing, I think we should pull up a couple of stocks. Aster DM, Vivek had told us about that large trade taking place. That got cleared out of the way. And sometimes when you see 10% equity get cleared out, then that overhang on the stock moves away. That's why the stock from the day's low, I think it's up close to 7 to around 8%. Saman Capital, what a big move is what we're seeing on that one. Yesterday, the low was, I think, around 145 or thereabouts. It built on yesterday and today as well, post the clarification coming in on the BSE from the management. That as well has recovered considerably from the day's low. And Doot Transmission moving from strength to strength. That stock as well up and about in trade today. But we have two new listings that should come up for you on the screen. We have Shiprocket, that's up and about, and Bihari Lal listing. Both those two have been good listings. We'll try to get in the management of Shiprocket in just a bit from now to help us out with how they expect business to move ahead. And Bihari Lal as well has done pretty well, up more than 60%. Well, let's get in Vinay Rajani of HDFC Securities, who joins us to help us out with the trade on the Nifty. Vinay, what do you make of the first 45 minutes of trade? The Nifty has been soft, but do you think it's providing some kind of an entry opportunity?
Yeah, so continuation of a downtrend is there, 7th consecutive session of fall, and now Nifty is approaching the crucial support of 24,050 odd, where the 61%, 61.8% retracement is there. So this retracement is nothing but the retracement of the rally which we saw. That was 1100 points rally, started from 24th July to 3rd August. That 1100 points rally was significant with a momentum. Now 61.8% of that move retracement is placed around 24,050, and there has been upward sloping trend line joining the April, June, and July month swing low, and that is also coinciding around 24,050. So we are of the opinion that we should wait for that confirmation that whether it is taking support or breaching support. Breaking 24,050 decisively on closing basis, then it will turn definitely on the bearish side, on the positional side. But we at the same time, we can see some opportunities on the long side. Some sectors are still performing very well. Some of the fertilizer, chemical stocks, some of the defense stocks have been doing good. Now, that is a good thing. So I think the overall trend will remain stock specific, sector specific. And as far as Nifty is concerned, one should have a 24,050 as a stop loss on closing basis. Once we get a decisive close about 24,300, then it will confirm the resumption of an uptrend. Till then, I think one should wait and watch in the Nifty. But stock specific, one can find long opportunities.
Tell us some of those opportunities then.
Yeah, so sugar space I think is really looking good and started doing well, and this is going to last. Positionally, we believe that that can be utilized with going long in some of the stocks like Dalmia Bharat Sugar, which is placed around 468. So that is looking very strong on the charts, and for positional traders also it is looking very good. So entire sugar theme can be looked at for short-term investments. So for traders, 468 should be the entry, 455 should be the stop loss. On the upside, 495 is the immediate target. I'm looking at the chart. The second theme which we believe can work out is the fertilizer space. And out of this fertilizer space, some of the stocks are really doing good. One of the stock which we like on the chart is GNFC, Gujarat Narmada Fertilizer and Chemical. That is looking good, and around 610 one can go long as a trading bet. 595 should be the stop loss. On the upside, we are expecting a target of 640.
Got it. All right, Vinay, thanks a lot for joining in and giving us those quick views. Well, today is going to be, an interesting trading session from the Sensex perspective, because tomorrow you'll have the weekly expiry that will play out. And for starters, in line with what the globe has seen, our markets as well have started off soft. The Sensex for the time being is down close to around 200 points. So there are a couple of indices actually that are doing well. The BSE IT index, the BSE metal index, both of them actually are active in trade. So the IT index is the top gainer, while you have the metal index actually that's recovered from the day's low. It was down more than 200 points odd when I put out this update. So, mixed trends coming in from the globe. Looking at the options data, the 77,200 call, the premium out there is halved. At yesterday, when it ended, the premium out there was around 360 rupees. That's come down to around 180 rupees. So the premium is half, telling you that there is considerable amount of writing out there. On the 77,100 call as well, the premium out there as well has come down by close to around half. It's come down to ballpark 220 rupees from around 415 rupees approximately. So the writers are at play at 77,100, 77,200. At around the 77,000 put mark though, there is some signs of writing actually at lower levels, which is telling you that the bulls believe that maybe in fact at lower levels they are playing for a bit of a bounce. But in the near term, the 20 and the 50 DMA, if we move to those levels, it's going to be met with considerable amount of resistance going by the options data and going by the kind of call writing that we've seen. And both of them should come up for you on the screen. The 20 DMA is, there, as well as the 50 DMA. So the key levels that you're looking at going by the options data, 77,500, 77,450, going to be a crucial resistance mark. While on the downside, looking at the options data, that 76,800 becomes a bit of a support zone. So that's the broad range that you're looking at in terms of the Sensex. We'll keep an eye out on those levels. Tell you what, slip into a short break, come back. Manisha Gupta is waiting for us on the other side of the short break. She'll tell us all that's going on in the commodity markets. Stay with us.
Welcome back. Let's turn our attention now to the commodity markets. Manisha joins in as always. Manisha, what are you tracking?
I'm looking at the crude oil prices because after 2 weeks of strong gains, we're looking at a third week continuing that way as well. So yesterday was 91, today it's $92 a barrel that we've seen in the earlier Asian markets. And with that, for the month of August, now we're looking at nearly 8 to 9% of gains that the crude oil prices already have put forth. Well, there is support coming in from US and Iran, which are showing little indication of any resolution therein and reaching an agreement for that matter as well. There have been Strait of Hormuz, which has continued to also see lower supply movement from 130 to 140 ships passing every single day. It has fallen to a trickle. Last weekend was 31 ships. This week has been about 5 to 7 ships. So that is what the numbers are, is what the markets are looking at. And then US has put out very, very strong statements with the president saying that there is no ongoing negotiations with Tehran right now and that the US naval blockade remains in effect therein. Also, Iran forces have intensified their hostilities as well. There have been reports on how there have been 8 attacks on vessels transiting Hormuz in the month of August till time therein. The U.S. inventories have continued to decline as well. Markets are anticipating nearly 3.28 lakh barrels of a decline in the previous week itself. When you look at the U.S. commercial crude stocks, well, they are the lowest since 1983. And what the markets are jittery about is that as we move ahead from there, even as the driving season may not have been good, but winter season demand actually is a necessity, it's an essential, and that is where you will need stocks continuing there. It's also about escalating refining margins and diesels, not just in the Asian markets, but when you look at Europe, North America, the refining margins and premium diesel costs are hitting record highs right now. It also has to do with the global production gaps, whether it is about OPEC and Russia. While on paper, they have been increasing production, but the markets are looking at much of that production behind that blockade or within the Middle East as well. And the global oil supply in the meanwhile is anticipated to drop by 4.3 million barrels per day for the year 2026. That in turn also would be supportive for prices, with markets believing that this quarter could see higher highs. $95, $98 a barrel are the next targets for this one. For today, though, it's going to be about the U.S. July FOMC meeting minutes. Market would take further direction from this one.
Thank you very much for that. And Aster DM opened lower on the back of that block deal where TPG sold stake, but now it's recovered because that supply is out of the way and there will be a 90-day lock-in. So Aster DM has now moved back into the green with a gain of 1.5%, and it's a stellar debut for Shiprocket. The IPO price was 97, and I think the stock is holding up with a gain in excess of close to about 130 rupees. This is a logistics fulfillment platform, but it does not own trucks, it does not own delivery. What it basically does, it connects the online seller to a Blue Dart, to a delivery, to a DHL. So it acts as the middle person. So it's got an extremely asset-light business, and the stock has opened up pretty well. Get into a break. On the other side, Lata will speak to Nikhil Gupta of CLSA on India's slowing income growth.
Welcome to It's the Economy. India's personal income, or rather wages, are growing very slowly. In fact, the growth has slowed in FY26 and in the first quarter of FY27. This is the conclusion of a study done by CLSA. Now, India's Ministry of Statistics, MOSPI, doesn't give personal income figures very quickly. The GDP data only gives you quarterly consumption growth. But the personal income figures come annually and with a lag of 1 year. So as of now, we do not have the official personal income data for FY26 and of course not for Q1 FY27 either. How has CLSA calculated the income figures for FY26? Well, they have taken the agricultural wages, the data is available, non-agricultural rural wages data, that's available, MNREGA wages, and they have taken salary bills of state governments and of listed companies and then created a proxy for personal income, which they find has slowed sharply in FY26 and in the first quarter of this year, that is as of June 2026. To understand more, we have the author of the report, Nikhil Gupta, the India economist at CLSA. Morning, Nikhil. Thank you very much for your time. Well, this actually flies in the face of the government constantly telling us that we are the fastest growing large economy. So can you explain your hypothesis?
Good morning, Lata. Lata, so you're right. What we have done, our analysis suggests that the 5 indicators you mentioned, of these 3 indicators, which actually are a proxy for rural income growth, as well as self-employed and casual workers, which together account for almost 75% of India's workforce. We have seen a sharp deceleration in their real income growth in the first quarter, that is June 26 quarter. So as you mentioned again, labor wages or agricultural wages and non-agri rural wages is available on a monthly basis. And although we saw good growth in these data points in FY26, which was the highest in almost a decade, we have seen a sharp deceleration in 1Q. In fact, NREGA, which is actually now replaced by the new scheme or the revamped scheme, VBGR Ramji, beginning July 2026, we saw a decline in their wages as well in the June quarter. And in July, under the new scheme or the revamped scheme, we have seen a decline continuing. As far as the regular wage salaried employed proxy is concerned, which is where we look at listed company salary bills and state government employee costs, we have still seen some growth in real terms, but it is nothing very exceptional. It's better than the growth in the other indicators. But what overall it suggests to our mind is that 1Q FY27, we saw slower income growth. As far as GDP growth is
concerned. And also in FY26 or only in 27, you're saying there is this problem?
So FY26, real income growth was better, but income growth was still lagging consumption growth. See, the problem is, even for individuals like you and me, it is true that if our consumption growth continues to outpace income growth, it is possible only and only if we are withdrawing our savings and or if we are taking more leverage. That is exactly what is happening on the aggregate basis for the entire household sector in the country as well. It is okay if it happens for a couple of years, for a few years, but what our analysis suggests is that for the first time in the post-independent India, if you look at the past 7 decades data, for the first time, income growth lagged consumption growth in the pre-pandemic decade. So this is not something which is very recent. Even in the pre-pandemic decade, we saw income growth lagging consumption growth. We saw some change in the years running up to this COVID pandemic. But then in the last 5 consecutive years, we have seen income growth lagging consumption growth again. So FY26, we saw real income growth improving, but real consumption growth also improved. And consumption growth was again outpacing income growth in FY26. We believe that to be the case in 1Q FY27 as well.
Okay, so Indians are taking more loans to consume. That's why their consumption is growing faster than their income is growing. But you know, can we show the GNPA data? I just gave that to the team. If you look at the gross NPA data, it is actually improving. So and it is improved very rapidly. You know, FY 17, 18, 19, we were at 7% gross NPAs and then it came to 5.6. Now it is as low as 1.4%. for FY25 and 1.8. It's gone up a little bit in FY26. So if people are taking more loans to consume, they are also able to repay. No, so why should we worry?
Right. So, Lata, there is no conclusion that we are making that if income growth is picking up at a faster pace, we will immediately see any deterioration in asset quality for banking sector. See, again, from the aggregate basis, what our analysis suggests, and this is something that we had done in the previous reports, India's household debt to income ratio, to PDI ratio, is close to 58-59% as of end FY26. As percent of GDP, it is close to 46%. Now, what matters? It's not household debt to income or GDP ratio, as you rightly pointed out. What matters is the debt service ratio or the ability of the borrowers to repay these loans. When we look at that ratio, we find that on an average, a typical household in India spends about 13% of their annual income to service those debt, right? Including the interest and principal repayments. Now, 13% of your annual income is used to service this debt. It means only 87% of your income is available to consume and save. If your income growth does not pick up, but this debt service ratio, which has picked up in the past decade, it means you'll have to make a choice between your spending and saving. So far, as we know that savings have fallen vis-a-vis where it was a decade ago, we know that consumers or household sector on an aggregate has chosen spending, which partly they are supporting by withdrawing savings and partly by taking more leverage. But the fact that debt service ratio is going up, the fact that income growth is not picking up, and if we look at the composition of household debt, the share of non-mortgage debt is much higher. All these facts come together tells me that this is not a sustainable model. Now, I'm not saying this is going to lead to lower GDP growth in the next quarter or a couple of quarters down the line. It may take some years, but this is something which is not sustainable if you think few years down the road.
Okay, we discussed a previous paper of yours on this higher debt servicing. That's why, I was prepared, I was aware of that argument. I even looked up the CIBIL scores. And I've not given that data on air because I just looked it up. The CIBIL data is actually showing that India's CIBIL score is improving. The average CIBIL score in 24 and 25 was 715 and 720. In March 2026, it has risen to 728. And likewise, if you looked at even the CRIF, the CRIF data, in many parts it is improved. Of course, over there, small ticket loans have shown genuine distress. There, the amount of repayment is falling. The GNPA has risen to 6.4 compared to 5.3 last year. But there again, CRIF says that is only for people under 30. New to credit borrowers. So the overall repayment data for the past 3-4 years is actually improving. Microfinance was a problem. That has also improved last year. So I am with you. I also sympathize MNRE GA wages should not fall. Agricultural and non-agricultural rural wages should not fall. It is very painful to hear that. But it is not impacting as yet. Even consumption growth, I picked up Marico, I picked up Dabur, Hindustan Unilever. All their volume growth, not value, volume growth has improved in Q1. So it's not showing up, is my point.
I agree with you, Lata. I do not have anything to contradict. It is not showing up as of now in any of these data. But again, when you look at what is driving household debt growth, is it the same people which we call credit widening vis-a-vis credit deepening, the same people taking more loans or new people taking more loans? For the first time in almost a decade for which we have this data from the RBI, using some proxy for credit widening, we found that for the first time, it's the same people taking more data.
Yes.
It is also reflected in RBI's FSR reports, which tells us that the number of or the share of borrowers who have 3 more live loans is increasing. So all these things, again, these things take time to show up in aggregates. Probably if these things continue, if income growth does not pick up over the next few years, then I'm saying this is something that may play out over the next few years, not necessarily in the next few quarters or the next.
No, fair point. Actually, I think the Reserve Bank's move to stop revolving credit also is on that line, that they probably think some people are over borrowing. And I take your point that the FSR did alert that the number of people taking multiple loans has increased. The MFI correction also happened because of that. Microfinance guys were taking more loans than they could repay. Okay, now that I have you with us, just one word on the current year and the current quarter GDP and inflation number. The crude oil problem is not going away. So are you revising up your inflation number? I'll come to GDP in a minute.
No. So our inflation numbers, which were published last, was on the basis of $90 crude oil for the entire year. And it came down, but now it is again around $90. So we are not revising or changing our inflation forecast.
And you all are at 5, like the RBI?
For the full year, around 5, but it would peak at around 6% for December quarter. And from there on, it will start coming down.
Okay. And since I have you again, GDP number for the current quarter and the year?
For the current quarter, we are slightly probably above 7%.
That is, I'm sorry, April, May, June,
June
right?
quarter.
Yeah, June quarter, slightly above 7.
Yes, but for the second half, we believe that growth could be 5.5% or so. Now, there are 4 reasons which I want to mention why we believe such sharp deceleration in second half. First, we all know there will be base effect. We saw GST rationalization in September 25, which led to lower inflation and better growth till about September, October 26, after which we will see the base effect reversing. Second, I think we are still not broadly, the consensus is still not factoring in the adverse impact that could be there because of El Nino. We are not saying the adverse impact will be as bad as it was a decade or 2 decades ago, but not expecting or not factoring in an adverse impact, I think, is too much optimism. Third, we believe there could be some restriction from the fiscal side. I think the government would still want to keep their fiscal deficit as much close to the target. With revised GDP and Q1 numbers, it is very likely that we will see lower growth or some decline in their spending in the second half. And lastly, on the private consumption part, again, the government shielded the consumers as much as possible by taking a hit on their revenue by cutting excise duty. And the companies did not pass on the entire fuel price hike to consumers. I think as we progress into this year, next year, we will see some impact of that, the indirect impact or second order effect building into inflation, and thus there may be some adverse impact on consumption growth as well. Okay. When we put all that together, we believe that the full year, it could be closer to 6%, which means second half, probably around 5.5%.
Okay, I think that's one of the most dire predictions, 6%. Everybody is above 6.5%, and I'm still with 7%. Thank you very much, Nikhil, for that very interesting and less discussed data on falling rate of growth of Indian incomes. Have to wrap up on Bazar on that note. Chartbusters after the break.
It's a weak start for the Indian markets. At crude, prices hold firm around the $91 per barrel mark on the continued standoff between Iran and the United States over the Strait of Hormuz. The Nifty gives up 24,100 as all sectors except IT and FMCG trade with cuts. The broader market falls in line with key indices.
The government plans for a high allocation of PNG to city gas distributors for domestic use as it looks to meet the rising household demand. Stocks surge across the board.
Crude prices hold firm above $91 a barrel as US and Iran standoff over the Strait of Hormuz shows no sign of easing. Stocks of OMCs, paint companies and aviation dip while refiners surge on global capacity shutdowns and higher refining margins.
EMS rallies 5% after it is declared the highest bidder for projects worth 42 crores. Railtel is surging on an order win worth around 170 crores from the EPFO.
An end-to-end logistics platform, Shiprocket, lists with a premium of nearly 40% to its issue price of 97 rupees a share. The management joins us shortly to discuss the company's post-listing growth strategy and outlook going forward.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel and with me is Vinny. Hey Vinny, good to have you on the show. You seem to be matching with the color on the screen today. It seems to be red. Crude oil prices have spiked. Overnight, the cues that we got on the geopolitical front are not very, very good. It explains why our market's a little bit low.
Absolutely explains why our markets are a little bit lower. Nigel, good morning to you as well. And obviously Nifty trading with cuts of almost 100 points. Broader end of the market not doing anything exciting as well in the trading session. Nifty Bank is down 0.3%. So we're seeing a decline coming in across the markets, and especially now the Nifty is trading at the day's lowest point. Will be key to watch out for whether we manage to hold on to that 24,000 level in the trading session. But today what we're seeing, some bit of a positive or a green is only coming in from IT. Pharma, just a mild green there. But apart from that, nothing exciting happening in any of these sectors. A lot of individual movers in trade that continue to do well. But yes, that's what we're seeing and keeping an eye out on in terms of the market today. But let's also welcome on board now Dharmesh Shah of ICICI Securities for a technical check for the market. Dharmesh, good morning. Thank you so much for joining us on the show. We're just holding on to the 24,000 level. If we go below that today, then what are the levels we're keeping an eye out on? And if we manage to hold on to 24,000, then what should we watch out for in terms of levels?
Yeah, so good morning, Vinny. Absolutely, I think so. The market started on a very weak note, I would say, on the back of crude oil prices going above 90. But what we believe, I think so, if you look at the structure of the Nifty since April, I think so, market has been forming the higher bottoms. Previous bottoms were around 22,100, 24,500, 22,500, 23,500, 23,600. And then recent current bottom seems to be forming in this range of 23,800 to 23,900. Because if you look at the joining the lows of this April and May, the trend line value is placed at around 23,800 to 23,900. They expect market to see some bit of a higher bottom formation. Today being a 12th day of a lower high, lower low formation, none of that is Nifty managed to close about the previous day high. But if you look just from the statistical perspective, I think so, since there has been 2 to 3 instances since April, since 2025, where the Nifty has done such type of a behavior, that 11 to 12 consecutive sessions of a negative closing, post moving into the oversold territory. And once we see the Nifty closing above the previous session high, we have seen a gradual recovery around 3 to 4% in Nifty. So we believe, I think so, Nifty should find support in this range of 23,800 to 900, forming higher bottom. And we should be going and retesting the 24,500, 24,600, which is again the upper band of the channel. So yes, things are not right now so lucrative to go for the buy, but it looks like I think the market should see some bit of a higher bottom, and we should see a gradual recovery in the next week.
Dharmesh, any stocks that you're looking at this morning as well?
As far as stocks recommendations are concerned, yes, definitely we going to be constructive, positive for real estate space as a whole. If you look at the real estate index has been consolidating on the daily chart for a long period of time. Expecting a breakout for the real estate index. But again, inside the real estate space, BLF remains to be our top pick. Again, for BLF, if you look at the chart from the weekly perspective, I think so, more of a consolidation for last 8 weeks. which seems to be on the verge of a breakout, with slower pace of retracement and more of a base formation above 52-week EMA looks good from a trading perspective. So DLF is one which we like from the medium term perspective with a target of 732, keeping a stop loss of 649. Apart from DLF, again on the banking side, Ujjivan Small Finance Bank is something one which we like. Again, the stock seems to be forming a top and middle formation breakout. Again, a 7 years of multi-year long consolidation breakout as witnessed in Ujjivan. So Ujjivan again looks more positive for target from 81, hitting a stop loss of 67. So DLF and Ujjivan Small Finance range we are talking.
Okay, Dharmesh, thank you so much for that. That's the update coming in on the technical front, individual stock names as well. But Nigel, we do have a bumper listing that's coming today as well, and that's from Shiprocket, the end-to-end logistic platform. Good listing there.
Well, that's right. Let's get straight to it. Then the end-to-end logistics platform, Shiprocket, has made a rocket start today, listing it again at more than 40%. We have with us Sahil Goel, the MD and CEO at Shiprocket, as well as Tanmay Kumar, the CFO at Shiprocket, who joins in on the show. Hi, Sahil and Tanmay. Congratulations. What a rocket of a listing. Fantastic stuff, guys. The journey is just starting, but it's always good to get off the mark in style. So congratulations. Now, the last time around, we had you all in the studio. You all didn't give us numbers, and we let you all go because your banker as well needs to be happy. This time around, it's going to be a little bit different. Tell us, what kind of growth are you looking at? Tell us how you expect the business to evolve between the core and the emerging segment as well. And what is profitability going to look like? Any one of you could go for it.
I think first, we're very excited, obviously, to be here today, and having received nearly 100 times oversubscription is just a testament to shareholders who are wanting to be part of our mission. And I want to thank everybody for that. We're also very excited with all the kind of potential that lies ahead of us, where there's over 6 crore small businesses in India, and we've just touched like 0.5%, less than 0.5%. So I think that's to us the main excitement of today, and the belief that India has shown in our mission and in our company. Yeah, Tanmay, do you want to add something?
No, very, very excited. At the same time, we see the responsibility on our shoulders. So the opportunity, like Sahil said, is immense, but we couldn't have been more excited with what's lying ahead in terms of whether the number of offerings that we could do, as well as the team's commitment and excitement.
Tanmay, sorry to come in over here. Sahil's excitement is super. The way you're putting it as well is super, but you're giving us the pre-listing answers. Now we want the post-listing answers, right? So last year you did around 2,000 crores. Let me give you the numbers. You did 2,000 crores of revenue. On that sort of a base, what can growth look like? And will you be net profit in this year itself? Will it be, will you move into the black? As simple as that. We appreciate the business. You'll have put in a lot of hard work as well, and it's been a phenomenal journey. But now, the numbers. Tanmay, take over.
So let me just answer this from a little longer term view. If you think about our business, where last time we met, we discussed that it is a completely asset-light business, a business where we work with a central team, which is technology, product team, and a support team. Essentially, every piece of revenue growth that we see will keep adding to the bottom line. We are not, folks, we are not just looking at this 2 lakh base or a 6 crore vision, but our aim over the next 5 years to get to $1 million plus MSMEs, and that is the number that we want you to. We want to tell you that we are all committed for, and we want to go for.
Tanmay, get 1 million plus customers you want to get into, MSMEs that you want to look at. You said every time you add some bit of a revenue, the profitability comes in as well. I want to understand at what revenue will we see the profitability come in? Is that an internal target that you all have kept as well?
Of course. So, our aim is to continue to deliver on profitability very clearly. And while I can't give you a specific number, but, rest assured that we not only are committed to growing the top line, but we understand that the shareholders look for value creation, and that is going to come from both sides, not just from the top line, but as well as bottom line. So that is going to remain focus. This morning we were addressing our team on the listing, and one of the things that we said was that we will stay true to a couple of things, right? We said that we will continue on sustainable growth. We said that we will continue to be ruthlessly frugal, and we said that we are going to be absolutely transparent, and we're going to stay true to that. That's what I want to tell.
Okay.
Everyone who's watching this.
Absolutely. Point taken there. Sal, I'm going to come to you and understand more in terms of the emerging side of the business as well, right? Emerging as of now obviously accounts around 27 to 30% of the business and revenue. From here on, how do you see that moving, and how do you see that growing in terms of the mix? Maybe in the next couple of years, what is the mix versus core and emerging?
See, I think the emerging business is essentially problems that merchants have upstream on the same order, right? So the same order we helped ship, now we're able to run ads, we're able to power payments and checkout, and are able to power fulfillment and fast shipping, right, on the same thing. So I think it's the fact that its same transaction is able to get monetized multiple times has led to this very rapid growth of the emerging business, which was 41% on 25 and then 65% in 26. So clearly the inflection on growth on emerging is painting a trend. And I think that as merchants start to use more and more of the product suite, automatically you'll see like a deeper penetration over a period of time, because it's just normal for merchants to want to get help across the stack. So while I don't want to put a number in terms of like what percentage it will become, I think the trajectory is there, and just sort of logically speaking, we are seeing great amounts of cross-sell between the core and emerging businesses. And like I said, if you think about it, it's the same order, it's the same transaction, just being monetized multiple times for multiple problems that our platform is able to solve.
When will this turn EBITDA positive then?
So I think Tanmay already answered that. I mean, we are adjusted EBITDA positive as of 25 and 26. So I think, yeah, I mean, that's already happened.
All right. And that million, users that are talking about, currently, what is it? It's around 3 lakh?
2 lakh 14.
2 lakh 14. All right. Got it. I just wanted a like-to-like number as well, gentlemen. We appreciate you all joining in and speaking to us here on CNBC TV 18. Wish you all well. Today's a day to celebrate, pop the champagne, have a good day, celebrate with the team as well. But we request you to join back, when you report, say, one of your results, and then we could get further details as well. For the time being, enjoy it and celebrate.
Thank you.
Thank you so much.
Okay. All right. Well, that's the Shiprocket listing, 40% higher. For the time being, though, we slip into a short break, come back. We continue to focus on markets and stocks that are bobbing around. Stay tuned.
Welcome back to Chartbusters on CNBC TV 18. A few point uptick from the day's lowest point is what we're seeing for the Nifty, but nothing sustainable seems like it as of now. 24,050 is what the Nifty 50 is holding on to. But let's move on and shift focus to the IT pack. CLSA has issued a note on the IT sector, expecting mid-cap IT companies to better navigate the technology transition versus large-cap ITs. Let's go across to Rima to give us a lowdown on that. Rima?
Thanks so much for that. So CLS's main point is that this technology transition is going to create winners and losers. And the winners are going to be the mid-cap IT companies better positioned to navigate it. They're better placed to take advantage of the changes, stronger management, execution, and the ability to pivot faster, which is why CLSA maintains a high conviction outperform on both Persistent and Coforge, and they've got an outperform rating on Hexaware and LTIMindtree. But for large caps, they say the picture is tougher. They are dealing with AI-led deflation in their legacy business, and plus there are macro headwinds. One of the key takeaways is, and by the way, for the large caps, they've also downgraded a TCS, Infosys, Tech Mahindra to a hold, while Wipro and Mphasis have been downgraded to an underperform. But I think this part is the most important part of what CLSA has to say. I think everyone's dealing with the question is about this AI inflation. When will the net benefit from AI offset the net loss on account of AI? And CLSA's view is that AI volumes could supersede the deflationary impact by FY30 only by FY30, which basically means the industry could be stuck in a period of subdued growth before AI volumes are large enough to offset the revenue deflation. Remember, FY24, 25, 26, FY27, they all have been low growth years for the companies, and now CLSA is saying that this could extend till FY30. Look at the numbers now. And for the first time, we have a brokerage calling out the kind of AI revenue contribution. So currently, for the large cap IT companies, AI is about 6 to 10% of their AI revenues, of the total revenues. According to CLSA, this goes up to 30-35% by FY31 in the next 4 or 5 years. And only when that happens will the revenue growth for the large cap IT companies expand from low single digits, from a 1.9%, a 2%, it will go up to mid single digits. So basically, double-digit growth rate is not in the picture. So the message is very clear. The opportunity is real, but the gestation period is going to be very long. The industry will have to wait till at least FY30 as it moves from low single digit to mid single digit kind of a revenue growth. Valuations, they say, are fairly it's balanced. Risk reward is favorable. There are 3 structural headwinds though. One is GCC. They're not gaining market share over global peers, and services are losing out to hardware and software companies on account of the global AI rollout. And finally, let me leave you with the ratings and the target price put forth by CLSA on the individual companies.
Got it. All right, Rima, thanks a lot for running us through that piece. For the time being, though, we slip into a short break. You come back, we'll tell you about some more stocks that are moving around. Stay with us. Welcome back. Well, let's shift focus to our special segment then, where we get you a few ideas for profit from Money Control Pro. Today we have Jitendra Gupta, who joins us to help us out with a stock that he's tracking very, very closely. Jitendra, take it away.
Hi, thanks. We think Power Grid, India's leading power transmission company, offers good value. The management has maintained a healthy growth outlook with execution improving, strong work in hand, robust project pipeline, tests, good earnings visibility. Moreover, it is well placed to benefit from the multi-year transmission investment cycle. In Q1, the company maintained a good, strong execution momentum. It commissioned almost 1,600 circuit kilometer of transmission lines. Q1 capitalization jumped almost to 5,277 crore from 1,683 crore compared to previous quarter, which is again one of the point that execution was better. Revenue grew almost 3% on a year-on-year basis. Looking ahead, Power Grid has maintained a good 37,000 crore FY27 capex guidance, and of course 30,000 crore of capitalization target. Work in hand remains strong at 1.8 lakh crore, while bidding pipeline is around 1.2 lakh crore. Beyond the existing pipelines, management see over 15 lakh crore of long-term transmission opportunities, renewables integration, pumped storage projects, rising electricity power demand, and those things should support overall opportunity. Battery energy storage could be another growth avenue. Overall, at around 16 times, it is trading at 16 times. We on the FY28 estimated earnings stock offers almost 4% dividend yield. We like Power Grid at this price.
Okay, thank you so much for that, Jitendra. But in terms of the markets, few more points higher from where we started the show, right? 24,060 now is where the Nifty is at. So not much of an up move there. But let's see whether this recovery or an up move continues through the day, or whether we see and break the 24,000 level will be key to watch out for from here on. And apart from that, IT is something that continues to hold on to that green in the trading session as well. But yes, with that, we're absolutely out of time on this edition of Chartbusters. Thank you so much for tuning in. Up next, you have Trading Hour.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Patakia. With me today, Sonal Bhutra. Sonal, good morning. Another day of losses for the markets.
Losses continue. Seems like markets cannot catch a breath at all. And it's the geopolitical tensions that continue to be hovering over the markets as well. Crude oil prices are higher. That is the biggest worry for Indian markets for now. The Nifty at the day's low, it's a 0.4% loss today. Remember, we broke that 24,200 mark yesterday. Today, we are closer to that 24,000 mark. That continues to be the next important level we'll be tracking very closely. As far as sectoral moves are concerned, it's the Nifty IT, which is trying to bat it for the bulls, but has been quite volatile. FMCG continues to be under quite a bit of pressure. IT has come off from the highs of the day, which is putting pressure on the Nifty as we speak. A lot of moving parts in the broader markets and the Nifty pack as well. If we talk about some of them for now, in terms of the top gainers or the losers on the Nifty, Eternal is the one which is on our radar for now. Not major gains there, but yes, there is some sort of green on that screen. And of course, we'll talk about individual names in just a bit. So let's do that actually. Let's go across to Hormuz. He's at the big wall with all the movers in the market as we speak. Hormuz, tell us more.
7 days of losses now for the index, and as you just mentioned, they just cannot catch a break from the losses now. So well over 500 points now is what the index has declined over the last 7 sessions. And now the important level to watch on the downside is going to be 24,000. That's going to be the most important level. As of now, the difference between the spot and the futures price is somewhere around about 60 odd points. The 100-point down on the Nifty near the lowest point of the day. And so this sandwiched session between the two expiries generally turns out to be the trending one. The bulls would be hoping that there is some support that emerges at that 24,000 mark, and there is some buying that emerges from those lower levels. Similar is the case with the Nifty Bank as well. The Nifty Bank has had a trend over the last 7 to 10 sessions. Every time it has moved towards that 57,000 zone, in this 57,000 to 58,000 range, it has seen buying interest. Today is no different. Today too, it tested 57,000 in the first 10 minutes of the trading session, then saw buying interest, but then the recovery has been sold into yet again. So it'll be interesting to see whether this 57,000 level sustains by the time we close today's trading session. But while the markets are struggling, the new listings, the IPO market is in a completely different world of its own. Look at the listings today. Shiprocket is up 43% from its issue price, and Bihari Lal Engineering has almost doubled from its issue price, not necessarily doubled, but 76% higher now. It's the second best listing that we have had in 2026 after Bharat Coking Coal, which had almost gained close to 100% as well on its listing day. So very, very strong listings that we have seen in today's session. Look at the city gas distributors as well. They opened higher. They have come off slightly, but still holding on to gains of anywhere between 2.5% to 4%. IGL, MGL, Adani Total Gas, all of them doing well in today's session. The other big headwind that the markets are bothered about is the fact that oil prices are rising, but there are specific stocks that are benefiting from it. Chennai Petro, of course, 5.5% higher, a record high for the stock, and the sugar names as well who are doing well. Dhampur Sugar is up 4, Dwarikesh is now up 8% as we speak. Take a look at the newsmakers then. Zaggle was down 20% after its results. There's some buying seen from Vijay Kedia earlier, and that too has resulted in the stock moving 10% higher. Prism Johnson after the order win is up 6%, and Nelco extending its losses from yesterday's fall. Look at the stocks that have won orders today. Multiple stocks that are reacting to that. EMS, 8G Infra, Railtel, all of them gaining between 4 to 7%. And lastly, even in a market like this, there are stocks that are at record high levels. Tourism Finance is one of them. Bliss GVS Pharma is in a 5% circuit. And Karnataka Bank too continues to move from strength to strength. A record high for this one as well, Sonal.
Okay, Hormuz, a neat summary of all the stocks which are buzzing in trade, maybe on the upside or downside. That's about the secondary market action. We have to talk about primary market as well. Gaja Alternative Asset Management initial public offering opens for subscription today. The asset manager is looking to raise 550 crore rupees. The 3-day bidding process closes on August 21st. The IPO comprises of a fresh issue of shares worth 450 crore rupees and an offer for sale of around 100 crore rupees with a price band set at 152 to 160 rupees per share. We are now joined by the MD and CEO Gopal Jain to understand and break down this IPO for us and to talk about some future opportunities as well. Mr. Jain, thank you so much for joining us in the studios today. Usually have market conversations, but let's try and understand this business better for the viewers as well. First up, if briefly, you can tell us what are the income streams that make up the total revenue of the company and what is the breakup there as well in terms of percentage?
So we are a fund manager. At one level, a very simple business. The market is familiar with fund managers, AMCs. So far, market's familiar with AMCs that are fund managers for mutual funds. We are an AMC that's a fund manager for alternative funds. And in addition to management fee, we also have performance fee. What is performance fee? It's a share of the profits. It is also a gain from sponsor commitment, which is a regulatory requirement. In our case, we've gone way beyond the regulatory requirement. So it's at one level a very simple business. The novelty is the alternative part. We are arguably the first alternative AMC to go public. There are multiple income streams, and it's a long-term business. Our capital is typically locked in, so we have predictability for the future. And this is a 22-year-old business. The entity which is going public is profitable, dividend-paying. It's a 27-year-old entity.
Okay, so just since you said different income streams, there's co-management fees, there's carried interest, and as you said, income from sponsor commitment as well. If I talk about the carried interest, that has seen a strong growth in last 3 years, just ahead of the IPO as well. Is this something which could be volatile because it depends on exits, it depends on the performance? And did you see a lot of these exits happen just before the IPO? How would it work going forward?
So if you see the global playbook, as firms mature, the performance fee rises. And if you're earning economics from multiple funds, then it tends to smoothen out, which is one reason why we've taken over 20 years to partner with the public. So it's a sign of maturity. It's a sign that some of the earlier funds are in a place where they can pay carried interest, because carried interest, share of profits, is back-ended. It's not deal-by-deal basis. Once a fund comes into the territory of carried interest, then every realization gives you carried interest. And that is the stage at which we are going public, where our funds have matured.
So this will continue. This is a performance which would continue. Does it really depend on future exits immediately?
Well, I shouldn't be making forward-looking statements. But
just for understanding,
yes,
qualitatively.
Yes, sponsor commitment, gains on sponsor commitment do not depend on future exits. As far as carried interest is concerned, we are very conservative. So these depend on realizations. But sometimes the realizations are from companies that have already gone public. So it's not about liquidity events, it's about liquidation.
Mr. Jain, since you are an alternative asset manager, you've earned a significantly higher management fee compared to your MF mutual fund peers. But compared to FY24, when your management fees as a percentage of revenue has now come down to 44% in FY26 from 79% earlier, is it because of the fact that other revenue streams have started to grow further?
Indeed.
Or is it because of the fact that the segment in itself is witnessing a bit of a slowdown?
No, it's the latter. Our denominator has grown. The denominator has grown because now we have performance fee. Actually, we don't earn a lot more management fee than mutual fund AMCs. Mutual fund AMCs have a lower fee, but they charge it on NAV. We have a higher fee, but we charge it on committed capital. In the alternatives business, at the AMC level, at the fund manager level, the real play is around performance fee. And as that starts to come in, that's when the business starts to accrete value. And you can see that in the last 2 years, our net worth has grown from 330 crores to 600 crores on the back of rich profitability. We had 82 crores of profit last year. Year before that, we had 62 crores of profit. Year before that, we had 45 crores of profit. I mean, this is a bootstrapped, self-driven business until last year. And that shows you how profitability is cascading upwards.
Mr. Jain, I wanted to understand this 450 crore rupees of fresh issue. How do you break it up? There's some bridge loan, there's general corporate purposes.
Right.
What are general corporate purposes for a company like
I'll take a step back. Take our current net worth. We have 600 crores. The bulk of it is deployed in our own funds. For a fund manager to put money in its own funds and alternatives, it's called skin in the game. We have a big chapter on it in the RHP, is a regulatory requirement. What we've done is we've gone beyond that and we've subscribed to global benchmarks, global best practices. We are at an average of 6.4%. Our last fund was 8.5%. We want to take it up to 10%. So the bulk of the fresh capital basically goes into helping us build a platform, putting in sponsor commitment in existing new funds of the flagship strategy and new strategies. The bridge loan part is a small part, but most of it is directly going because we have negligible leverage, but we are going to pay down that leverage.
How much is that?
Please don't hold me to a number right now. So what I'm saying is that 80% is going into funds as sponsor commitment in line with what we've done in the past.
Okay, so are these for deals which are already, discussed upon, or is it for fund which possibly will see some deals?
So it's a great question because it helps me clarify. The AMC does not invest in companies.
No,
the
yes,
AMC
of course.
invest in funds,
Right.
right?
So,
the
have you
funds-
had these conversations with funds already?
Right. So our funds invest in companies. And if you see, our funds have been investing at a very regular clip. There's a lot of transparency. Maybe I should, our last known investment was in an AI foundational model company. I think you guys covered it.
Yeah.
Before that, we invested in a healthy cookware company. So we have been investing for so many years. We continue to invest. And whenever there is an investment, there is a drawdown. And the drawdown is both from the GP, the fund manager, Gaja Alternative AMC, and the limited partners investors, right? So yes, this is all going into funds, all going in turn into companies. But the funds give us carried interest, they give us management fee, and they give us undiluted multiple on invested capital because the manager does not pay fee and carry.
And that remaining general corporate purposes, what is that used? So that's 25% of your overall capital raise.
It's if you see currently, I think close to 30% of our balance sheet is cash, and we hold it to grow the firm, which is essentially infrastructure. We have operations outside of India. I mean, I don't want to make statements that could sound like they're speculative, but we have a real opportunity to keep building this into a large global business. We should also talk about our anchor. Right? We've done the anchor yesterday. I think it's a big step. I think our bankers have done a fabulous job. 82% of the anchor has gone to long-term investors, 65% to mutual funds, 17% to insurance companies. And then there are marquee domestic investors and a foreign institutional investor. This, along with the pre-IPO we did, are two solid institutional rounds driven by pedigreed investors.
A couple of questions, Mr. Jain. Firstly, operating cash flows were negative this time around, despite your profitability going up. That's one. Does that stabilize or improve, turn positive?
So in the case of a finance company, in the case of an investment company, even if we open a fixed deposit, that's debited from our cash flow.
Okay, so that is what that is. Okay, but won't fixed deposit come under operations from financing? Investments, sorry. That is what, it's the operations that are negative.
So it goes into creating assets, and therefore it shows up as negative cash flow. If you add back the investing activity, it becomes positive.
Okay.
What about the loss ratios, Mr. Jain? Your fund 2, 3, and 4, they had loss ratios of 13.8, 19.1, and 6%. Now, how have they evolved over the last 3 years, and how, especially considering the recent exits?
I think for what we do, we invest in mid-market growth stage companies. That's been our strategy consistently. I think a loss ratio of below 20% will be the stage. So unlike venture capital funds that have success ratios of 20%, growth stage funds have loss ratios of 20%. And I think that's the general considered global norm, that 80% of the investments should give you some or good returns.
Do they remain stable at these levels going forward as well?
And it's a forward statement. As long as we keep our head down and keep working hard, they will.
Okay, I wanted to understand this. For a company like yourself, what would receivables mean? Because you can understand that for a manufacturing company. I'm trying to understand it for you. And it is to other associates, or I would say related parties, right? What does it mean for you?
So first of all, the funds become related parties.
Correct.
They are managed by us.
Correct.
The receivables are from our funds only.
Okay.
Right. So we don't necessarily draw down capital to pay ourselves fee, etc.
Okay.
So, we just wait, but the fee is payable. We've never had a LP default in 20 years of our work.
So increasing of receivables means exactly?
Receivables for the manager from the fund entity.
Got it.
And unlike a mutual fund which has a corpus, private equity funds work on drawdowns. Right?
So this distinction was important to understand as well. Going through your RHP as well, it was quite a detailed one, I have to tell you. But one of the members of the promoter group has not provided the consent to be identified as a member of the promoter group. What does that mean? Why is that?
Well, whatever disclosures we had to make have been made there. I think we reach out to all members. Some members respond and some don't. I mean, it's not a member that has ever been part of the management or been part of the board or been part of the shareholder entity. But I think these things are fairly normal, and we've handled that through disclosure.
One final question from mine, Mr. Jain. The RSP is also mentioning about an audit trail, which was unavailable from the 1st of April last year to the 27th of August and in the earlier years. Did the auditors find any accounting record changes, and what should you make? What should investors make of this?
So you will see that it also has a note that since then we have upgraded the software, and now the software has the audit trail. So it was a question of upgrading the software, which we have. And
so now it's available.
Yeah, now it's available. So they made a note that, listen, you need to upgrade your software, and we did it. I mean, this is a negligible leverage, cash-rich business in which the manager, the only business the manager does is with the entities it manages. And then it has balance sheet investments to manage its cash. So in that sense, again, I'll say there's a novelty factor, which requires us to spend some time understanding it. But at its heart, it's a simple business, and we have followed a proven global playbook.
Okay, that's exactly, we were trying to understand this particular business. So last question then. Some of the fees or the breakup of the revenue could be volatile, as we said earlier, but you've done well in last 3 years. Is this a performance you expect to continue? No numbers, but qualitatively, if you can tell us.
No, I think that's a question we got through right through the pre-IPO process and through the anchor process. And you can see that a whole bunch of highly disciplined, pedigreed investors have come into the business, and they have satisfied themselves, I assume, that actually the going in, your first question obviously is this volatile? But for a 22-year-old business, earning economics from multiple funds at varying levels of maturity, where the assets are very well known, we believe we are a highly modelable and predictable business.
Pleasure having you today, Mr. Jain. Thank you so much for joining us. Wish you good luck for the IPO and looking forward to some forward-looking statements during the day of your listing. Thank you so much for joining us. The management of Gacha Alternative, they are the IPO opening for subscription today. Take a short break. On the other side, Ramneek Saigal of Seagull India joins in to discuss their JV with Sushi Infra and, of course, the road ahead. Stay tuned. Welcome back. We're now being joined by the management of Seagull India, Ramneek Sehgal. Recently, the Delhi PWD has cancelled the company's L1 bidder status on select projects, including contracts worth over 330 crore. Meanwhile, its joint venture with Sushi Infra Mining has secured 4 letters of award from the Ministry of Road Transport and Highways for Arunachal Pradesh projects worth close to 2150 crores as well. We'll talk about all of this. Mr. Sehgal, good morning. Thank you for taking out time. Firstly, tell us about the order cancellations before we get to your JV and the Arunachal projects. What led to these cancellations, and what has been your response to this, to the Delhi PWD?
So first of all, thank you so much for having me over. So in Delhi PWD, the contract was for 280 plus GST. We were L1. The Delhi government, CPWD, qualified us. Then they opened a financial bid. Then we got to know they have cancelled the contract and they have gone in for rebidding. So that happened 2 days back. The good news is we have been allotted projects worth 2,423 crores, which is almost more than 7x of what has been cancelled. And, we have a robust order book, which is more than 18,000 crore. And besides that, another 2 projects where we are L1 for another 1,000 crore. So, our visibility of order book is huge. I mean, we did a revenue of about 4,000 crore. It's almost 5x and one of the best in the industry. So, this was a small order, which we anticipated that it will be allotted, but I know they've taken the call and they have gone for rebidding.
But have they told you what was the reason? It's around 330 crore rupees of an order. So there could be some reason why it has gone for rebidding. Any conversation from them? And are you trying to sort that out to bid for it again?
So first of all, we were on the website. It's shown that we are L1 and there were only 2 bids who got qualified. And then we thought they are taking time to allot. But there was like we just got to know 2 days back that they have cancelled the bid and they have gone for a revaluation, rebidding again. And our legal team is looking into the process and they will do as per the requirement of the contract. They might write it to them also. But still, it is a very small bid for us. And as I said, we've been allotted another projects worth 2,423 crores since the last 2 days, which is very high for us,
Mr. Sehgal, now moving to your projects in Arunachal, the JV that you have signed, what's your scope, share in the joint venture? Tell us more about those projects.
So our share is, we are the major stakeholder. We have about 74% and Sushi has 26%. So this was a strategic move because, Arunachal government bidding norms are very tight. They only entertain the bidders who have already executed projects in hills or the toughest terrain. And we've been the one who have already executed a lot of projects. We have constructed a 6.5 kilometer tunnel in the terrain like Ramban Banyar. And the people who started with us, they only could execute the excavation work of 1.5 kilometer. We've completed 6.5 kilometer of tunnel worth 1,000 crore. We are about to complete a viaduct. We have completed a leftover work of ILFS, which was Kiritpur Nichong in Himalayan terrain. That's one of the toughest terrain. And we're really looking forward to these projects. One more project in which we are L1 is close to 700 crore is also expected to be allotted very soon. So in totality, the project will be more than 3,000 crore in only this terrain, which is Arunachal.
Okay, all right. Take that point. Let's talk about some forward-looking statements now. EBITDA margin guidance in 11 to 12.5%. Is that something that you maintain? What kind of order book inflows are you expecting in this year? And now activity would be picking up, right? Since we are almost done with the monsoon season, or I would say the next month would be that. What kind of order breakups are you looking at? Which of the segments will do well for you?
So first of all, we are not only an EPC player, we are a developer. And if you see, 70% of our order book is from developer side, where we've been building these assets, where IRR is about 25% at the time of bidding. And if you see the completed asset, which we have sold it to NEO, our IRR, which we have made in from this project, is much more than 30%. Now, in terms of VITA levels, what we have guided, we have achieved much more in the first quarter. We always try to achieve much more than what we guide. We always, speak about the conservative numbers. And in terms of revenue, of course, that's also growth. I always said in last 2 years, I've been guiding to my investors that we will be keeping our revenue growth between 10 to 15%. But this year, looking at the order book, our minimum growth would be 15%. And in terms of the order book, we have a very good order book, close to 18,000 crore. And we have a target of getting 6,000 crore of new order book. 600 crore we've already achieved in first quarter. And we are looking forward to a lot of bidding. We've already quoted projects more than 25,000 crore this year. And our available net worth is about 4,000 crore, in which we can get the HAM projects or DBFT work projects worth 20,000 crore. So order book is not a challenge for Seagull ever. And you can see vis-a-vis our revenue, we are already sitting at around 5x of the revenue.
Would that apply to the top line as well, Mr. Sehgal? Fair to assume you would attempt to grow 20% this time around?
So I said minimum would be 15%. So last 2 years, if you see, when we IPO'd, our company was around 2,900 crore. And last year we done 4,000 crore. We've grown almost 30%. So this year, I'm saying our minimum revenue would be minimum 15%. But the investors will make more money because our project IRRs are better than EPC players. So we are a developer. We are not an EPC player. We're building the projects and selling it off. We've already done it in the past. We have already sold one asset to Neo in the first quarter, and that's visible. Yeah.
Okay, take that point. Thank you so much, Mr. Sehgal, for joining us and giving us all those details as well. So that is what Seagull India is saying, and the stock is on our radar as well. But let's talk about SpiceJet. There is a settlement that the company has done with the lesser aviator ML. Let's go across to our colleague Ashmit. What does it mean, and how important this particular development is? Ashmit.
Well, quite substantial as far as SpiceJet is concerned. Bear in mind that the NCLT was due to pronounce judgment in a total of 8 cases concerning 8 individual lessors. The claims across these 8 lessors aggregate to over 500 crore rupees. Now, what's important is that SpiceJet managed to strike a settlement at the 11th hour with one of the 8 lessors. That settlement was with Aviator ML. The Aviator ML has claims of about 60 crore rupees with SpiceJet. That one case was settled. What that effectively did is that it left the NCLT unable to proceed with the other matters. The NCLT said that all of these 8 matters are interconnected. We are unable to pronounce orders in all 8 because of settlement with one of the parties. And what's important is that one of the 2 judges who is hearing this matter before the NCLT is due to retire today. So effectively, the NCLT said one matter in which the settlement has been done has been withdrawn by the lessor. The remaining 7, the balance 7, will have to be reheard. So effectively, SpiceJet buying time in all 8 matters by settling with one of the lessors. That lessor, of course, being Aviator ML. We'll, of course, have to wait to see how the NCLT chooses to deal with the balance 7 matters now.
Ashmit, thank you for that update there. Buying time is SpiceJet. Still 100 points down on the index. Stock technicals on the other side with Pritesh Mehta of Yes Securities. Get you some trading ideas as well. Stay tuned.
Welcome back. You're still tuned into Trading Hour. The weakness in the market continues in a couple of these stocks which are at the day's low. We have SRF, which is at the day's low as we speak. Havells is the other one, which is trending towards the day low. The other one is Manappuram Finance. That too is touching lows of the day. Power Grid is the other one, which is at a week low. So for now, some of these stocks which are not doing so well in trade, and the weakness on the benchmark index also continues. But what next from here? Let's get a technical check. Pritesh Mehta from Yes Securities is joining us for just that. Pritesh, good morning. Thank you so much for joining us. What next on the index? Do you think that 24,000 could also be broken today? The weakness continues, and we've not seen any relief as yet.
Good morning, guys. I feel there is no point looking at index. Yes, we might go and retest the zone of 24,000. But I think when we look further internals of the market, we need to look at the top 10 Nifty stocks and top 20 stocks, because that is the main reason for the current predicament of the index. They are not participating, they are not showing leadership. And no, we are not witnessing any kind of strength or leadership coming from Bank Nifty as well. So I think in this kind of environment, let's not focus on index, stay away from index, and there are better opportunities outside of index. In fact, broader markets, they are showing relative strength. When we look at something like Nifty Midcap 100, Nifty Small Cap 100, even Nifty Mid Small for an index, they are outperforming Nifty on a relative basis. So this is space to be focusing on.
Where are those specific stock ideas then, Pritesh?
Yeah, the first one that we like is RR Cable. So again, the stock has been a strong uptrend in the month of May. We have seen series of bullish anchor column. Thereafter, we have seen consolidation. Bullish at a breakout has come in. So I think we are not done with the rally. There is more steam in this counter. We can see levels of 3300, and the stop loss would be around 2700. The second one is by LT Foods, again from the small caps category. This stock had a strong rally in late July and early week of August. Thereafter, it went sideways. Now it is given double top buy on point of figure chart. So it tells me that it's going to start another round of move. So buy for a move towards 490, and stop loss would be around 405.
Okay, all right. Thank you so much, Pritesh, for joining us. So those are some individual technical picks. But with that, we'll do one thing. We'll take a short break and talk about markets with Rohit Srivastava of IndianCharts.com and Strike Money.
Welcome back. Still 110 points lower on the index. Some flashes from the SEBI chairman on your screens as well. They are considering allowing mutual fund schemes only funds for portfolio management services. SEBI chairperson speaking at an event, and some important lines coming in from there as well. But the index, though, nearing the lows of the day yet again, 24,040 now. Rohit Srivastava from IndiaCharts.com and Strike Money is now joining in. Rohit, good morning. Thank you for taking out time. Well, from 24,700, 800, we went to 24,500, then 24,300, now 24,000. Do we still continue to grind lower despite being in oversold territory? What are the levels that you're watching out now on the index?
So for the day, we are going to be watching 24,050 or 24,045, let's say, which is sort of a 61% retracement of the entire rally that we saw from the 24th of July when we were at 23,600. So from 23,600 to 24,800, 61% is where we are right now. I think we'll watch this level because plus or minus of this level, you typically do get a final bottom. And like you said, a couple of indicators which were not yet oversold are starting to flash that now on our sentiment data and also at a very low time frame on the RSI. So the combination does set it up for a rebound from these levels. I don't think we are going into any free fall or bear market because the current decline is not really supported by the broad market or even within large caps. It's purely Nifty. Even the Nifty Next 50 is barely fallen off a cliff. So therefore, I think this is a very, very narrow correction. It's not a broad-based correction.
Okay, narrow correction then. So let's talk about some sectors, Rohit, in that case, since you expect it to not see a free fall. What would keep it supported in that case?
So if you look at financials, so interest rate sensitive is essentially where my expectation is that we are somewhere at the beginning of a rate reversal cycle. We may be seeing peak rates. I know people are talking a lot about US bond yields, etc., but everything may be at peak rates. And you can only see them ease from here. There's already data in the US also where, either the employment data or the inflation data has started to come off, which will create a case that you don't really have room for rate hikes. So basically what I'm saying is interest rate sensitive stocks here in India, which is financials, autos, real estate. These are likely to do well. Out of them, you can already see outperformance by the second two, which is autos and real estate. They've been doing pretty well over the last 3 to 4 weeks. And I think only financials have been the pain point, and that also mainly because of some of the large cap banks like HDFC. Apart from that, maybe a little bit of selling you're seeing in Axis, but you're not really seeing it in the second line private banks. You're not seeing it in the second line NBFCs either. So again, it brings back our argument to the large cap, mid cap theme. So I think financials also do well. So these are three sectors that I think are actually going to benefit from what is happening on the currency and bond side. And that should be our focus. And you're already seeing, like I said, performance in real estate stocks have done very well over the last month, even today. When I look at a couple of them like Oberoi Realty or DLF, where we do have open trades as a SEBI registered analyst, we actually not broken the 20-day average, as simple as that, and we've rebounded from there, which so shows that the sector is showing strength at this point of time.
Rohit, the one bothersome factor for our markets have been oil prices. From sub 70 at the time of the ceasefire announcement, we have slowly but steadily moved back to 90 plus on Brent. Is that the range or the level at which prices start to face some resistance, or is the charts indicating that we will slowly move towards $100 as well?
So we have to look at oil prices in two components, a pre-war oil price and a post-war oil price. We are still not completely out of the crisis mode. But pre-war, what happens is when the war, whenever you have a war or any kind of unrest that causes prices to go up very fast in the short term, typically at that point of time, oil prices are a negative for equity markets. But when you are in a situation where you have economic growth and say the war is behind us and you see a positive trend in oil, then it is more reflective of ongoing demand factors, possibly a commodity cycle. And I think those are the things that will eventually come into play for oil as well. Now, we have seen some improvement in the oil price in the near term from the lows of almost, if I talk about WTI, which is in front of me, from 67 to around 94. And then we've pulled back, currently trading around 84 on the WTI, maybe in the 90s for the Brent. My sense is that you could remain in a trading range for quite some time as the basing out happens. Hopefully the geopolitical risks go behind, then you may see some downside. But I'm really not looking at going back to, say, $50 as some people are talking about. I think you will remain well above this 65, 66 for WTI. And therefore, this will become your 70, 80, 90 range, which you're seeing oil in, will become the new normal as far as the bottom end is concerned. And once you form a base here and you start seeing economic expansion again, it's possible that oil prices rise much more gradually, but they will be read very, very differently by markets at that point of time. When growth is back, you'll probably see oil prices as a positive, not as a negative. But right now, I think they are somewhere in between, because you're not completely out of geopolitical zone. So every time oil prices go up, we make some noise. But the good part is that oil prices are far lower than where they were 2 months ago. And in that sense, it is helping.
That's right. Who would have thought we would be at that $120, $130 per barrel, and now I've come back to $90 a barrel on the crude price. Rohit, thank you so much for joining us. So with important levels on the Nifty and some of the sectors which could drive that level as well. Slip into a short break. Up next, we'll focus on the bond markets with Manisha Gupta on the other side. Welcome back. You're still tuned into Trading Hour on CNBC TV 18. We'll talk about bonds in just a bit, but before that, there is a wee bit of recovery which is underway. 91 points lower on the Nifty. We are at the 24,063 mark, but still below that 24,100 mark for now. We were just having a conversation with Rohit Srivastava, who said 24,050 will be an important level to watch out for today. Might not see lower lows than that. But if we talk about the broader markets, or at least let's talk about what is leading to the recovery from the lows of the day as well. Pick out some Midcap index that is also leading to some recovery that we are seeing right now in trade today. In the broader markets, though, we do have some of the stocks which are not doing so well. Lupin, for instance, is at the day's low as we speak. It has been under pressure since the time the company announced results, and there was disappointment with respect to their guidance as well. In the Nifty pack, we do have Wipro, which is at the day's high. So IT is something which is batting it for the bulls yet again. Look at that go. Wipro is up around 1%. There's been a sharp recovery from the lows of the day. But we do have some bond market conversations.
Yes, and let's go across to Manisha Gupta for just that. Manisha.
Well, it has been quite a bit of a whirlwind in the last couple of sessions when you look at the money markets, the government securities, that is, the government bonds have, the yields that have hit multi-year highs. There is rising economic uncertainty, and that can be seen in the prices and the trade as well. So 30-year US Treasury yield rose to near 2007 highs. It's seen some bit of an easing since then, and that has been across board as well. But we also did see 10-year German bond yields highest levels since 2011. Then there was yields on 10-year Japanese government bonds also hitting a 30-year highs. Also, when you look at the 30-year UK gilt, well, that also hit a 3-month highs. The bond yields have been rising to multi-year highs across in the Asian markets as well. But the bonds are getting sold off, the yields have been surging, and investors are asking for higher payouts as they invest money in long-term maturities, looking the kind of uncertainty that we are looking at, especially in the 10, 15, 20 years horizon therein. It also has to do with the Indian rupee, which also seems to have edged lower slightly. That is because the crude oil prices have been rising for a third straight week. We are trading at around 1-month highs, above $92 a barrel as well. And the crude oil prices, by the way, have gained up by 52% in 2026 till time. That continues to bother the markets herein. Also, the other thing that the street is watching out for is the Indian monsoon. The SkyMet in its latest report has said that there is a 70% possibility of a drought. They have lowered the monsoon forecast to 85% of long period average, and that of course is concerning as well. But it's a strong, steady list when you look at the private bond issuances happening in the markets today. You have Home First Finance Company. Here, the markets are looking at the board meeting that's going to be happening on Friday to approve the issuances of NCDs, which are worth nearly 1.5 billion. That is to watch out for. And then you have Integrated Infrastructure Trust, which is planning to raise 11 billion, and they are doing it via issuances of 2 bonds with different maturities going forward. Another one company that should be on your screen is L&T Finance Limited. They are looking to raise 9 billion, and they are doing it via reissuances of bonds which are maturing in 2031. Another big name, and this one is Bajaj Housing Finance, and they are looking to raise almost 20 billion via the markets there. They are doing it via issuances of 5-year bonds which are maturing in 2031. And finally, Tata Capital Housing Finance should come in on your screen because they are looking to raise nearly 20 billion, and they are doing it via issuances of 5-year bonds which are also maturing in 2031. The bids for all of these companies are in the day today.
Manisha, thank you for that update there from the bond markets. Take a short break. Back with more on the other side. Stay tuned. Welcome back. Well, there is some bit of recovery from the lows of the day at 24,040 odds. So 35 point recovery is what we have seen from the day's low. Some buying interest looking to emerge. Now, the question being whether this buying interest will sustain or not as we go into the second half of the trading session. A couple of names that are not doing well from the broader markets. Well, Himadri Specialty Chemicals, of course, is one of them. 7.5% lower on that one. That's the top loser on the Nifty 500. That does not take away from the fact that the stock has run up significantly on a year-to-date basis, so some profit booking from higher levels. The capital goods names are not doing well today. So Hitachi Energy is down 4.5%, Siemens Energy is down 3.5%, CG Power is down 3% as well, and PTC Industries too trading with losses of close to 3%. So yeah, that's the state of the market right now. We take a leave on this edition of a Trading Hour from Sonal and me. Thank you for watching. Halftime report on the other side.
Stocks continue to slide with widespread selling leading the declines, far outnumbering the advances. Renewed Gulf fears and worries on the tech sell-off is weighing on the Asian markets. Utilities as well as industrials are the big drags, even as IT holds on firm.
Well, city gas distributors to expand coverage of piped natural gas to homes. The government is allocating an additional 200 SCM of gas at the administered price to city gas distributors. The stocks of IGL and MGL flare up on the news.
After the heady show by Milky Mist post-listings on Tuesday, we have Shiprocket that steals the show today with a listing at around 35% premium to its offer price. Other listings like Doot Transmission and Bihari Lal Engineering also deliver heady gains.
Crude oil surges after US President Donald Trump says there are no talks ongoing with Iran and none are scheduled. Little movement through the Strait of Hormuz only fuels further inflation in crude prices. Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it's turning out to be a bit of a dull day for the markets again. So just about holding at around 24,000 as we speak. Remember that the markets have now fallen for the 7th straight day. The Nifty is down more than 500 points in 7 days and has been making lower lows and lower highs. The Nifty is in fact below 24,100 for the first time since July 28th. So not looking great for the markets at this point in time. Let's see whether there's any kind of respite in the second half. But the Bank Nifty also down over 100 odd points at this point. Hi, Vinny.
Hi, Ekta. Good afternoon. Yes, we're not seeing much of a respite coming in terms of the market, but at least today we are managing to hold on to the 24,000 level, right? That's a support that we're watching out for. Now, if we go below that, that will be again a key to watch out for where Nifty goes if it breaks the 24,000 mark. We've seen that recovery coming in from the day's lowest point for the Nifty. Now, whether this recovery continues is key to watch out for. Pull up the Nifty IT because while it was trading in the green with gains of 0.2% through the first half of the trading session, it went in the red and then it saw recovery. Now it's holding on to gains of almost 0.4% in the trading session. So Nifty IT also will be key to watch out for. It did see a bit of a flip-flop through the day between the red and the green. Broader end of the market still holding on to better performance versus the benchmark indices. So Nifty Midcap also has seen a recovery from the day's lowest point, now trading with cuts of just 0.2%. Small cap is still a bit more under pressure, and that's why that advance decline ratio is still more in the favor of declines versus advances in today's trading session. Whether any change happens tomorrow is going to be Sensex expiry, but today as of now declines surely seem like more on the higher side. 1,900 stocks on the declining versus 1,200 stock approximately on that one side. But let's talk about what's on the show for you all today. We will be decoding the pickup in the IPO activity with 54 companies raising nearly 70,000 crore rupees so far this year. In fact, smaller IPOs have also delivered stronger returns. So we're going to be decoding all of that for you. We'll also focus on a whole host of buzzing stocks and big movers in the trading session. Stay tuned in for that. In our Crypto Corner segment, Manisha Gupta will be tracking the key developments, including the US's SEC's proposed new framework for crypto asset financing. We'll have all of that through the show in the next 1 hour for you all. But first up, let's go across to Vivek, who's here to take us through all the stocks that are moving around in the trading session. Good afternoon, Vivek.
Well, good afternoon, Vinny. Like you pointed out, it's been quite lackluster, especially in terms of volumes as well as moves, especially post the culmination of the earnings season. Individual stocks are quite a bit of large moves. Aster DM, stands out. While the move in itself is not very large, the intraday chart will show, the kind of recovery this particular stock has seen after seeing a block deal of over 10% of equity at much lower levels at almost 760 rupees a share. Sharp recovery seen over there. In terms of order win shares, quite a few of the stocks doing quite well in the session today. Standalone refiners, especially names like Chennai Petro, that particular stock higher by almost 4% today, continues its up move that it's been seeing for the last few trading sessions. Both the city gas distribution companies that you just highlighted, IGL as well as MGL, additional gas for PNG, something that the government has allowed both the stocks cheering that particular development. And GSK Pharma, GlaxoSmithKline, not a name we discuss too often, up 3%, hitting a fresh 52-week high in the session today. On the other hand, quite a few drags as well. Remember, Page Industries, reported a very weak Q2. That particular stock almost, down 2%, has cooled off almost 10 to 15%, in the run-up and post the results as well. L&T Finance Holding, some positive news flow coming in terms of reports, but despite that, one of the top NBFC laggards in the session today. CSE, again, a particular stock, that's seen quite a bit of volume-based selling, almost 5% lower on this particular name today. And Voltas, again, a stock that's seen significant weakness post a very muted Q1.
Okay, all right, Vivek. Thanks very much for that. So a whole host of stocks which are buzzing around in today's trading session. And let's get a little more micro on that. This is our movers and shakers segment and halftime report, where we track a whole host of stocks which are buzzing in trade. In fact, Sonal joins in on city gas distributors as the government aims to accelerate household PNG rollout. Sonal, over to you.
Thank you for that. Well, there's a press release from the government where they talk about a higher allocation or the domestic gas allocation of around 200 SCM to city gas distribution companies. This will ensure that there are more PNG connections. Now, how does it impact, or how is it positive for city gas distribution companies? Gas or LNG that is imported into the country has been coming at higher rates because of lower domestic gas availability. But now the government has been pushing for higher PNG or household connections, and that's why they've allocated additional 200 SCM, which is lower price gas for these city gas distribution companies. This will ensure more PNG connections. This would also mean PNG connections at reasonable price to customers as well. So this will mean better volume gain for these companies. And secondly, this would also mean that input costs are coming at lower prices. That would mean margin benefit for these companies. And they have been seeing a lot of margin pressure in the quarter gone by, while volumes have been stable. So it's a two-part positive development for them, higher volumes and better margins. Largely positive for the likes of IGL and MGL because they have a bigger portion, or I would say they do have PNG connections in different cities. For Gujarat Energy, they are largely dependent on industrial volume, so it will not be such a positive impact for them. But yes, this news is coming after a long time where APM gas allocation has been increased, and that's something that the street likes for these companies.
Okay, thank you so much for that, Sonal. Those are those CGD names that are in focus. But let's talk about a couple of names that are in focus on the back of order wins today. Now, you have RailTel as well as HG Infra. Both of these are buzzing in the trading session, come off from the day's highest point. But nonetheless, RailTel, the order has come in, the one on around 167 crore order. This is from the EPFO. This order will also involve maybe an extension of work and extending that work order for a period of 1 more year for infrastructure as a service, which they will be giving to EPFO. So the execution of this order timeline as of now for this 167 crores is February 9th. So that is why we're seeing the stock is holding on to gains of around 3 to 4% in the trading session. The other one that we'll talk about is HG Infra. Now, they've received a letter of intent from REC's arm and for 2 substations and associated lines in UP. So that is why we saw the stock see a very sharp run up. It is an order received for construction of 220, 132 as well as 33 kilowatt of air insulated switchgear substations in Ranipur, and as well as more substations that they're making in Mirzapur as well. So this is the focus that is coming in for both these stocks because of order wins.
Okay, all right. But let's go back to Sonal now. She's looking at Jubilant Ingrevia. Sonal, why?
Well, there's an M&A in works. Jubilant Ingrevia will be acquiring 40% stake for a consideration of 189 crore rupees. This is in Zeta One Technologies. This is a fully cash consideration that Jubilant Ingrevia will be taking up. The acquisition is an electronics design and manufacturing company, and it serves different sectors, be it defense, semiconductors, aerospace, medical and industrial sectors as well. So why is Jubilant Ingrevia investing in this particular company? Because it will give an expansion and it will actually give them a presence in semiconductors and electronics manufacturing chemicals. This is how they will supply to these different sectors as well. Remember, Jubilant has already been investing or expanding into high precision semiconductor chemicals. This is a trend in the chemicals industry where they are looking at more expansion into semiconductor chemicals. Acquisition will be completed in 2 tranches by November 2026 and November 2027. If we look at the financials of the acquired company, they have done well. FY24, 51 crore revenues moved to 79 crores, and FY26 revenues came in at 98 crores, which is a CAGR of 39% in last 3 years. So yes, this has been done well. But for a 40% stake, if we talk about what the valuations are, 4.8 times the revenue, which is not very cheap actually, but maybe they are looking at the growth perspectives from here on. But this is not a segment that the company already is in. This is diversification that they are looking at into semiconductor chemicals. And analysts are of the opinion that maybe this means that there are limited growth avenues in the current business, and that's why they are looking at diversification. And they have acquired it as an associate. It's just 40% stake, so those financials will not be consolidated in the overall financials. So maybe that's why the stock is lower, because diversification is something that would mean growth avenues in the current business are not so much.
Okay, all right, Sonal, thanks very much for that. So those are a whole host of stocks which are buzzing around in today's trading session. IGL, Gujarat Energy, RailTel, HG Infra and Jubilant in Crevia. Well, it is definitely a little bit of a dull day for the markets at this point. But remember, it is not a dull time for the IPO space. In fact, we're going to decode that space next. We'll have Hormuz joining in with all the statistics that he's picked up in terms of the IPO activity, with 54 companies raising nearly 70,000 crores so far this year. So huge numbers coming in. We'll be discussing that on the other side. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. While the market is not doing anything great, right? 24,050, around that mark is what the Nifty continues to hold on to. Let's talk about a couple of individual names. Now, Aegis Logistics is in the crosshairs of an overseas M&A speculation this week. Now, with the company reportedly in advanced talks to acquire UAE-based TriStar Group, Vivek is breaking down on what brokerages are making of this as well. This is still something that is pending, Vivek, but what is your view so far that is coming in here?
That's right. Yesterday news reports had indicated about this large likely transaction, large likely M&A that could come across as far as the Aegis Group is concerned. While there is no official press release from the company, brokerages have gone ahead and done a scenario analysis of what this could mean for the entire Aegis Group, given that this could be one of the largest acquisitions that we could see as far as the logistics space is concerned. The JP Morgan has come out with a note. They have an overweight rating on the stock. They have the target price at 1,670 rupees a share. They're saying that yesterday the stock reacted to reports of the company being in advanced talks to acquire UAE-based TriStar Group. Remember, TriStar is a global, fully integrated energy logistics company operating across 30-plus countries. What they also say is that while the management has not reacted to this particular speculation, in various conference calls and analyst meets, the management has guided to a 2030 growth roadmap encompassing both organic as well as inorganic growth. And they say, prima facie, a potential acquisition will make the company a key global energy logistics player. Now, talking about the financials of TriStar, remember, it generated close to $250 million of EBITDA, $1.4 billion of revenue in calendar year 2025, and at 18% margin, compares quite favorably to Aegis's own 17.4% margin. What they say is that a potential transaction multiple of 5.8 times that the report indicates actually is quite attractive. Now, along with that, they don't think the financing deal would be viewed negatively by investors. And in fact, they say that this particular position, it positions Aegis quite well for the next leg of capacity creation.
Okay, all right, Vivek, thanks very much for that. So that's on Aegis Logistics. But let's talk about the other big story which is making headlines. It is the number of IPOs in 2026, which have now reached 50% of last year, with over 54 companies raising close to 70,000 crores. But this year has also been significant for companies that have been smaller in size but delivered healthier returns to investors. Hormuz is here to decode all of the trends so far in the IPO market. Hormuz, over to you.
Well, we are at that stage of the year where the IPO activity has started to pick up again, and based on the number of IPOs that are set to open at least until next week, the number of IPOs this year have now reached 50% of what it was in 2025. So we had over 100 IPOs last year. We have now reached 54. That is until the IPOs that are set to open until the 24th of August. Now, if you take a look at the number of IPOs, the relatively quiet first half of the year in terms of the IPO market, 20 IPOs between January to June, then we have already had 34 that have opened or are going to open going forward in the next couple of and over between this month and of course until August. Now, if you take a look at the number of IPOs in the size wise, according to this data from Prime Database, we have not had an IPO that has been more than 10,000 crore in size. The number of IPOs, the smaller ones are the ones that are garnering the majority. 34 IPOs out of the 54 have been sub 1,000 crore and so on. But this is not a new trend. If you take a look at the last 5 years as well, the number on an average, at least 2/3 of the IPOs every single year have been less than 1,000 crore in size. But it is this 1,000 crore IPOs, sub 1,000 crore IPOs, that have had better returns in terms of the value that has been created for these. Now, if you take a look at the average listing, the number of IPOs sub 1,000 crore, 28 of them have been completed and listed so far, and out of them, 20 of them have delivered positive returns and only 8 have delivered negative returns. Now, take a look at the average listing premium. For sub 1,000 crore IPO, the average listing premium has been 8.3%, but for a more than 1,000 crore IPO, the average is 11.7%, but there's a catch here which we'll get to in just a bit. But take a look at the last 6 listings. The last 6 listings have all been sub 1,000 crore and the average listing premium has been 35%. Now, why I spoke about the catch is because for IPOs more than 1,000 crore, if you exclude Bharat Coking Coal, which listed at a 96% premium, the average of that drops to 5.9%. So it comes down to the fact that the sub 1,000 crore IPOs have a a healthier average listing premium compared to the greater than 1,000 crore IPOs. Now take a look at the best performing small IPOs this time around. Omnitech Engineering is up 150% from its IPO price. GSP Crop, One EMI Tech, Gaudium IVF, Laser Power, all of them have seen gains of anywhere between 50 to 90% in comparison to their issue price. Now take a look at the worst performers as well. Of course, it does not mean that the smaller IPOs have all delivered outsized returns. There have been some that have underperformed as well. Shriram Twistech, it's down 62%. Innovision, Astha Spintex, Amirchand, all of them have declined anywhere between 15 to 50%. But the IPO pipeline is only picking up, the activity is only picking up in the primary markets, even though the secondary markets have not gone anywhere. Gaja Alternatives IPO has opened for subscription today. Tencent's Instruments will open for subscription tomorrow. And we have two already that are lined up to open next week with Skyways Air and Symbiotic Pharma. And then, of course, the two mega IPOs that the street is awaiting with bated breath. There is the IPO from Reliance Jio and, of course, the big NSE IPO as well. So the IPO activity has only started to pick up as we draw closer to the end of the year. And, of course, there's some mega fundraising activity lined up going forward as well.
Absolutely, Hormaz. We'll keep an eye out on much more to come in as well. More fundraisings, more IPOs. But thank you so much for that. At least the first half of the year, we've seen a lot of IPOs coming in, much more than what we saw last year. On that note, we're going to slip into a very short break. After the break, we'll have Jay Thakkar of ICICI Securities joining us to talk to us about his trading strategy. Stay tuned in.
Welcome back. Well, let's get talking technicals. Jay Thakkar joins in to tell us what he's strategizing today. Jay, hi, welcome to the show. Well, it's definitely a dull day for the markets. In fact, the Nifty's lost out in the past couple of trading sessions. So give us a sense in terms of how you would approach trade. What is the next technical level that you would watch out for on the downside?
Good afternoon to you, Ekta. Well, Nifty has been consolidating, and in fact, there has been a slow grind since past 12 to 13 trading sessions. If you look at when Nifty on the very first day of implementation of cash on the expiry that happened on the 3rd of August, that particular day we saw Nifty on the spot made a high above the levels of 24,700, and since then, in the market, wherein Nifty has fallen now almost to the levels of 24,100 range. For this August series particularly, if I have to say, then this is the level wherein there has been highest put base. And I think that after having fallen for straight 6 consecutive negative trading sessions, today is the 7th one, I mean, there has to be some recovery or some bounce from here on. So the risk reward is more favorable for a bounce back or a long side trade than a short side trade from the current levels. Although some increase in the short positions by the FIs in the index, it has gone up beyond 1.8 lakh contracts now. But overall setup still looks positive until 24,000 levels on 900 levels on a closing basis are held data. So I would say the short-term view is bullish. One can go long from the current levels, targeting 24,300 to 24,400 for this August series, placing a stop loss below 23,900. And having this view in the short term, I have 3 buy recommendations stock specifically as well. The first buy recommendation is on Dixon. Dixon is trading around the levels of 14,400 right now. I think the way we have seen overall long positions getting built up here, the stock is likely to head towards the levels of 15,000 to 15,400. These are its short-term targets. One can place a stop loss below 13,900. The second buy recommendation, plainly from the bounce back, is levels of 758. It's been consolidating for a while now after having witnessed some short covering, but now I think it has come to a very critical lower end of the range, which is 750. So placing a stop loss below that, one can expect a bounce back in camps from the point of view of short covering, which can take this stock to 790 to 800 levels in the near term. And the final buy recommendation would be on Torrent Pharma. Here, the trend overall has been positive. We have seen good long additions here. Since past few trading sessions, there has been some consolidation on account of profit booking. However, the overall setup still looks bullish. I think that within the pharma space, this Torrent Pharma targeting 5,200, placing a stop loss below 48.50.
Okay, Jay, thank you so much for joining us this afternoon, giving us the levels in terms of the markets as well as your individual bets. CAMS, Dixon Tech as well as Torrent Pharma were the names that you mentioned. Thanks so much for that. On that note, we're going to slip into a very short break. After the break, we'll come back and get you more in terms of stock-specific action as well as stock-specific news. On that note, just a quick check in terms of the market that I would like to note as well, because we're seeing that the Nifty is still at 24,050 levels, but Nifty IT, that's the one that's seeing a pickup. Now it's up 0.5% in the trading session today. So after going to the red, it's seen a significant recovery. So watch out for the Nifty IT pack, especially coming in and leading the way for Nifty IT is a Coforge that is doing well for them in the trading session, where Persistent Systems, HCL Tech, all of them are managing to hold on to very strong gains in the trading session. On that note, before we go into the break, let's go across to Nigel, actually, who is here to tell us what's happening in the world of F&O, what are the important cues we should keep an eye on this afternoon. Nigel, we keep managing to hold on to 24,000 as of now. But what is the key indication from the F&O space?
Well, just about managing, right? The last few trading sessions, we've been heading south. And today as well, we're under some pressure. But my gut is that 24,000 odd could invite actually a fresh buying opportunity. So let's see how that goes. But otherwise, the trend seems to have got broken a little bit, or at least paused for now. The call writers are back in play. And that's why if you see the PCR has come down to around 0.7 or thereabouts. And a few of those active strikes actually should come up for you on the screen. The 24,100 call, there's a sharp decline that we're seeing in the premium. It's down to around 130 rupees. Remember, it started the day at more than 200 rupees. The 24,200 call as well. The premium out there as well has lost more than 30-40% thereabouts. In fact, it started the day at around 150 bucks. It's down to around 80 rupees. So that's telling you there's aggressive writing you're seeing at both those two levels. However, The 24,000 put, that's seeing some bit of open interest build up. So there is some writing on the put side as well. 24,000 put, 24,050 odd put. We are seeing signs of writing at those levels. So looking at the options data, well, you get your levels up for you. So closer to around the 20 DMA and going by the options data, 24,350. That's the first level of resistance that you're looking at. However, on the way up, if you remember, the 23,950 was a bit of a resistance. Once we got past that, then in fact we moved up. And that becomes a near-term support. Even if you look at it technically, well, that as well, 23,950 is an important support zone. Individual stocks that are in focus, well, Dixon Technologies, that's seeing a bit of a short squeeze. The stock is up, I think, 1.5%. And the open interest came down. And the other one that we're looking at is Nippon Life. That one is seeing a good amount of fresh buying. The open interest actually is up more than 10%, and the stock as well is holding strong in an otherwise wobbly market. So I'll keep an eye out on both those two names. So for the time being, the Nifty is a little bit lower, but it seems that this 23,950 to around 24,000 odd, it could invite some kind of interest from a bullish perspective. Back to you.
Okay, all right, Nigel, thanks very much for that. So that's what's taking place in the F&O space. For the markets, like we mentioned, it is a bit of a dull day. So we have the Nifty, which is just about holding at around 24,000. The advanced decline ratio has shown no sort of improvement as the day has gone along. So around 1,700 stocks advancing to over 2,400 stocks, which are declining right now on the Bombay Stock Exchange. We'll do one thing, we'll take a short break, but up next, we'll get you more on the markets, lot of stocks to watch out for, all that on the other side. Stay tuned.
Welcome back, and joining us on the show now is Avinash Verma. He's promoter and FD at EICPL. Mr. Verma, hi, thank you so much for joining in. First of all, on the sugar prices itself, because when you look at the ex-mill prices in various states in the country, they seem to be crossing 53, 5400. Wholesale prices at 57, 5800 in Delhi as well. The kind of run-up that we seem to be looking at in prices, even as government is making all the right statements, taking steps from stock holding to physical verification as well. What is your sense on why are prices not stopping at all?
Hi, Manisha. I don't really follow sugar so much, but whatever I could read and understand from the media as well as whatever information I have, obviously the stocks have been drawn down and the kind of expected production of sugar is not as much as what we were expecting. And therefore, the closing balance as on end of this year will be much lower than what was earlier estimated. Secondly, what I also understand from my friends from the trade is the sugar production next year will be probably equal to or lower than this year. I think ISMA will be in a much better position to tell you that. So both combined, the stocks are on the lower side. There is a demand now. The festival demand will be coming up very soon. And next year's estimation of production will be lower than what it was expected earlier. So all these combined together, I assume that the prices are moving up.
The whole ethanol as a story in India began with sugar, and that seems to be becoming a very small percentage of the overall trade. And with the kind of concerns that we just spoke about, would you say that sugar perhaps would take yet another step back?
Yes, Manisha, if you remember, we've been talking together for the last about 15 years on how the ethanol program has moved. So nobody better than you to understand the policy, how it has been framed, and how it has moved forward in the last so many years. See, the whole concept of the sugar industry producing ethanol was to give flexibility to the sugar industry so that whenever there is surplus sugar cane, they can convert that into ethanol instead of producing that surplus sugar. And the prices of sugar would actually decide how much ethanol they would make and how much sugar they would make.
Yeah.
Now, if the price of sugar is much better than what return they would get from ethanol, obviously the sugar industry would prefer to make more of sugar. And this is exactly what is happening now. The flexibility will allow the sugar companies to produce whichever product is more beneficial to them and more economically, it makes more economic sense to them.
So when you look at the divergence in the coming season, and we've seen the divergence from cane to ethanol kind of continue to decline for 2 seasons now. Coming season, do you think that would go further declining? And with the kind of whole narrative that we seem to be talking about right now, that by the month of November, the sugar availability in the country would be much lower. There perhaps is an import being discussed as well. Where does that leave the industry and then, of course, the ethanol part?
See, let me answer the import part. I mean, I've gone through that whole process a few years back when I was with ISMA. There was a lot of requests for import of sugar, and the country did allow about 3.5 lakh tons of sugar imports, and that too only in the southern part of the country, only in the southern ports. That was because the sugar availability in the southern part was lower, and therefore the country imported only in the southern part of the country. So, and as far as the availability of sugar, my numbers and whatever I've been told is about 35 to 40 lakh tons will be the closing balance. And even if you draw down about 24, 25 lakh tons in the month of October, we will still have a reasonable number as on 1st of November. Now, I also understand that the government wants the industry to produce, start producing earlier, start crushing earlier. And therefore, the concern that as on 1st November or the first week of November, there will be less sugar in the country, that can be overcome by kind of advancing the sugarcane crushing this year. So there may not be any requirement of imports. Even if it is required, I would suggest that the government can go back about 7, 8 years back and see how we could manage by just importing 3.5 lakh tons and that too in certain parts, southern parts of the country.
How are you also looking at the festival demand? And, you know, my question again on divergence, do you see whether we import or we don't import, would you see that cane flowing into ethanol is going to be something that's going to be a question mark in the coming season?
I do see that a big question mark there, because if next year's production is not so much, because if the government is concerned about the sugar availability or the sugar stocks at the end of this year, they would like to build up stocks for the next year again, because again the rainfall this year is not so good. So one should be worried about the cropping for the 27-28 sugar season. And therefore, for the next 2 years, the government should plan from now on and kind of build up stocks so that you don't require to import too much of sugar. And therefore, diversion of sugarcane into ethanol can actually be controlled and more of sugar can be produced.
The sugar stocks clearly have been running today on all of these reports on festival demand, lower sugar availability, and that really seems to be supporting many of those sugar stocks there. But when it comes to ethanol then, and if cane is going to take a back step, you see rice continuing to do its work, maize is yet another one, but is it going to be more of rice then?
Yes, obviously. I mean, if there is lower production or lower supplies from the sugar cane side, obviously the supplies can actually come from the grain side. Let us remember one thing, Manisha, that lot of sugar companies, especially in the northern part of the country, including even in Karnataka, they have developed dual feed ethanol plants. So therefore, if they don't have enough sugar cane to convert into ethanol, they will also use maize and broken rice to convert that into ethanol. So the sugar companies per se, the larger ones especially, should not have the problem of capacity utilization, because they have that flexibility to use maize or rice in the same ethanol plant if they have lower sugar cane availability. So the supplies, number one, will be more from maize and rice this year, next year. Plus, some of that or most of that will also come from the sugar industry, because they have dual feed facilities now.
Point taken. Mr. Avinash Verma, as always, thank you so much for making sense of all of that. So clearly a run-up in sugar prices and stocks as well, as markets believe that come 1st November and the new season starts, we perhaps could be looking at lower sugar availability. Would that lead to imports for India when it comes to sugar, or is it going to lead to early crushing season also coming in for mills is something that we'll of course have to watch out for. But with that, let's go for a short break. Up next in our Crypto Corner segment, we track the key developments, including the US SEC's proposed new framework for crypto asset financing after this break.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome to Crypto Corner now, and let me tell you that it has been a year of declines continuing for cryptocurrencies. The last couple of months actually have taken away all the gains that we saw in cryptocurrencies in the first quarter of this calendar year. So much so that when you look at Bitcoin right now, it's trading 26.5% on a weaker side. Ethereum has declined even more with 35% of losses there. Binance is down 30% as well. And then you have something like a Solana and an XRP, which has declined even more at 45 to 47%. Polygon, which usually does quite well, also is in the negative of 18% for this year till time. But there is plenty happening when you look at the global markets in sense of regulations and constitution therein. The most important clearly comes in from US SEC, the new crypto framework, which establishes clear compliance pathways for digital assets, now provides a $75 million of fundraising as well in sense of exemption for crypto startups. So a big positive coming in for the crypto startups there. Apart from that, the Genius Act, the stablecoin rules also seem to be now coming in. Starting 2027, the crypto platforms will face stringent licensing rules for fiat-pegged tokens therein. The Clarity Act update also seems to be coming into the markets now, where lawmakers seem to be prepping for a pivotal cloture vote in the month of September. Remember, this was supposed to happen way back in June, but now it's expected to happen in September. So markets will watch out for the next 1 month as well. And then when you look at the traditional finance companies, well, they seem to be scaling up in digital asset infrastructure as well. I'll start with Citigroup, and they are looking to deploy institutional Bitcoin custody by this year end under new Custody Plus platform. You also have UBS now coming into the market, which is expanding digital asset exposure. They're logging 24 times surge in spot Bitcoin ETF call options as of now. And then you also have Neuberger, which is looking at $230 billion fixed income platform placing on-chain, creating efficient tokenized fund structure. And there's a lot of competition as well going on, where you have Schwab, E-Trade rolling out spot crypto access to 40 million accounts at 50 to 75 basis points. This is much lower than various other established cryptocurrency exchanges seem to be doing. So clearly getting competitive there.
Absolutely, seeing increased competition there, but that's all about cryptos and what's happening in the world of cryptocurrencies as well. Thank you so much for that, Manisha. On that note, we're going to slip into a very short break. We'll come back with more on markets, more stock-specific action after the break.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back to Halftime Report on CNBC TV 18. Now, the markets have not priced in an AI opportunity. That's the word coming from the head of IT industry body NASSCOM. Now, CNBC TV 18, in partnership with NASSCOM, hosted a special event to discuss if Indian ITs is ready for the AI pivot. Microsoft's India head believes that nobody is better positioned than Indian IT companies to benefit from AI. Let's go across. Also, we had Arundhati Bhattacharya of Salesforce, who says that SaaScopolis is a narrative that has already been proven false. Listen in.
This industry will go through bad times before it gets better, as I always say. So I think we're going through that turf at this point in time. People always ask me, will the industry pivot? The industry has nothing to pivot here. I think the individual companies will pivot. Will all the industry players will pivot? Probably not. 80% of them will pivot. Maybe some of them will not pivot. But the opportunity you saw in those charts, the TAM that we are talking about, the opportunities that for the services company to truly cross the chasm, if you may, that's for real. And I don't believe that the markets have actually priced in yet.
We look at a few transitions, and possibly our industry is experiencing one right now. And it's a transition of two pivots. I think that was also spoken about in the first presentation, of what's under pressure and what's new. And the growth of opportunity in the new is something that we have been reporting quarter on quarter. It's been last 3 quarters we've been reporting, and that's a mark of confidence and conviction. The path that we have taken, the path that we have chosen.
Every headline has been screaming about the SaaSpocalypse. Now, how do you, sitting at Salesforce, deal with this?
I think, our results are expected very shortly. So really can't speak about that in as clear a language as I could. But I think that that narrative has already been proven false. The thing is, we are all in a stage of transition. And let me make this comment regarding this outcome-based pricing. When this outcome-based pricing really starts working, they want to go back to the license-based pricing, okay? Because the outcomes are so many, they don't like it then.
I was with a client recently, and he said, some of these frontier models that I'm working with, they're like brilliant strangers. And I said, can you explain this to me? He said, they're brilliant strangers. They know everything about the world. They know nothing about me. Can you get me a familiar friend? Can you get me a child who grows up in my organization, understands my context, the knowledge turns, what does a good work look like, and then get that to answer questions or do work for me, which is where the new value pool is, and Naushir spoke about, right? Which is translating this enterprise ontology, the enterprise context into these frontier models, and getting these models to work for you on your own terms versus the other way around. Satya spoke about the reverse information paradox. Don't pay for these models twice. So I think that is where the real value pool is, and I don't think there's anybody better positioned than the services companies in India who have the context, who have the domain knowledge, who know how to do this at scale.
Okay, and McKinsey's Naushir Kaka adds that the revenue productivity per employee is steadily going up and that India is actively gaining employment. Listen in.
Now, if I look at India, these are some well-known facts, but they're probably not known as well. So if I look at the top 20 vendors, on the left-hand side, I can't get the GCCs in that number because it's not exactly accurate. The revenue productivity per employee, i.e. the revenue rate versus the number of employees, has been going steadily up. And some of the vendors, including some in the room, have actually shown remarkable growth rates on the per-person revenue. The headcount on that, the dark blue on this line, is actually the outsourced headcount. The light blue is the GCC addition. So 2 things to note. Number 1, your headcount in India is still more modestly than ever before. We're still actually gaining employment. Not at the rates we were doing in the past, but we're still gaining employment. But the headcount on the outsourced side has been roughly flat. In other words, the GCCs, if you like, are probably taking share.
Okay, on that note, it's a wrap on Halftime Report. Business Lunch will take all of the action forward. Stay tuned.
Stocks continue to slide with widespread selling leading to declines far outnumbering advances. Renewed Gulf worries and a tech sell-off in Asia weigh. Utilities and industrials are the big drags even as IT hold firm.
To expand the coverage of piped natural gas to homes, the government is allocating an additional 200 SCM of gas at the administered price to city gas distributors. The stocks of IGL and MGL flare up on the news.
After the heady show by Milky Mist post-listing on Tuesday, Shiprocket steals the show today with a listing at 35% premium to its offer price. Other listings like Dooth Transmission and Bihari Lal Engineering also deliver heady gains.
Crude oil prices surged after US President Donald Trump says that there are no talks ongoing with Iran and none are scheduled. Little movement through the Strait of Hormuz only fuels further inflation in prices. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Patakia. With me, as always, Arundhati Ramanan. Arundhati, good afternoon to you.
Hi, Hormaz. Good afternoon. You know, another lackluster day on Dalal Street, right? Nifty barely holding on to that 24,000 mark. And we're seeing the Nifty and Sensex see cuts for the 6th straight session at this point.
In fact, it's now added one more to it. It's a 7th straight day of losses now for the index. And well, the 24,045 level on the index is going to be the most important one. Because it's the 61.8% retracement from the rally that we saw from the lows in July. And for now, the index has managed to hold on to that level. Still 100 points lower, still at 24,050, still at the lows of the day. But 24,045 is that level that has not been broken yet. And then, of course, we go to 24,000. And if that goes, then the next level of support only emerges at 23,700 on the downside. So we've already lost more than 500 points in the last 7 sessions now on the index. So not a pretty picture if you're looking at the index performance, but of course the broader markets, the specific stocks, there is activity that is happening there more so. Action being stock specific. The Midcap index not fallen as much as the index as the Nifty, still in the red, but fairly range bound is where the Midcap index is. Of course, the primary market activity is in a world of its own. That's where the real action is. The listings of the day today have been very, very sharp.
Absolutely. It's a different run there for those new companies that are listing. But if you take a look at the Nifty and the markets today, what's leading it lower are those defense names, right? That was actually doing well in the last 2 sessions, but the index for today is about 1%, 1.5% lower. And if you take a look, HAL, MTAR Tech, Astra Micro, all of them down anywhere between 1% and 5% in the red. We're seeing pressure for that metal pack as well, about 0.5% in the red today as we speak. And right now seeing a little bit of a recovery, 0.2% lower. We've got Hindalco, Nalco, Hinzink, all of them down over 1%. In fact, a big recovery there on Hinzink. That stock now 0.5% in the green. Now, the only index, one of the only indices that's managing to hold on to in the green is that IT pack, which has actually been the loser over the last couple of sessions. We've got HCL Tech, Coforge, Persistent, all of them gaining over 1.5% as we speak. And speaking of the IT pack, Hormuz, we have the reason as to why that IT pack is gaining in trade today.
Oh, yes, it does. And that was, of course, evident from the sell-off that you have seen in the markets in both South Korea and in the US, where the chip stocks sold off significantly, but the software names did fairly well. Overnight, the ADRs of Infosys and Wipro were also higher. But on the contrary, CLSA has issued a note on the sector. It is expecting mid-cap IT companies to fare better than the larger names. Rima is here with more details on this. Rima.
Thanks so much for that. So CLS's main point is that this technology transition is going to create winners and losers. And the winners are going to be the mid-cap IT companies, better positioned to navigate it. They're better placed to take advantage of the changes, stronger management, execution, and the ability to pivot faster, which is why CLSA maintains a high conviction outperform on both Persistent and Coforge, and they've got an outperform rating on Hexaware and LTIMindtree. But for large caps, they say the picture is tougher. They are dealing with AI-led deflation in their legacy business, and plus there are macro headwinds. One of the key takeaways is, and by the way, for the large caps, they've also downgraded a TCS, Infosys, Tech Mahindra to a hold, while Wipro and Mphasis have been downgraded to an underperform. But I think this part is the most important part of what CLSA has to say. I think everyone's dealing with the question is about this AI inflation. When will the net benefit from AI offset the net loss on account of AI. And CLSA's view is that AI volumes could supersede the deflationary impact by FY30 only by FY30, which basically means the industry could be stuck in a period of subdued growth before AI volumes are large enough to offset the revenue deflation. Remember, FY24, 25, 26, FY27, they all have been low growth years for the companies, and now CLSA is saying that this could extend till FY30. Look at the numbers now. And for the first time, we have a brokerage calling out the kind of AI revenue contribution. So currently, for the large cap IT companies, AI is about 6 to 10% of their AI revenues, of the total revenues. According to CLSA, this goes up to 30-35% by FY31 in the next 4 or 5 years. And only when that happens will the revenue growth for the large cap IT companies expand from low single digits, from a 1.9%, a 2%, it will go up to mid single digits. So basically, double digit growth rate is not in the picture. So the message is very clear. The opportunity is real, but the gestation period is going to be very long. The industry will have to wait till at least FY30 as it moves from low single digit to mid single digit kind of a revenue growth. Valuations, they say, are fairly it's balanced. Risk reward is favorable. There are 3 structural headwinds though. One is GCC. They're not gaining market share over global peers, and services are losing out to hardware and software companies on account of the global AI rollout.
So CLSA, they're preferring mid-tier IT companies over the large cap ones. Rima, many thanks for taking us through those details. Now, the number of IPOs in 2026 have now reached 50% of last year, with over 54 companies raising close to 70,000 crore rupees. But this year has also been significant for companies that have been smaller in size but delivered healthier returns to investors. Hormaz is here to decode the trends so far. Hormaz?
Well, we are at that stage now of the year where IPO activity generally picks up, and that has been the case this year as well. Now, as of the 24th of August, until which we have data for which IPOs are about to open, a total of 54 IPOs have opened so far in 2026. That is almost half of the number of IPOs that we saw in 2025, which was well over 100. Now, this comes after a relatively quiet first half where we saw only 20 issues opening for subscription, and compare that to post-June, where we have already seen 34 issues that have opened or are set to open at least until the 24th of August. Now take a look at the size-wise IPO breakdown, and we have not had an IPO that has been over 10,000 crore in size so far this year. The smaller ones have been the ones that have dominated proceedings here. 34 out of the 54 IPOs so far have been sub 1,000 crore in size. But this is not a new trend. Now, if you take a look at the last 5 years as well, on an average, at least 2/3 of all IPOs opening for subscription every calendar year in the last 5 years has been sub 1,000 crore in size. Now take a look at the average listing premium of these IPOs as well. Now, out of the 28 sub 1,000 crore listed of the IPO sub 1,000 crore size, the average listing premium is 8.3%. For over 1,000 crore in size, that goes up to 11.7%, but there is a catch here. I'll get to that in just a bit. But if you take a look at the last 6 listings, all 6 of them have been sub 1,000 crore, and the average listing premium of them have been 35%. Now take a look at the catch. Now, if you exclude Bharat Coking Coal, which was a greater than 1,000 crore IPO in size, which listed at a 96% premium, the average of listing premium of the IPOs of more than 1,000 crore in size drops to 5.9%. That's the catch here, because and therefore the IPOs sub 1,000 crore have delivered a greater average listing premium compared to the more than 1,000 crore ones. Now take a look at the best performing IPOs so far, the sub 1,000 crore category. Omnitech Engineering is up 150% from its IPO price. GSP Crop, On EMI, Gaudium, Laser Power have all gained anywhere between 50 to 90% from their issue price this year. But that also does not mean that all small IPOs have delivered outsized returns. Take a look at the worst performing stocks as well. Shriram Twistex down 62% from its issue price. Innovision, Astha Spintex, Alpine Texwood, all of them have declined anywhere between 45 to 50% from their issue price. Of course, this is not the end of the IPO pipeline. There is a long one that is still lined up. There is one IPO that has opened for subscription today, one more opening for subscription tomorrow, and 2 that are lined up to open next next week, and a size of anywhere between 550 crore to as high as 1750 crore. And last but not the least, the two major IPOs that the street is awaiting with bated breath, Reliance Jio being the first one, of course, and of course the IPO from NSE is also something that the street is awaiting. So the IPO activity has only started to pick up now as we draw closer to the end of the year. There is some big fundraising activity that is lined up on the last street going forward.
So lots of action there in the IPO space on Dalal Street. Thank you for that, Hormuz. Now, the MD and CEO of the National Stock Exchange earlier today thanked the SEBI chairman for the NOC for the NSE IPO. Sources are now telling CNBC TV 18 that the issue could be launched in September. Yash Jain is here with all of those details. Yash?
Well, that's correct. So, of course, as Hormaz mentioned, one of the most awaited IPO, the National Stock Exchange, one of the largest IPO, which Indian markets are awaiting. The MD and CEO of the exchange, that is the National Stock Exchange, at the CAPM Conference 2026, thanked the SEBI chairman for the approval when it comes to NSE's IPO. Just a small clarification, the thanks which came from the NSE MD CEO was not for the DRHP approval. It was rather for the no objection certificate approval which SEBI had given to NSE's IPO, which was about a month and a half ago, which allowed the National Stock Exchange to file the IPO DRHP with market regulator SEBI. As far as SEBI's approval for that important DRHP is concerned, that still remains awaited. And of course, NSE MD CEO thanked the SEBI chairman only because it was the first time when both of them were on a public stage after the NOC approvals was given by market regulator SEBI to NSE. As far as the way forward is concerned, all indications with the National Stock Exchange tell us that NSE is expecting that important DRHP approval as well by the end of current week or next week. As far as the way forward then is concerned, by 10th of September, around that time is when NSE is looking to launch the price band for its IPO, which is expected to be around 2100 to 2300 approximately. And by 15th of September, which will be the auspicious week of Ganesh Chaturthi, is when National Stock Exchange would look to launch and list on stock exchange, that is the Bombay Stock Exchange. That will happen by mid-September. A valuation of about 5.2 to 5.3 lakh crore being targeted by the National Stock Exchange.
Important updates on the NSE IPO. Yash, thank you for bringing that to us. Take a short break. On the other side, we get you all the updates from West Asia. Stay tuned. Welcome back. On to the latest updates from West Asia. US President Donald Trump says that no conversations are taking place or scheduled to take place with Iran, while maintaining that the US naval blockade remains in full force and mines in the Strait of Hormuz have been cleared. CNBC's Dan Murphy gets us the latest updates.
President Trump says the Strait of Hormuz is open. In a post on Truth Social overnight, he says the waterway is open and operating and that all water mines have been removed or detonated. He adds the US naval blockade of Iran remains in full force. But US Central Command has not echoed that claim. Asked by CNBC to confirm that the strait has been demined, CENTCOM referred us to the White House. Meanwhile, President Trump also posting an image declaring the strait a new US territory overnight. In the Oval Office on Monday, he called that a great idea, saying, quote, we control it with the blockade. Experts say that would violate international law. And the diplomacy is gone. President Trump also now saying there are no talks or conversations going on or scheduled with the Islamic Republic of Iran. That reverses his own position from 2 weeks ago when he accused Iran of denying talks that were underway. It follows his decision to rule out extending the 60-day ceasefire, which expired on Monday. Meanwhile, Iran's Mohammad Ghalibaf breaking his recent silence, saying that the strait will remain closed until the US fulfills its side of their agreement.
Let me be clear. Until the United States fulfills its commitments under the agreement, including lifting the blockade, releasing frozen assets, lifting oil sanctions, ending threats and military operations on all fronts, and implementing the other conditions to which it committed, the Strait of Hormuz will not reopen.
Meanwhile, weeks of calm interrupted here in the UAE after the country came under an attempted Iranian missile attack overnight. The Ministry of Defense says air defenses detected 2 missiles launched from Iran towards the country. The first fell outside of UAE territorial waters. The second fell inside them. The Ministry of Defense says Iran was targeting maritime navigation. For its part, Iran's foreign ministry denied any involvement, but the context matters here. Only last weekend, an ADNOC vessel was hit by a missile while transiting the Strait of Hormuz. An attack Abu Dhabi also blamed directly on Iran. And Abu Dhabi's response is economic and sweeping. The foreign ministry says that, quote, in light of regional escalations that undermine regional and international peace and security, all trade, commercial exchanges and financial transactions with Iran have been halted until further notice.
So Dan there with all the action from West Asia. But on that note, it is time for us to head into a short break. But more news and updates on the other side. Stay tuned. Welcome back. You're watching Business Lunch on CNBC TV 18. SpiceJet has settled with lessor Aviator ML, forcing the NCLT to hold back verdicts in 8 insolvency pleas worth over 500 crore rupees, with the tribunal calling the last-minute move a fraud on the court. Ashmit Kumar has all of those details. Ashmit, what are you picking up?
Well, a big relief coming in as far as SpiceJet is concerned. Bear in mind, the NCLT was supposed to pronounce judgment in a case of 8 petitions, 8 insolvency petitions against SpiceJet. However, as this matter came for pronouncement before the NCLT, SpiceJet appeared, their counsels appeared, and they informed that they've managed to settle the payment dispute with one of the 8 lessors. That one lessor was Aviator ML. The amount in question was about 60-odd crore rupees. They've managed to agree on a settlement. Aviator ML withdrew its petition. But what's interesting is that the NCLT noted that, look, this one petition, the Aviator ML application, was interconnected with the remaining 7. All 8 were interconnected, and because of that, the NCLT said that because there is a settlement that is reached with one of the parties, they cannot pronounce their orders on insolvency against SpiceJet in all 8 of them. So essentially what has happened is that one petition has been withdrawn after a settlement. There are 7 others that were due to have orders today. They will now be reheard afresh because one of the 2 judges hearing this matter in the NCLT is due to retire today. So a new bench will be constituted. The 7 of them will be heard once again. And bear in mind, this is significant given as how while Aviator ML had dues of only about 60-odd crore rupees, the remaining 7, their aggregate claims add up to about over 500 crore rupees. So to that end, SpiceJet buying itself time. The orders being deferred right now, the cases to be reheard once again. And again, aggregate claims over 500 crore rupees. SpiceJet managing to defer the judgment by settling with one lessor for a settlement sum of about 60-odd crore rupees.
Ashmit, thank you for that update there. You take your leave on this edition of Business Lunch. The market still at the lows of the day, still around that 24,040 mark from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vivek Iyer. And again today we are talking about markets being at the lows. It's almost a 500-point cut in last 1 week that we are seeing. And seventh straight day of cuts on the Nifty. No respite there. And we are now testing that 24,000 mark.
Testing the 24,000 mark, no respite from the selling pressure, and it's very lackluster trading session. Volumes are quite thin. The broader end of the market's not doing too well as well. And along with that, when you're especially looking at the kind of momentum you're seeing in the larger cap stocks, it's completely missing. So overall, very lackluster, muted volume kind of trading session is what we're seeing so far. But we have a lot lined up on the show for you, so let's start off with the top headlines. Market continues to trade with cuts, with the Nifty trading near the 24,050 range. Financials, pharma stocks drag, while IT bucks the trend. Broader markets trades in line.
EMS rallies more than 5% after it is declared as the highest bidder for projects worth 42 crore rupees. RailTel is surging on winning an order worth 170 crore rupees from the EPFO, while AG Infra gains after receiving letter of intent from REC Arm for two substations and associated lines.
After the heady show by Milky Mist post-listing on Tuesday, Shiprocket steals the show today with a listing pop at 35% premium to its offer price. Other listings like Crude Transmission and Biharilal Engineering too deliver heady gains.
The government plans for a higher allocation of APM gas to city gas distribution companies as it looks to meet rising household demand. Stocks surge across the board. All right, those are the top headlines that we are tracking. The broader end of the market's under pressure. It's actually across the board if you have to talk about the moves in the market. Nifty continues to see lower lows. And if we talk about some of these sectoral moves, IT is under pressure. We do have, IT is the one which is batting for the bulls, my bad. It is up around 0.5%. We do have most of the sectors in the red. Nifty Energy is down 1%. FMCG is seeing some cuts. Pharma is down around 0.3%. So it's across the board cut that is coming by. The big question, whether we break that 24,000 mark today itself, or there is some consolidation at 24,050.
That's right. Expect to see some consolidation or some respite from the selling pressure, at least at the current level. That's what the bulls will be hoping for. A couple of individual stocks are hitting the screen. Have a look at Bharat Forge. In the last half hour of the session, has moved significantly lower to the day's lowest point. Colgate Palmolive continues to languish post the analyst meet that they had day for yesterday. And on the other hand, Quantum Greaves Consumer, ahead of its analyst day tomorrow, has perked up and now trading near the highs of the day. But these stocks and a whole host of other names is what Upasana has on her radar. This is our special segment, Midcap Movers. Upasana will take us through all of the midcaps that are moving around in the session.
Well, certainly, if you look at the Nifty Midcap Index, it's down nearly about 0.3%. First, let us focus on some of the top gainers in today's trading session. Zaggle Prepared is up nearly about 12%. The rally continues for the stock. Milky Mist is also up nearly about 10%. Chennai Petro continues to remain in focus, up more than 3%. And if we look at the stock move in the last 1 month, it's up nearly about 17%. Keynes Tech also seeing some gains, up more than 3% as we speak, and sugar stocks continue to surge in today's trading session. Dwarkesh Sugar up more than 6%. Now let us look at some of the volume buzzers on the back of the order wins. RailTel, the volumes up nearly about 30 times the weekly average. EMS is seeing a high of nearly about 5%. Volumes up 10 times. AG Infra also surging on the back of that order win. Volumes up 31 times the weekly average, and Prism Johnson also secures additional coal linkages worth 70 crore annually, and we can certainly see the stock react on this one, up more than 4.5%. Now on the flip side, let us look at some of the top losers in today's trading session. NetWeb has seen a cut of 6%. CMS Infosystem trading at a 52-week low. CG Power is also taking a hit. And lastly, coming to the defense stocks, continuing the yesterday's rally, today are seeing some correction. Zentek down nearly about 3%, and Astra Micro is also nearly about 3.5% taking a hit. So all in all these stocks are on our radar.
Okay, thank you so much for that as always, Upasana. It's now a good time to welcome Ajit Mishra from Religare Broking for a technical check on the markets. Ajit, good afternoon. Do you think 24,000 mark, that is something that could be broken today, or we'll see some consolidation or maybe a recovery from current levels?
Yeah, good afternoon, Sonal. So, Sonal, what we are seeing right now is the 7th consecutive day of decline. And Today, the pace of decline is slightly higher, means after breaking its 100 EMA around 24,200 level, we are seeing that the pace of decline has increased. Banking still looks relatively better. So there is a possibility that in case if the banking index manages to hold this 56,900 mark, probably we may see a rebound. But decisively, this is the third time that we are testing a trend line support on the daily chart. At the same time, crude has inched above $90 mark, and there is a gap that we have on the daily chart to fill in crude also close around $94, $95 mark. So all this put together, maybe we might see some respite due to the oversold position on the intraday basis. But broadly, the texture has changed from positive to negative. And until we decisively reclaim 24,400 mark, I doubt that we can see any meaningful recovery.
Well, completely take your point, Ajit. It's been languishing, especially as far as the headline indices are concerned. But broader into the markets, what are your individual trading picks for the day?
So Vivek, we are still seeing that pockets like auto and some of these realty counters, they are still holding strong. So DLF is something that we like. It's been almost like 2 weeks of tight range consolidation. So there's a possibility that we might see an uptick with the level close around 694 being the target zone. So with stop at 658, one can look for a fresh long opportunity in DLF. FMCG is the weakest link among all the key sectors, and we still feel that this trend might continue. So after ITC, HUL also looks set for the next leg of decline, maybe a possible target of around 1910. So with stop at 2065, one can look for shorting opportunity in HUL.
All right, thank you so much for joining us and taking us through those individual names that are your top bets. We'll step into a short break now. When we come back, we'll get you more on the markets and talk about some stock-specific action on the other side.
Welcome back to Midcap Radar. While the headline indices are muted, a bit of a recovery as far as some select stocks in the broader end of the markets are concerned. Have a look at a name like InfoEdge or Naukri. That particular stock continues to move higher after a stellar set of numbers from, as far as Q1 is concerned. That particular stock near the 1380 mark, and a bit of a bounce back as far as select NBFCs are concerned. PNB Housing Finance as well as Cholafin. Both of these names have recovered quite sharply. But one set of stocks that are doing quite well today are city gas distribution companies. Sonal, what's the development out here?
It is a positive development for city gas distribution companies, where the government has said they will allocate additional domestic gas, which will be used by these city gas distribution companies to make PNG. PNG is the household gas that you and I use, which is given to you via that piped gas connection. So they say they will be allocating additional 200 SCM for this particular PNG gas availability for domestic consumers. Why is it positive for city gas distribution companies? For two reasons. During the West Asia crisis, we were seeing that there was an LPG crisis, because of which government had been focusing a lot more on PNG connection. That would mean higher volumes for these companies from the PNG segment. The second thing is that during the same time, there were concerns around domestic gas allocation. Gas prices had surged and imported gas was much costlier for all these companies. So getting domestic gas will be a discounted price, because domestic gas is usually priced at a lower level. So these companies will be getting additional gas at lower prices. What would that mean? Their margins will improve. So there is a 2-point positive development for them. One, of course, PNG volumes will increase because of this PNG push, and second, their margins will improve because of this particular move. It largely will benefit IGL and MGL, because these are the ones which have a bigger network in the PNG space, be it in Delhi, be it in Mumbai. The second thing is that Gujarat Energy, which was erstwhile Gujarat Gas, has a higher exposure to industrial segment, which is Morbi. So this is not such big of a positive for this company, but these two are the ones which are surging in trade. This is because there is a margin benefit and there will be a volume benefit once this does come into picture, and that's why these stocks are doing well in trade today. So this is about the city gas distribution companies. It's like a relay now. Talk about Aster DM. Why is that in focus?
Well, let me take the baton from you. Well, we are talking about Aster DM Healthcare. Aster DM Healthcare, it's quite interesting. Company already changed hands. You saw the promoter go ahead and hike stake, after which you also saw an M&A action over here, where the company went ahead and acquired Quality Care Hospitals. So the company, right now has three main shareholders. One is the Moopen family, and then two private equity companies. Both, when you're looking at the private equity companies, it is actually Blackstone as well as TPG. Now, TPG, after the merger, held close to 9.9% stake in the company, which was a bit of an overhang on the stock, given the fact that 9.9% stake was something that was always on the block and along expected lines. Today, there was a large block deal that took place in this particular counter. Over 11% of equity has changed hands. It will be very important to see the disclosures that will come in post-market hours today. We know that the seller is TPG because CNBC TV 18 managed to access the block deal or the term sheet for this particular block deal. It's going to be important to see who the buyers are. You can see that this particular block happened at close to 770 rupees a share. But post which, there has been a very sharp recovery intraday in the stock, still lower by close to 1%. But the overhang of one large private equity player exiting is something that, the street will actually look at quite closely. But you've also been looking at Jubilant Encraver.
Yes, so there is an interesting acquisition that the company has made. It is a 40% stake in Zeta One Technologies, which is for 189 crore rupees. This is a completely cash transaction that the company has gotten into. Zeta One is an electronics design and semicon value chain company. It is into different segments, be it aerospace, be it defense, semiconductors, autos, medical and industrial sectors. And the company says that it will strengthen their presence in electronics and semiconductor manufacturing. Now, this is a thing that's happening in the chemicals industry. A lot of them are looking at semiconductors, chemicals manufacturing to cater to these segments, because this could be high margin business going forward for them. Now, remember, the company has already been exploring this particular space into high precision semiconductor chemicals, and this acquisition in particular will be completed in two tranches, first by November 2026 and the second by September 2027. Let's take a look at Zeta One's financials as well. It has been growing really well, from 51 crores in FY24 to 79 crore rupees, and almost double from levels from FY24 to FY26 at 98 crore rupees. That's a CAGR of 39% in last 3 years itself. So this values the acquisition at 4.8 times revenue, which is not very cheap going by the fundamentals of the sector. this current transaction is different from the current business. It is a diversification that the company is looking at. It is not an addition to the existing portfolio for the company, and this will be acquired as an associate. It's a 40% stake, so these numbers will not be consolidated into the overall balance sheet or the financials of the company because the stake is just at 40%. Now, there have been varied opinions, right? Some of them are saying, yes, it is a good segment that you're getting into, semiconductor chemicals. That's great. This could be a growth driver for you. But other analysts are of the opinion that would also mean that maybe you don't have enough growth drivers in the existing business, what the investors are currently valuing the stock at. And that is the reason why they're saying that this could not be a good acquisition, or maybe growth drivers are not existing in current levels. That's why the stock has come up from the highs of the day and a sharp fall, 2.5% lower in trade as we speak.
Well, thank you so much for that. 2.5% lower for Jubilant Ingredient. Well, we'll now slip into a short break. We'll get more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. It's been a heavy day with listings. End-to-end logistics platform Shiprocket listed with a premium of nearly 40% to its issue price. When he joins us with more details on this one.
Absolutely, a bumper listing, a rocket listing coming in for Shiprocket, 35% premium. The stock has seen an up move furthermore as well from that. And overall, the IPO was subscribed 100 times itself. So strong subscription that came in and a strong listing that's come in. Just in terms of details for the IPO, it is a mix of fresh issue as well as OFS. It was a 1,600 crore approximately IPO. Mainly, they're going to be using some amount of around 365 crores for platform investment and other will of around 200 crore for repayment of debt. Now, in terms of the business of the company, they have a core business which accounts for 73% of the revenue and the other emerging business accounts for 27% of the revenue. Overall, how is the revenue shaped up over the last few years in terms of financials? As of FY26, the revenue is at around 2,000 crores, which has seen a growth versus last year. But EBITDA, that's been a loss for the company versus last year, a slight bit of an increase in terms of the EBITDA loss, 59 crores last year versus 66 crores. Profits of the company, actually it's a loss that the company has been reporting as well. So that is something that we're watching out for in terms of the path of the profitability of the company from here on. Cash on book stands at around 53 crores for the company. Core business margins, they are at 12%, but the emerging business is still at an EBITDA loss. That's the major loss that is coming in here. So the key is going to be to just know how the profitability of the company moves on from here on. But yes, that's the update. Bumper listing as of now coming in for Ship.
Thank you so much, Winnie, for joining us. 58% higher as far as Shiprocket is concerned. And keeping with the trend of IPOs doing very well, Sudarshan joins in with a list of all of the IPOs that have so far not disappointed investors in 2026. Sudarshan.
So it's been a flurry of IPOs and so many companies have got listed on stock exchanges in the last few weeks. So I've tried to list out companies which have given very good returns and also some of the companies which have disappointed after the listing. So on top of the list is Indomim. Stock has almost doubled from the issue price. Remember, issue price was 485 and just day before yesterday stock had released Q1 earnings and after the stock has almost doubled and today it hit high of almost 990 rupees per share. Next one is Dhoot Transmission. Stock has moved 50% higher from the issue price of 870 and current CMP is more than 1300 rupees per share. Next one is Molbio Diagnostics. Returns of almost 40%. Issue price was 807 rupees per share. CMP is more than 1100. MV Electro, here also returns of almost 35%. Issue price was 425 and now stock is trading around 600 rupees per share. Milky Mist Dairy, returns of almost 30%. Issue price was 140 and stock has risen to as high as 182 rupees per share. Manipal Health too has given returns of more than 20%. Issue price was almost 590 rupees per share. Now stock is trading above 700 rupees per share. Two underperformers. Leap India returns are almost flat. Issue price was 159, CMP is 160, and last one, SBI Funds returns negative 3% down. Issue price of 574. Stock is now trading around 560 rupees per share.
Okay, so that interesting list. Thank you so much, Sudarshan, for giving us a sense of how these new listings have performed in the last couple of days. Talking about the IPO market again, Gaja Alternative Asset Management, 550 crore rupee IPO opened for public subscription today. Devyani is joining us to tell us more about this one. Devyani.
The Gaja Alternative Asset Management IPO opens for subscription today and it's a 550 crore IPO with a fresh issue of 450 crores and an offer for sale of roughly around 100 crores. Now the price band is set between 152 to 160 rupees per share, implying a market cap of 2,256 crores at the upper price band and an FY26 price to earnings of 27.5 times. Now 372 crores out of the IPO proceeds will be used for sponsor commitments as well as repayment of bridge loans, while 78 crores will be used for general corporate purposes. Now coming to the company itself, it is an alternatives AMC which primarily invests in the mid-market private companies. Coming to the financials, the revenue from operations came in at 136 crores in FY26, growing at a CAGR of 19% since FY24, and PAT came in at 82 crores, growing at a CAGR of 35% since FY24. Now, alternatives by themselves command premium fees, with Gaja's management fee rate coming in at 190 basis points versus regular mutual fund players which earn anywhere between 37 and 52 basis points on a blended basis. Now this is because alternative investments carry higher fees by themselves, but keep in mind the earnings mix is what is a key monitorable for the company. This is shifting, with FY26 management fees coming in at 60 crores while the carried interest income came in at 75 crores for the company. Management fees as a percentage of revenue has also fallen since FY24 2024, which was at 79% of the revenue versus 44% in FY26 itself. Now, carried interest is based on the actual realization of fund investments, which makes them lumpy in nature. So this is a key monitorable for the company. Now, other key risks include the dependence on successful private equity exits for the company and the carried interest volatility itself, and the ability to raise large funds going forward. Along with that, also the increasing competition with the biggest mutual fund AMCs all looking to grow their alternatives business going forward.
Thank you so much for joining us with all those important details about this new company that is coming for an IPO. With that, we'll do one thing. That's we'll wrap on this edition of Midcap Radar. Do stay tuned, your stocks, when we return to answer all your individual stock queries.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny. Along with me is my colleague Arundhati as well. Arundhati, good afternoon. And seems like a bit of midweek blues are coming in for the markets. Not much of an action-packed day. 24,000, we're holding on to that level. As of now, we're trading with cuts of almost 100 points for the Nifty 50, which is at 24,050 for the Nifty 50 to be precise. IT, that's the one that's managing to hold on to gains on the trading session. So saw a very good recovery from the day's lowest point as well, which it touched at around 11. And then we saw recovery, now 0.4% of gain coming in for the IT pack. Broader end of the market, that has also seen a recovery from the day's lowest point. But again, the small cap side is seeing a bit more of a pressure versus the mid cap. Mid cap is down 0.1%. The small cap was significantly lower and trade down 0.4% as well. So that's what it's looking like as of now, Arundhati. More declines than advances in today's trading session, but 24,000 is what we're managing to hold on to.
Absolutely, Vinny. Hi, good afternoon. It's a lackluster day of trade, to say the least. The Nifty managing to hold 24,000, but barely at this point in time. We've got the IT pack, as Vinny pointed out, doing well. Realty managing to stay in the green, but every other sectoral index is in the red. And if the market's shut, if the Nifty closes in the red today, it'll be the 7th straight session of losses. But let's get down to answering all of your stock queries today. Joining us to do exactly that is Asta Jain, research analyst at Haim Securities, and Somil Mehta, the head of retail research at Mirae Asset Sharekhan, to answer all of those stock queries. Now, the first query coming in from Balasubramanian, who's writing to us from Bangalore. He holds 200 shares of Mukund at an average cost of 202 rupees. He is a long-term investor and wants to know whether he should hold or sell and switch to a good auto stock. That's the question he has. He is making a loss on this. Asta, let me come to you for the fundamentals on this stock. Mukund is the one he's holding, making a loss on it. And he wants to know whether he should, he is a long-term investor. Should he continue to hold or should he sell and switch to another stock now?
Good afternoon to everyone out there. So talking about Mukund Limited, Mukund is basically a Bajaj Group company, and it basically specialized into the specialty steel and the heavy industrial machinery. Now, the major attraction of Mukund Limited as of now is that they have signed some deal in July 2026, and in which they are selling 9 acres of land at Kalwa, which is near around Thane. So, and the deal value is around 500 crores, 500 to 506 crore. Now, this transaction becomes very important because if you see Mukund Limited itself, I mean, the market cap is not very high. It is only around 2,000 crore. So I think this deal will definitely help the company in reducing its debt, because they can use this money in reducing the debt, as well as maybe they can go for the expansion. So I think this is one of the major development on the basis of which I would like to recommend just hold for this counter, at least for some time. So rather than incurring losses at this point of a time, hold this counter, let it rise high, and then try to exit from this counter. Stay invested is what we are recommending for this counter.
Okay. On the fundamentals, Asta is saying stay invested for this one. Afternoon, Asta, as well as Somil. But Somil, on the technical front, how is this one looking like? Because every time I see it go up, that fall also comes down very fast for Mukund Limited. So 134 is the buy price. 204 is the buy price, and 134 is what the stock is trading at. What should they be doing?
Yeah, I think afternoon to everyone. I think the stock is in an uptrend for a little while now. However, in the last 1 year, since mid 2025, it has been in a consolidating range, very broad range. 114 is the lower end and the upper end is 160. So it's a broad range. Now, I am expecting this range to break on the upside. The breakout is around 150, 155 levels. So that is a breakout level. I will hold on to the stock with a stop loss of around 113. Keep a stop loss around 113 and keep holding it. I think the stock target would be around 190 plus, and I'll be positive on it.
And technicals, positive on the stock there. Keep an eye out on the levels that Somil mentioned as well. Let's move on to the next query then for today. We have Nandan Kumar, who's writing to us from Bangalore. He is holding 200 shares of SJVN. Price is 103 rupees per share. Long-term investor. What should they be doing with SJVN? Asta, does it merit holding it at the levels that they bought, or maybe sell this one? They're making some bit of a loss on this one.
So now SJVN, although it was into the renewable energy system, but now it has started, diversifying into the other things as well. So firstly, it was into the hydropower generation, but now, apart from that, now their portfolio is consist of like solar, wind energy, transmission, thermal, etc. So I think that is one of the major focus of this company. And another is the type of capacity expansion which this company is doing. I mean, they are currently operating 4.2 gigawatt of operating capacity, where the portfolio value is around 21 gigawatt. Out of this, I think this portfolio value is very, very strong, and it will generate a strong revenue to the company because of the kind of revenue visibility we can see from this kind of, portfolio generation. So my idea here is it is a good long-term story to believe on. In the short term, we might not see so much rise in the stock prices. Here, losses are huge. So if someone is ready to hold for at least 6 months time duration, then I suggest holding this counter.
So you'd suggest holding this counter, and he is a long-term investor, so that probably is a possibility, even though he's making a loss on the stock now. You believe in the long-term story of this particular counter. Somil, what's your view on this? Should he continue to hold at the current price that he's bought it as? And, any levels that he needs to watch out for?
Yeah, I think I would hold on to this stock. We've seen a very good rally since 2020 from 20 rupees to around 150, 170 levels. Now, 61% retracement is already done. Very sharp correction we've seen in the last couple of years. I think the lower end is around 60, probably 55 levels, but there is no point selling it now. I will be positive in the long term, and I'll be expecting higher targets for the stock. So I'll be positive, and you need to be a little patient. Probably it will take a couple of years more, but the stock looks good in long term.
So the stock looks good in the long term, and you have to be patient at least for a couple more years. That's the view there coming in from SJVN. The next query is coming in from Vinay, who's writing to us from Pune. He holds 200 shares of BEL at 423 rupees a piece, and he wants to know whether shifting to CG Power or CAMS will be a better option. He is making a loss on that stock. Astha, what's the view? Yesterday the government also came out with their indigenization list. BEL finds a mention in that. Should he continue to hold BEL at the current price?
Yes, because what happened, like BL is one of the electronic backbone of India's defense, indigenization program, which even you have talked also. But the latest results, they were okay, but they were not so exceptionally well so that they can suggest the kind of valuation which it is driving right now. So I think that is one of the major point that why we are not seeing BL performing so strongly on the bourses because of the kind of valuation it is quoting right now. But still, I believe it is one of the best defense businesses, and they have got very strong manufacturing capabilities. The only problem is the kind of numbers they are posting. Growth is not very, very high, which justify the valuation. But order book of around 72,000 crore itself is looking very strong. So idea here is rather than exiting out from this counter, just book partial, just exit partial quantity and make entry into the CG Power, because CG Power is somewhat related to the business of the company of BEL. But CAMS is entirely a different sector. So right now, if anyone wants to exit, then just exit partially, not fully.
Okay. Exit partially, not full exit, and CG Power, Astha. That's what you're saying. But see, Astha, CG Power, even after this run-up, it's not looking expensive?
Yeah, it is expensive, but I think the kind of story the stock is quoting right now, maybe at the dips, not right now in the market, but maybe at the dips, CG Power is recommended.
Okay, thanks so much for that. On the technical front, Somil, BEL, Vinay has bought it at 423 rupees. Other suggestions that he wants is exit this one, CG Power and CAMS. What do you like out of all of this? Would you look at CG Power, CAMS? And CAMS is one of the stocks, 24, 25, we saw that amazing run up. Then it's come off a bit. What is your suggestion?
Yeah, like all three stocks. I would definitely like all three stocks. But I would not exit BEL. BEL is one of the top picks I would have from the defense pack, and defense is doing really good. So I would expect BEL to, outperform, all these stocks actually. Of course, it would take a little bit of time. There would be a time-wise correction around, 400, probably 380, 360 levels, but that would be a buying opportunity in the stock. So I'll be positive on BEL.
Okay, and CG Power and CAMS also. Now, since you like all three, give us the levels also. Maybe the viewer, if they're looking to enter and have cash to deploy, then they could add that also.
See, CG Power in the very short term, I'm a little negative. And I would be expecting the stock to go down till at least 800 levels, maybe 780 levels, but that would be a buying opportunity. But revisit the stock around 800 levels, and then once you get a reversal point there, then you can enter the stock. CAMS is creating a triangle pattern, and I'll be expecting this triangle to break on the upside. The breakout levels are around 840, 850 levels. Once that breakout level happens, I think there will be a very big run up for CAMS, but I will wait for the breakout. Don't hurry up on it, because even the markets are a little shaky right now. So wait for breakouts. Don't hurry up on any stock.
Okay, wait out for the breakouts. Just do not buy and enter into it. And at the levels Somil has mentioned, maybe you can revisit these stocks. Thanks so much for that. But on that note, we're going to slip into a very short break. We'll come back with more of his stock-related queries after the break. Stay tuned in.
Welcome back to Your Stocks on CNBC TV 18. We still have with us Astha Jain of Hem Securities and Somil Mehta of Miri Asset Sharekhan to answer all of your stock queries. Now, the next query is coming in from Augustine Thomas, who writes to us from Bangalore. He holds 500 shares of Kalyan Jewellers at 570 rupees, and he wants to know whether to hold, sell, or add more. He is making a profit on the stock. Astha, you know, the stock doing well, the company doing well, seeing strong demand despite higher gold prices. What's your fundamental view on the stock? Should he continue to hold, sell, or should he add more at this point?
So now the Kalyan jeweler has totally converted from a traditional retail jewelry retailer to, FOCO model, which is franchisee owned and company operated. And this is one of the major attraction of this company. What is another focus point of this company is its same store sales growth, which is around 28% and which is very strong despite the fact that company is continuously opening new stores. Candere is another focus point of the company where we have seen a very, very strong growth of more than 100%. I think on the basis of all these things, even the results were good. The only problem is with the margins. So margins were in pressure, and that is why we have seen that markets were somewhat not very much happy with the numbers. When the results came, the stock was down also. But my idea here is that this is one of the good long-term story to play upon, because now the company's focus is entirely on deleveraging its balance sheet, capital efficient expansion, cash generation, which the company is focusing. So on the basis of these parameters, one can make fresh entry also, but at the lower level of around 570 and remain invested in the stock for the price target of 650 at the initial levels.
Okay. Point taken there. But on the technical front, Kalyan Jewellers, how is it looking, Somil? You know, they bought it at 570. Does it merit continuing to hold this one? They want to look at adding more also. If they want to add, at what levels maybe they can look to add also?
Yeah, I think Kalyan Jewellers' long-term trend is up, and I would expect the trend to continue. We've seen a very good run in the recent times. In the very, very short term, I'll be expecting this stock to, time-wise correct or a little bit of correction towards 550 or probably 540 levels. That would be a right time to add more if you want to add in Kalyan Jewellers. My view would be positive. Buy on decline should be the strategy.
Buy on declines is a strategy on the technical front as well, and positive view coming in there. But next query for today, let's move on to that then. We have Mukunda, who's writing to us from Bangalore. He's holding 200 shares of Shriram Finance with a profit of around 10,000 rupees. Now, they've not said the price, but they've given the profit that they're making on this one. So what, should they continue to hold this one or sell? What is your suggestion on this one, Astha?
Shriram Finance is a hold from my side, because what we know about this counter, I mean, I'm just highlighting, some uniqueness in all the stocks we are discussing in order to just justify my statement why I'm saying hold. So in this counter also, this is one of the counter which has an ability to lend, and that to profitability to the underserved or self-employed customers, where the other traditional banks, don't go. So this is one of the key focus of this company. And another key focus, I think, is the commercial vehicle segment, which it is catering, and it differentiates it from the big Bs like, Bajaj. So my idea here is Shriram Finance is one of the very strong NBFC story. If anyone wants to continue with the NBFC space, it is one of the major, or the biggest player, or my choice is goes with the Shriram Finance in that space. Idea here is just to stay invested in this counter, and maybe buy on dip strategy is also recommended at around the level of 1,080 to 1,070. Although price target can be kept at around 1,180 to 1,200 at the initial levels.
All right, so stay invested. That's the advice coming there on Shriram Finance. Somil, what's your view? Would you also recommend that the viewer continues to stay invested in his holding, or should he sell at this point?
I think hold on to it. Definitely, I'm very positive on the stock. On the upside, my medium-term targets are still around 1250, maybe above that. in the last 12 months, the stock has gone from 570. Now it's trading around 1100, so almost 100% returns. Now I'll be expecting this trend to continue. Very recently, probably a couple of months back, it broke out of a huge triangle pattern and it has started a new move on the upside. So I'll be expecting this trend to continue for a target of at least 1250, probably above that.
All right, so that's the view coming in there for Shriram Finance, and that's stay invested. The next query is coming in from Raj Agarwal, who writes to us from Bangalore. He holds 450 shares of Suzlon at 62 rupees, and he is making a loss on this. He wants to know whether to hold or whether to sell at this point in time. Asta, how is Suzlon looking from a fundamental point of view? Do you think he should book his losses or continue to hold at this point?
Partially exiting is what I can recommend. So partially booking profit is what I can recommend, because here the problem is with the valuation. Although this company is now is on the path of deleveraging its balance sheet, they have got a very strong order book of around 6.1 gigawatt. But the problem is with the kind of loan or debt we are seeing on the balance sheet. So that is what is a major concern right now. And my idea here is that partial exiting is a better choice in this counter. So just exit or book losses partially, not fully.
Exit or book losses partially is what you're suggesting on the fundamental front, given the current scenario of the debt that is there on the books as well. That's interesting to watch out for there. But on the technical front, Saumil, what would you suggest? The viewer is making a loss. So should they just completely exit, hold, average? What is the options?
Yeah, I think Suzlon, it's in a downtrend. In the last couple of months, it's been making lower tops, lower bottom. Previously, there were a couple of tries of, bouncing back towards the 200 daily exponential moving average or the previous swing highs in the quarterly, monthly charts, but it did not sustain. And that's where I don't like this trend at this point of time, and I'll be bearish. And my targets probably would be around 38. So my suggestion would be to exit and probably go into some better stock or sector.
Okay, point taken there, Saumil. But Saumil, as well as Asta, that was the last query for today. So thank you so much for joining us on the show, as always, helping our viewers get answers to all their stock-related queries. A quick check in terms of the markets, because in the last 15-20 odd minutes, we've seen a bit more of a fall coming in for the markets. Now 24,030 is what the Nifty is trading at. Day's lowest point for the Nifty 50. It's seeing a bit more of a fall as well. And obviously, we're seeing a fall coming in names from the broader end of the market as well. So let's watch out for that. But with that, we're absolutely out of time on this edition of Your Stocks. Remember, you can always email us your queries or send it to us on the WhatsApp number that's flashing at the top of your screens for you all. So do send us your queries. We'll get them answered. Thank you so much for tuning in. Up next, your closing bell.
go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
We're seeing Taiwan index that's down 1%. Hang Seng is trading with cuts of around 0.5%.
Definitely, there'll be some sort of expansion that's going to be required if we're going to continue to grow the way that we're growing.
They have introduced Adani ports after the recent correction.
The bell has gone and the first tick on the Nifty is absolutely flat.
In the short term, of course, we have a very uncertain demand environment.
We will see growth move up from low single digits to mid single digits.
The emerging business, which was 41% on 25 and then 65% in 26.
The Nifty at the day's low, it's a 0.4% loss today.
Pre-war oil price and a post-war oil price, we are still not completely out of the crisis mode.
We had over 100 IPOs last year. We have now reached 54.
Bad times before it gets better, as I always say. So I think we're going through that turf at this point in time.
Again, today we are talking about markets being at the lows. It's almost a 500-point cut in last 1 week that we are seeing.
Well, that was the day so far. You're with us here on a fresh new edition of Closing Bell, live from the CNBC TV 18 Motilal Oswal studios. I mean, it has been a pretty dull day, down 100 points once again. And I think this is the 11th or the 12th day where the market has been just breaking down lower highs, lower lows, and not very much else which is going on. I mean, you know, activity is quietened down. And, you know, I said this 2 days back, result season behind. And no real big triggers in that sense, and of course some amount of escalation with oil up, etc. So activity levels has certainly quietened out quite a bit. Today, of course, is also Wednesday, which means that there's no expiry. So in any case, the last 30-minute action because of cash, etc. perhaps a little flat out. With me, my colleague Nigel. Nigel, hi.
Well, hi, Prashant. Indeed, that's sort of a lackluster day, but I think the markets are in wait and watch mode, right? Hopefully, there is some kind of taco, so hopefully there is some kind of a pullback. For the time being, crude oil prices at $92 per barrel mark. The cues that we got overnight and the commentary as well, that's what's making the bulls a little bit skittish. But I think this 23,950 mark is an extremely important mark on the downside. We have been moving one way, that's south. You need to hold on to that level, which is going to be extremely crucial.
Okay, well, 91.5. You want oil down, not up. But lately, of course, we've had the opposite effect coming through. Let me just quickly run you through what's lined up here. So we are around 24. I think we've given up 24,100, 24,40 or so on the Nifty. Oil prices at the margin, of course, sentiment negative. IT, real estate stocks are the outliers. End-to-end logistics player Shiprocket has made a strong debut, and we'll talk more about this one. It's up 50% from the IPO price. And actually, there's another listing as well, which is also doing very well. So the primary market buzzing. The government plans for a higher allocation of PNG to city gas distribution companies for domestic use. As it looks to me, rising household demand. Stocks are up about 2-3% across the board on your screen now. And IT, Midcap IT is doing well. CLSA expects, smaller companies, better place. They've downgraded some of the larger companies in that particular space. So Coforge, etc., they liked for a while. We'll get you more details. Well, I think Mitesh is with us with what he wanted to do as far as individual trades go. Mitesh, good afternoon. Good to have you with us here. What would you recommend?
So on the stock side, Prashant, I have one buy and one sell, but before that on the index, yesterday I talked about 24,200 and below that we could possibly go to 24,000 or, worst case scenario, even 23,850, 870 zone. So I think we're close to 24,000 now. As you were rightly highlighting, we've been now having a lower low and lower close for many days now. So it's kind of a bit oversold market as well, but no sign of a reversal yet. So I think no point going aggressively long on the Nifty just because it's declined a bit. We're still not sure whether we'll get a reversal or not immediately. On the stock side, though, I have a buy and a sell. A buy on Dalmia Bharat Cement with a stop at 1839 for targets of around 1920. and sell on Cipla with a stop at 1440 for targets of 1375.
Got it. Okay. All right. Got that. Thanks a lot for that, Mitesh. Well, let's focus on the IPOs then. The new IPOs continue to deliver strong returns with several recent listings trading well above their issue prices. Sudarshan breaks down the key winners. Sudarshan, take it away.
If anyone has got the allotment in the recent IPOs, he or she would have made huge returns because most of the companies listed in the recent past, in the last few weeks, have seen major returns. And most of the companies, except few exceptions, have seen returns of more than 20%. On top of the list is Indomim. Stock has almost doubled up 100% from the issue price of 485. Today's intraday high was of 990 rupees per share. Next one, Dhoot Transmission, up more than 50% against the issue price of 870, and today the stock has crossed 1300 rupees per share. Molbio Diagnostics, returns of almost 40%, issue price was 807. Now trading above 1100 rupees per share. MV Electro 2 has seen returns of more than 35% from the issue price of 425. And now Milky Mist Dairy, returns of more than 30%. Issue price was 140 rupees per share. Now the stock is trading around 200 rupees per share. Manipal Health as well has seen returns of more than 20%. Issue price was 590, and now stock is trading above 720. The stocks that have underperformed or have given flat returns, Leap India, returns have been almost flat. Issue price was 159, and current price is also around the same level. SBI Funds, negative returns of around 3 to 4%. Issue price was 574. Now the stock is trading around 550 rupees per share. So overall, it's been most of the companies have given more returns than the few ones which have disappointed.
Okay, all right. Thanks a lot for that, Sudarshan. If someone got allocated on quite of these names, well, they would have been quite happy. But the start of today is the end-to-end logistics platform, Shiprocket. It listed a premium of 40% to its issue price. Well, we spoke to the management earlier today to understand what can they guide in terms of a growth strategy going ahead. Let's listen in to what they had to tell us.
Essentially, every piece of revenue growth that we see will keep adding to the bottom line. We are not, folks, we are not just looking at this 2 lakh base or a 6 crore vision, but our aim over the next 5 years to get to a million plus MSMEs, and that is the number that we want you to, we want to tell you that we are all committed for and we want to go for. We will continue on sustainable growth. We said that we will continue to be ruthlessly frugal, and we said that we are going to be absolutely transparent, and we're going to stay true to that.
Okay, well, that is the Shiprocket management talking about the listing and what their guidance is for the future. Ashish Chaturmurthy is Managing Director and Fund Manager at JM Financial. Ashish, good to have you with us here. Any thoughts on these listings? There is, of course, Shiprocket. Well, there was Leap India, which came to the market, and some of the others which Sudarshan highlighted.
Hi, Prashant. Hi, Nigel. So I think, yes, as far as Indomim is concerned, a very good precision manufacturing player, where we expect the segment to grow almost 30 to 40%, at least for the next 5 to 7 years time frame. And the kind of gross margins and the EBITDA margin this company has been making clearly shows the kind of, edge they have in terms of the manufacturing practices. And our belief is the moat is on the sourcing of the raw material, which will make Indomim a very, very attractive place. So definitely the stock has run up post listing. Maybe some consolidation here and there could not be ruled out, but our belief is this is one stock which has a potential to deliver a very strong set of returns, considering the kind of ROE, ROC it is going to make, the kind of top line EBITDA PAT growth it is going to show, and the way aerospace industry is growing at 35 to 40%. I think Indomim is going to be the biggest beneficiary of this mega trend which is emerging in this sub segment.
Okay, all right. By the way, just keep an eye on a couple of stocks in the broader markets. Neel Kamal actually is another stock that I think Jay Bala had spotted a couple of weeks ago on our show. He was talking about the trend looking good. For the time being, I'm guessing it's the trend itself, because Neel Kamal Plastics, it's up more than 10% with a 3% move in this hour itself. So let's get that one up for you on the screen. Yes, that's the one that we're talking about. Let's turn our attention, though, to the IT space, CLSA. has issued a note on the tech sector. They expect mid-cap IT companies to better navigate the technology transition in comparison to the large-cap names. Rima joins us to fill us in with all of those details. Rima?
Thanks so much for that. So CLS's main point is that this technology transition is going to create winners and losers. And the winners are going to be the mid-cap IT companies better positioned to navigate it. They're better placed to take advantage of the changes, stronger management, execution, and the ability to pivot faster, which is why CLSA maintains a high conviction outperform on both Persistent and Coforge, and they've got an outperform rating on Hexaware and LTIMindtree. But for large caps, they say the picture is tougher. They are dealing with AI-led deflation in their legacy business, and plus there are macro headwinds. One of the key takeaways is, and by the way, for the large caps, they've also downgraded a TCS, Infosys, Tech Mahindra to a hold, while Wipro and Mphasis have been downgraded to an underperform. But I think this part is the most important part of what CLSA has to say. I think everyone's dealing with the question is about this AI inflation. When will the net benefit from AI offset the net loss on account of AI? And CLSA's view is that AI volumes could supersede the deflationary impact by FY30 only by FY30, which basically means the industry could be stuck in a period of subdued growth before AI volumes are large enough to offset the revenue deflation. Remember, FY24, 25, 26, FY27, they all have been low growth years for the company, and now CLSA is saying that this could extend till FY30. Look at the numbers now. And for the first time, we have a brokerage calling out the kind of AI revenue contribution. So currently, for the large cap IT companies, AI is about 6 to 10% of their AI revenues, of the total revenues. According to CLSA, this goes up to 30-35% by FY31 in the next 4 or 5 years. And only when that happens will the revenue growth for the large cap IT companies expand from low single digits, from a 1.9%, a 2%, it will go up to mid single digits. So basically, double-digit growth rate is not in the picture. So the message is very clear. The opportunity is real, but the gestation period is going to be very long. The industry will have to wait till at least FY30 as it moves from low single digit to mid single digit kind of a revenue growth. Valuations, they say, are fairly it's balanced. Risk reward is favorable. There are 3 structural headwinds though. One is GCC. They're not gaining market share over global peers, and services are losing out to hardware and software companies on account of the global AI rollout.
All right, Rima, thanks a lot for that. Ashish, tech, how are you placed out there? What do you like, basically? Give us a few stock names.
So, Nigel, obviously the preferences towards the mid-cap IT companies because the way they have been growing even in a challenging environment, and our belief is they are going to see double-digit growth even in coming few years. So, our belief is companies like Persistent, Coforge are going to see 20-23% kind of growth rate. And keeping this in mind, even at current valuation, it looks like from a PEG perspective also the valuation looks reasonable and the growth looks quite promising. The one reason is obviously these companies, the mid-cap IT companies, they can shift resources towards AI, data, cloud and digital services much faster than its large cap peers. Second, obviously their exposure to these legacy services is much lesser. So they can increase their exposure to the newer technologies much faster. And our belief is that this overall the revenue base is quite small. And if there is a new client addition, or let's say there is a new AI offering, then a percentage growth could be much larger. So obviously they will look very growth oriented as compared to the larger sets. So our belief is Persistent, Coforge, these are the 2 names which can significantly outperform the larger peers.
Okay, got that. The other story that we want to just sort of quickly put out, of course, is City Gas distribution company. Stocks are up. Government aims to accelerate household PNG rollout and plans a higher allocation of PNG for domestic use. Sonal is here with the details. Sonal, so tell us what the plan is, but also, right, what is the profitability on for these City Gas distribution companies on PNG as opposed to CNG? Because I think bulk of the money is made on CNG, right? PNG is far less profitable.
It is, and it is far less in terms of volumes as well. So these two companies, basically MGL and IGL, which have a bigger chunk in the PNG economy, have around 11 to 12% of volumes only coming in from PNG. But the relief here, or maybe the stocks why they are rallying, couple of reasons here. First, quarter one was quite weak for them. Their margins did see a big decline because of how they had to import LNG, which was at a much higher prices because of West Asia crisis. Second was there was no indication of how they would improve on volumes from here on, right? Because yes, CNG adoption is increasing, but it was not increasing at the level which was expected, because EVs have become a competition now for these CNG producers. So the relief is 200 SCM of APM gas or domestic gas will be allocated to PNG now. Yes, it is not higher in margin or volumes, but it is a sentimental relief considering that these stocks are also trading at lower valuations. For something like an MGL, it's 11 to 12 times now. IGL is 16 to 17 times now. So this is a relief rally as well that we are seeing currently. Secondly, it would also mean that their margins will see an improvement because APM gas or domestic gas is priced cheaper versus imported LNG. Imported LNG will have a lot of other costs which will be added to that as well, right? So margin improvement is what we are expecting because of this. And the second thing is, of course, volumes will be higher because remember, after the LPG crisis, government has been trying to push for more PNG volumes, right? So that we are not dependent on imported LPG. And that's one of the reasons why we are seeing this rally on these two names, IGL and MGL only, because Gujarat Gas has most of its volumes from industrial customers, not even CNG or PNG. Hence, these two are the stocks which are benefiting today.
Okay, all right. Thanks a lot for that, Sonal. Well, Ashish, any of the city gas distribution companies on your radar?
So yes, I think this government will provide this 200 SCM of cheaper domestic, gas for every new PNG connection. And obviously, the objective is to increase the PNG connection to 3x from current levels and almost make it 4 million this year. Our belief is that because of these cheaper domestic gas allocation, this could improve CGD's margins significantly and accelerate the overall PNG penetration. And our first preference would be towards MGL, which is much cheaper as compared to IGL at 11 times multiple. It looks like MGL at least can see a very strong sharp recovery as compared to IGL. So MGL as a tactical bet looks quite promising.
Yeah, as a tactical bet, looks good. So that is Ashish's view at this point in time. Just take a look at what else is going on in the broader space. I mean, it's actually a clean 2:1 knockout with more stocks down than up at this stage. And actually enough volumes on the downside as well. So it's not as if it's one or two names with large volumes, but across the board. CG Power, I mean, but point is stocks have generally all done so well. You look at the stock, look at some of these names, right, through 2026 so far. CG is down 3%, is up 35% this year so far. There is Adani Energy Solutions, one of the top volume-led losers today. It's up 50% this year so far. There is Hitachi, which is down, I think, 5% today. It's up 80% this year so far. So, NetWeb is at number 2 in terms of volume-led losses today, 5.25% lower. It's up 60% this year. So it's just pullbacks. I mean, that is the essential, backdrop for some of these names. Defense, Ashish, do you have a view? And anything you like in particular?
Yes, so overall defense as a space is looking quite promising, and particularly companies in the larger cap space like HAL is coming out of a very long consolidation phase because of the very strong execution capability which can be seen in the next few quarters. And our belief is now the challenges with regards to some of the supplies has also come down. So HAL is our top pick in the large cap space. Apart from that, data pattern in the mid cap space is looking quite promising because the way the company has been growing at 22% CAGR in terms of top line for last 3 years, and its profit growing at almost 26% CAGR. Order book to bill is close to 4 times. So this is also giving very strong revenue visibility for a company like data patterns. And something like solar industries, where we are seeing the overall concentration of defense in the overall business is going up significantly, and this is getting reflected into the margin profile as well. So our belief is that a top line of almost 18,000 crore in the foreseeable future is one thing which will keep the stock on the positive side. So yes, HAL, data pattern, and solar industries, these are the top picks in the entire defense space.
Interesting. All right. Thanks a lot for that, Ashish. Have a good remainder of the day, and we appreciate you giving us those views as well as we take note of those defense companies that you're talking about. Take a break. When we come back, our Alpha Manager of the Day, Gautam Dugar of Motilal Oswal Financial Services, will be joining in. Stay tuned. Well, Bank of America's latest global fund manager survey with 203 participants managing a combined $581 billion was conducted between August 7th to 13th, and the findings are in. So where's the smart money betting and what got the allocators worried? Well, Hormuz joins us to fill us in with exactly that.
A very interesting survey that is coming from BofA, the monthly fund manager survey that comes out. And while the markets are in a period of uncertainty, what happens next? The bigger takeaway is the fact that this is the third most bullish survey of investor sentiment since 2022 is what BofA is saying. And that is because the cash levels among the fund managers has now declined to 3.5% from 3.6% last month. And the global equity allocation has now surged to the highest level since November of 2021. And that's because fund managers managers are now overweight on equities for 14 months in a row. Now, what is the consensus that has come in among these participants who were surveyed for this? The fact that there will be no macro landing, no hard, no soft, there will be no Fed rate hikes, there will be no AI capex cut, and the Democrats will not sweep the midterm elections is what the consensus has come out for. Now, the first question, where is the global economy headed in the next 12 months? 56% say there will be no landing, 34% say soft landing, and only 4% are expecting a hard landing for the global economy. The second bigger question that is bothering the global markets, will the US Federal Reserve hike interest rates or not? 22% say yes, 72% of them say no. The third bigger question, where are the oil prices going to be? They are above $90 right now. The average price consensus that has come out is that by the end of the year, prices will be at $76 a barrel. But take a look at the price range as well. A majority, 42%, believe that it will be between $70 to $80. The third believe that it will be $80 to $90. 13% of them expect it to be further down between $60 to $70. But there are a few who are hawkish as well. 6% believe that they'll remain in this $90 to $100 range that they currently are in. And of course, there's a small fraction that expects the prices to either go as far below as $50 or well over $100 as well. Now, the question being, what happens to whether if the Democrats sweep the midterms, what happens to the market in general? For stocks to go, for bond yields to go up and stocks to go down, that figure is around 37%. For bond yields to go down and stocks to go up, that's a 17% figure. For bond yields and stocks to both go down is 16%, and for both to go up is a 9%. So that's a small fraction who expect both of that to take place simultaneously. But where is the most crowded trade right now? And surprisingly so, it is long global semiconductors. That is still the most crowded trade, more than 50% here. Short the yen, long the Magnificent Seven, long global banks, short treasuries, long EM carry trades. Of course, they are some of the other crowded trades here as well. And lastly, the biggest risk that comes in for the global market, of course, is the AI bubble. A disorderly rise in bond yields is a new entrant, mind you, and 27% of those believe so. A second wave of inflation, geopolitics, a sweep of the Democrats in the midterm elections are, of course, some of the other tail risks that the fund managers are seeing. But the third most bullish survey since 2022, and the global equity allocation at the highest level since November of 2021.
All right. Well, thanks very much, Harmas, for that. Gautam Tugar is with us, Managing Director, Head of Sales Institutional Equities at Motilal Oswal Financial Services. That Moti Conference, annual global investor conference wrapping up. Gautam, good to have you here as always. Let me start with, we'll ask you about the feedback and what stood out, etc. But the one conversation which was the most well attended at the conference over the last 3 days, Gautam.
Hi, Prashant. Thanks for having me. So there were multiple conversations, Prashant. It's very difficult to pinpoint. Almost all our 14 CEO tracks were super packed. But I saw the interest levels quite high towards manufacturing related CEO tracks. So names like Dixon, Ecos, they've seen massive interest. Then, of course, financials. We had HDFC Mutual Fund, AMC, and Shriram Finance. And then some of the non-listed ones also, like we had the promoter of Balaji Wafers talking about his journey from 1982, his humble beginnings, and how he's made it into a 35,000 crores enterprise. So clearly there was wide interest across variety of segments and companies which presented at CEO Track, and of course for the 180 plus companies which did investor meetings beyond CEO Tracks.
But I mean, the two things which you kind of stood out, right? Manufacturing, huge interest, and AMCs as well, right? Yeah. And of course, a bunch of others, but these are the two which stood out.
Manufacturing, let me put it let me put it in a bracket of three: manufacturing, industrials, and manufacturing/industrials, financials, and consumption discretionary side. Within financials, obviously, there's more interest on the non-bank side, which is also what is reflected in the allocations that you see in the way portfolios have evolved in the last 6 months or last 12 months. So clearly, a lot of interest on the non-banking side in financials, be it capital market names, be it the lending NBFCs, is tremendous interest out there. And of course, from the recency effect is also playing out. The quarter that has gone by, both cohorts of NBFCs, lending as well as non-lending, have delivered close to 30-32% earnings growth.
All right. Hi, Gautam. Good to see you in. Well, you know, that I think Balaji wafers, I think there were wafers on the table as well at when the promoter was addressing the people. I think they were quite yummy. That's the feedback I got.
Much more than wafers. Yeah, almost all their products were there.
I'm wondering what happened when the alcohol beverage
much
companies came on
wafers.
stage.
So there are alcohol beverage companies representing in the conference, and they have their whole portfolio displayed in the meeting rooms too.
Cheers to that then. You know, what else? What are the big fears? What are the risks? You know, it's sounding like mood was upbeat with the kind of participation you got at the conference. But, you know, what's the fear? It seems that earnings are coming back. Flows are coming back. In fact, you know, my colleague Horma just put out a BOFA survey that says India is actually slipping in the rankings. So sentiment isn't good, but it appears fundamentals were at least appearing to come together. So what are the big risks?
So clearly, Nigel, fundamentals are improving both on macro and micro side. As you mentioned, the corporate earnings season was pretty good too. Again, I think the fear is more on the global side, which is geopolitics, crude oil, how things shape up on the AI front, regional AI trade, the usual fears that we have known for the last 6-12 months. What has changed at the margin for India is clearly we have seen some improvement in macros, and earnings growth is making a comeback after 2 years. That is what is there in your control as an investor. You look at bottom-up ideas. There are a lot of ideas which are doing well, which have reported good set of numbers, have good growth visibility, and they're guiding for very good FY27, FY28. From a top-down perspective, if you focus only on index, you will see disappointment written all over it, because Nifty has now virtually gone nowhere in the last 2.5 years. And clearly, from a Nifty 50 perspective, companies which are representative or constituents of Nifty 50, there the growth has been slightly subdued, especially segments like consumer staples, segments like IT or big pharma. So index is not giving you a true picture of the underlying sort of action that we have seen in the non-Nifty index. So if you look at Nifty 150, Nifty 250 small cap, clearly there is a lot which is happening. And its story, and like we had discussed in our previous conversation also, the story is clearly beyond the top Nifty 50 names and maybe even top 100 names, because segment after segment, cohort after cohort, you are seeing growth getting divergent. In the same space, there are companies which are representing or demonstrating 10% growth, and also companies which are delivering 30% growth. So clearly the multiples which are available in the market are at the two extremes. You know, what is not growing about 10-12%, there's absolutely no floor on their P. Some of the very high profile blue chip names have made new lows today. And similarly, companies where the growth is upwards of 25-30%, I think in the short term at least, I don't see the investors are ascribing any cap on the P. So this divergent nature of the market with different segments, different sectors, and even within the same sector, the dispersion in earnings and consequently the multiples is quite high.
Absolutely. Gautam, you know, just if you want to weigh in on some of these are individual names, right? But if you've heard anything or if you've got coverage on the research side, there's Shiprocket, right? It's rocketing up 35-36%, which is listed today. You know, we had Milky Mist. Again, I mean, a consumer business, but I mean, you know, the chatter around when the time the IPO came was it's too expensive. It's a limit up on day 2 as well. Indomim is almost doubled, right? Manufacturing. Leap India is another one. I mean, these are all kind of newer. Okay, Milky Mist is perhaps not that new in terms of the segment it belongs to, but a fair bit of excitement around these names. I mean, if you want to just weigh in on any or all of these.
So, Prashant, obviously, without speaking about the individual companies, if I can add more to that, you had Molbio, which is listed at a 30% premium. You had Doot Transmission, which listed on Monday and has been going up every day since I think the stock is up 40-45% since the IPO price. So clearly, the money which is getting rotated from the existing names in some of the indices and moving into new areas. You know, some of them, obviously, as you rightly said, they are not new, but clearly the growth visibility is what is driving the capital. And which is where you are seeing some of these new listings, not so recent listings, or even the ones we just listed, they are demonstrating that kind of an interest. And I think the interest in the IPO market has come back after some time. We had a pretty much dull period from November 25 to May 26. So the primary market has heated up again in the last 2-3 months, and clearly you're seeing a lot of supply coming through, not just through IPO, but even through QIPs, promoter blocks, PE blocks. The underlying thing remains same, Prashant, where there is a growth irrespective of the sector.
But Gautam, my only point...
That's where the investor money is moving.
Yeah, but my only point is...
Yeah.
Now, are bankers suddenly deciding to leave a lot of money on the table? Valuations are not cheap, right? 50, 60 times routinely. So, or is this the lack of opportunities elsewhere? So, let's do something new, that kind of mindset. Or is this just a little bit of euphoria here for listing gains? What explains it?
So it's a combination of everything, Prashant. I mean, again, everything depends on, it's case specific, right? For example, some of the segments which you got listed, there the interest is pretty high because they are the first representative of that sector in the listed market. So clearly there is a lot more excitement. I wouldn't call it euphoria because sometimes what happens when in the existing segment you're seeing a slightly modest or subdued growth, clearly there is a company A, B, C which comes in and gets listed, which is demonstrating 30-35% kind of a growth. You will see some more excitement happening there. Now, it is up to that corporate or to that company to demonstrate and execute on the promises that they've shown. And market has been equally brutal. When the companies do not meet their guidances, do not meet their promises, the same market has also brought the multiples down, even in the case of new listed companies or new age companies, so to say. There are many examples of that over the last 4 years. So it's not as if that every company which got listed from a new age segment has done exceedingly well. There are clearly a bunch of companies which have not done as well. So market has been fairly, I would say prudent in that sense.
Okay, all right. Well, Gautam, always a pleasure hearing your thoughts. Have a good end to the conference. And I look forward to catching up with you. Missed out on coming to the venue this time around, but catch you soon.
Thank you. Look forward.
All right. Well, let's do a quick check then on the F&O market. The PCR has come down to around 0.77, 0.78 or thereabouts because the called writers are at play. 24,100 call. The premium has close to have halved. It's come down to around 120 rupees the last time I checked. At the start of the trading session, it was around 205. Now it's at around 130 rupees. So it's down close to around 37% or thereabouts. The 24,200 callers, well, the premium come down to around 82, 83 rupees from around 145 rupees. On the flip side, the 24,100 put, the premium out there is holding at around 105 bucks. So clearly, there is some writing that being seen on the near-term strikes, which brings us to the levels. I think on the upside, you have the 20 DMA that's ballpark around 24,350. So that's going to become a bit of a resistance mark. But I think we also have a strong support at around this 23,950, which is the important mark to watch on the downside. So if you're looking at a 400-point range, that's what you need to look at. LIC, I'm going to keep an eye out on that stock. I was looking at, the total open interest. There is some shedding that we're seeing today. I think it needs a little bit more of shedding to go. And then probably it comes out of the F&O band either today or tomorrow. So LIC is a stock that I'll be keeping an eye out on because it's a probable candidate to come out of the F&O band. While PB Fintech, don't spot the stock too often, but appears in this sort of a market, there is some buying that we're seeing on PB Fintech as well. So keep an eye out on that name. Well, time to slip into a short break. On the other side, Nimish is waiting for us. He'll tell us what's going on in dealing rooms. He'll also get you a couple of technical calls. Welcome back. As promised, let's hop across to Nimesh. He's here to tell us what is he picking up in terms of dealing room action. Hey, Nimesh.
Hi, Nigel. I may sound repetitive, but again, it's a lackluster day of trade. There is hardly any momentum in the market of late. The entire action seems to be shifted towards the IPO and the recent listings. Look at the kind of volumes you're seeing on those names, and even from a retail interest point of view, there is a lot of trading interest in the recent IPOs and the recent listings. We saw what happened to all those names in the past as well. So let the music be on. As and when the music stops, you might see big crashes as well. But for now, there seems to be a lot of action and trading interest in the IPOs and the recent listings. From a technical point of view, given the fall we've seen from the recent highs and the PCR at 0.79, you might see a bit of a short covering rally next week as we head towards the monthly expiry. So that's the feedback. But broadly, I guess today's fall seems to be backed by some bit of FI selling as well. So there is a buzz of a large basket buying at a leading FI desk. So numbers, if it comes to, will substantiate that. But nevertheless, I guess the trading interest is quite low of late. And as I said, a lot of interest seems to be clearly in the recent IPOs in the IPO market, at least for the time being.
Okay, let's talk about individual stocks then, Nimesh. What's on your radar?
Well, the first stock is JSW Steel. Again, while there was a very strong commentary from the management in the CIO roundtable recently, but the stock has been under pressure or sideways of late, largely on fears of a large block deal in JSW Steel. In this particular case, it's not the promoter entity, but a large FI who might sell a large block in JSW Steel soon. So that's the first stock. The second stock is Adani Power. Even that's corrected from the recent peaks of 240 back to 205. There has been constant selling as well. I believe that selling pressure from a leading FI is largely over. And at least in the last couple of days, some bit of HNI flows have resumed in Adani Power on the buy side. So that's something to track there. The third is Vimta Labs. Again, been consolidating in a narrow range of late, but the street is anticipating a corporate development in Vimta Labs. The potential M&A is the buzz as far as Vimta Labs is concerned. And the last is Leap India. As I said, there is a lot of interest in the recent IPOs and recent listings. Leap India stands out. And interestingly, in Leap India, it's been reported as well. And the flow suggests that there is still a lot of institutional interest, and at least one large long-only fund seems to be actively buying Leap India ever since the listing day. So volume backed by FI buying in at least this particular name.
Okay, all right. Well, look at the volumes on Leap. I mean, some 32 million shares. There's Vimta. There's a corporate M&A, corporate development of the cards, perhaps a potential M&A. Adani Power, and of course JSW Steel, where, as Nimesh points out, there is expectations that perhaps there is a large block which is out there, which may happen at some point. Mitesh is with us. Nimesh, thanks very much for that. Nimesh is with us with what he wanted to do as far as some of the short-term trading ideas go. Mitesh, what do you have?
Yeah, Prashant, for a 1 or 2 day kind of a trade, PNB Housing is just at a flash high. So keep a stop at 1160 for targets of around 1195. And Dixon, I think, a few days of pullback seems to be over. The stock could re-enter the upward trajectory. So that's the BTST. Keep a stop at about 14,430 and a target of 14,580 can be that.
Okay, all right. Thanks very much, Mitesh. We'll speak again. 3:13, which means about 17 minutes to go, and about 2 minutes to go, by the way, for the regular session to end and the cash session to start. I mean, so 3:15, and of course 3:20, you'll be able to trade and put orders into the cash session. Well, some stocks are buzzing on the back of order wins, and Vinny's got that. Vinny, take it away.
Hi, so first up we have RealTel, which is in focus and it's buzzing away in trade because they've won around 167 crore order. This is by the EPFO that they've received this order. This order will be executed by 29th of February 2027, but there's a possibility of a further extension in terms of more orders that will come in on this existing work order as well. So that'll be interesting to watch out for, and that is why the stock is buzzing in trade. The other one is HG Infra. Today we saw it see a jump up of as much as 10% at one point of time as well. Now obviously it's come off from the day's highest point, but this is also on the back of an order win. They've received a letter of intent from REC Power Development, which is REC's subsidiary and arm of the company as well. So this is an order mainly for substations that they'll be making in the UP region, and that is why we've seen the stock see a very good run up, now just holding on to gains of 2-3%.
Okay, got it. Thanks a lot for that, Vinny, for giving us the quick update. Mayuresh Joshi joins us, Director Research, Market Smith India, on the show. Hi, Mayuresh. Good to see you in. Mayuresh, Welspun Corp, 2,000 rupees stock today. I recall asking you about it at 750, 800. You were quite bullish. We had at CNBC TV 18 as well, had explained the company. I recall visiting the unit in Gujarat with Mr. Goenka. Stock is, you get a day or two of dip and then it moves up. Is it getting to now a level that you would actually advise booking some profits, or would you run the course?
Afternoon, Nigel. So again, as a disclaimer, I think we are still holding on to the stock, more than 100% gains in our portfolios as we speak. So I think the stock has given exaggerated moves over the last few months, and very valid reasons as well. I remember the piece that you did, Nigel, on Welspun Corp as well. And again, I think all the pieces are probably coming together for this company. Strong order book, they're executing well. Margins have been decent. The overseas order book specifically, when the West Asian crisis probably comes to some sort of an end over the next few weeks or months, I think the huge transmission layouts that are expected to happen across the MENA region gives tremendous opportunities for Wellcorp, as well as its US operation working at full capacity as we speak. The domestic operations also stand on a very, very strong footing. So yeah, it's been a stellar show, both from a price performance and an earnings perspective as well.
Got it. All right. Let's talk about a couple of other names then. In this IPO, euphoria, or IPO is the only game in town. Anything that stands out for you? Anything you like?
No, so Dooth Transmission, Nigel, apparently is one company which probably seems to be in the right area as we speak. The expectations, specifically from an auto ang company, in the EV ecosystem, and probably being a lot more agnostic as far as the entire EV powertrain and the EV ancillary products are concerned. I think it probably stays fit in this entire transition that is expected to happen over the next few years. Having said that, I think the expectation in terms of capacities and the product mix that they probably have, the large expectation is that the entire macros surrounding those should probably be very, very supportive in terms of expected futuristic numbers as well. And with some element of innovation happening over the next few quarters for the industry as a whole, the expectations in terms of a stronger product mix leading to better EBITDA margins and therefore better profitability growth is something to be watched out for. I think Dooth is something that I watch out from the recent times.
All right. What about HEG? That demerger green signal was awaited from the NCLT. The stock actually ran in anticipation of that. Some believe that you could give some value to this business as a green tech business, and the management is sounding extremely optimistic on it. While others believe it's not yet giving numbers, so for the time being, we are not going to value it at much. Which part of the argument are you in? Because the graphite electrodes core business itself will gradually start looking up. The current market capitalization is around 13,500 crores approximately. And they could probably do close to 1,000 crores of EBITDA in 2028.
No, so I think that seems to be a base case scenario, Nigel. And expecting, I think, the newer business to start contributing, I think you'll still have to give it time in terms of how much of a meaningful contribution does this new vertical probably give HEG. However, for both HEG and Graphite India, which are the two largest organized listed players within this entire graphite electrode space, the move that is happening at the macro level, the big picture argument that is probably being put forth in terms of production of green steel. And obviously, I think graphite electrodes become a very important and pivotal part in terms of green steel production. I think that is going to be the norm as we've started seeing specifically in terms of European standards. And it will start gaining a lot of steam across the globe as we speak. And therefore, I think being one of the front runners in terms of capacities that they've probably got along with HEG, I think both these players from a big picture macro argument obviously stand to benefit as this entire transition picks up steam over the next few years. The second element in terms of input costs, specifically needle coke prices, is something to be watched out for, specifically from an interim period. Because I think with the West Asian prices, I think how does the supply probably come through in terms of needle coke, which is extremely critical in terms of production of graphite electrodes, and how do these prices probably move, is going to be extremely, extremely pertinent in terms of their end product pricing, as well as volume growth in case of inavailability or some sort of an inventory concern that happens as far as raw materials are concerned. The third element, obviously, is the big picture argument in terms of how the pricing itself is expected to be. And pricing should be steady state as we head into both these arguments when it comes to green steel and expectations of a lot of adoption happening in terms of inputs that probably go there. So yeah, I think big picture argument stays with them. From an interim quarter or two, I think they might still get impacted in terms of all these input cost fluctuations hitting them.
All right. What about Zagil, Mayuresh? Mr. Kedias thinks that there is value at $160. He picked up, I think, 20 lakh shares yesterday, Mr. Vijay Kedia. The stock is excited today, but it's come to a third of what it was at its peak. What is your view on it? The management still sounds very optimistic about growth, but there are a couple of question marks that are being raised with regard to a couple of line items.
Absolutely, I think, and that is why I think the stock probably came off, Nigel, to a large extent a couple of days back. Having said that, I think the guidance which has probably been downgraded is something that perturbed the street to a large extent. Does the business model remain resilient over a longer period of time? Absolutely, yes. I think there are a lot of opportunities that Zagil probably has at its behest in terms of not just exploring the existing environment that they're operating out of, but also new opportunities that probably come their way. So the big picture argument probably stays in their favor. I think it just needs a quarter or two for the street to probably reset. That probably FY27 might be annualized year or the next 2 quarters or 3 quarters, where numbers as per the management guidance might be a little bit on the lower side. But as things start picking up and as things start getting synergized on all the aspects put together, I think FY28 should be relatively better. So the big picture argument is in favor. However, our opinion is that the stock might just consolidate for some time.
Got it. All right. Stay with us. We just take a short break and come back. As we do that, let's get in some opinion. We have Sanjit Prasad, the MD and co-head of Kotak Institutional Equities. He expects FY28 earnings growth at around 14% that will be aided by some recovery in the economy, as well as a pickup in banks. He added that IT needs to be seen on how IT services companies cope with the AI disruption and the margin pressures. Let's listen in.
It is pretty much unchanged, actually, for a long time now. For the last 7-8 months, it's been in that range, only 17 to 18%. At least, that's one good thing this time around, that you're not seeing that level of earning downgrade. In fact, at least our numbers seem to be holding up reasonably steady compared to FY25 and FY26, where you saw a lot of earning downgrade, which is one of the reasons why the market really struggled over the last 2 years. So at least earning outlook is looking a lot healthier. Next year, we have about 14% for now, assuming some more recovery in the economy, and more important, banks starting to come back. The IT budgets, even if they're growing modestly, are getting diverted to other areas, which means the amount an enterprise is left with to spend on the traditional IT services has anyway come off. So that is anyway a challenge in the short term. In the medium to long term, given the rapid progress of AI, and that is not going to stop. It's going to be faster and faster only. So what is the relevance of it in IT services sector? How it will evolve in the new ecosystem? Who knows? Where Indian IT services fits in. And one thing to keep in mind over here is, in an environment where the growth itself starts to struggle, you have to keep an eye on margins, because when I look at the assumptions of the analyst community, most of the analysts seem to have factored in some slowdown in growth for the next couple of years. The second bucket to focus on is the domestic manufacturing theme. Again, you have a whole host of sectors which can fit in this theme. You have capital goods, CDMO, defense, electricity, electronics, and so on and so forth. But of course, you have to always overlay the valuation argument. Things will definitely grow in India. There's no doubt about it. So if you just ask me in isolation, yeah, you're bullish on everything in India, right, more or less. But if you overlay the valuation argument, then the investment universe in the short term diminishes significantly, because things have run up pretty sharply in the last 3-4 months, particularly in the so-called mid-cap and small-cap names.
Welcome back. Well, we just got 2 minutes and we're counting down to the final bell. Let's try to squeeze in a couple of queries then. Today was the day when, in fact, we did have a couple of stocks that did do well. That was Dixon, that was up and about in today's trading session, and Keynes as well. Mayuresh, what do you like from this pack? Very quickly.
So we like Sirma. I think it's part of the trading books. I think the product mix, the numbers have been decent. They've also probably got more allocations as far as the schemes are concerned. And therefore, I think from a numbers perspective as well as a positioning, I think Sirma is something that we continue to like.
Got it. Sirma is something that you'll continue to like. That's the pick of the pack from the EMS company as well. Thanks a lot, Mayuresh, for joining in and giving us a view on the whole host of stocks that we discussed. Sirma, as well as Welspun Corp as well. Some of those ideas that Mayuresh has liked and continues to like as well. But I think we're waiting the final rates that should gradually trickle in. But I think it's a good time actually to wind down the markets for you in today's trading session. Well, you had Keynes Technology. That was one of the top gainers today. The stock has been wibbly wobbly, but in today's trading session, it went home with a gain of close to around 5.5% in trade today. Dixon Technologies as well. That's the big boy in there. Well, that one in fact went home with strong gains. Add to the list something like a PNB Housing Finance. The stock has moved very smoothly from around that 800 rupee odd mark to around 1,100 rupees. A good move is what we're seeing out there. Coforge from the tech pack, well, that stock stood out. That stock was up close to around 2.5%. And Paytm, after that large trade got closed out, well, that stock as well has resumed its upward trajectory. Hitachi was a stock that ended with a cut of close to around 4.5% approximately. And Bharat Dynamics as well did come in for some profit taking. In fact, you had the defense pack that did come in for some profit taking in today's trade. I'll tell you what, we've got the final rate on the Nifty that's come in. Getting into this session, we're a little south of around 24,050. We have ended at around 24,078, which effectively means we have moved up by close to around 29 points in the CAS session. So not too bad. After a couple of days that the bears were on top in the CAS session, the bulls make a mild comeback with some kind of pullback just in the last 15 minutes or thereabouts. A few more stocks though to highlight that moved around from the broader markets. Shiprocket, beautiful listing out there. The stock was up more than 47%. You had Zaggle Prepaid, Mr. Kedia checking in, so that stock was up and about. And Milky Mist as well was up close to around 10% in today's trading session. Net, well, the bears went home with the advantage today, but there were pockets of strength, namely stocks like the EMS stocks did do pretty well. We'll wrap up on this edition of Closing Bell. You don't go anywhere. The team of Markets Forward is waiting by.
Markets remain weak, ending lower for the 7th straight session. However, the Nifty manages to hold the 24,000 mark in trade today.
The government allocates an additional 200 SCM of gas at the administered price to city gas distributors as it looks to expand piped natural gas coverage across more households. IGL and MGL surge on the news.
After Milky Mist's heady listing on Tuesday, Shiprocket steals the show today, debuting at 35% premium to its offer price. Other new listings include Dhoot Transmission and Bihari Lar Engineering. They've also delivered strong gains, keeping the IPO market firmly in focus.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all of the key data points to gear you up for the next trading day. I'm Ekta Batra and with me is Sonal Bhutra. Well, it turned out to be a day where we did see profit booking again. We did have the Nifty with just about managed to hold above 24,000, but we did see the Bank Nifty recover from the day's low. The advanced decline ratio also on the declining side, but a little bit of an improvement from the earlier part of the day. So it stood at around 1,988 stocks advancing to over 2,600 stocks declining on the Bombay Stock Exchange. Overall, dull day for the markets.
Dull day yet again, and 24,050 continues to remain an important level that we'll be watching out for on the Nifty. Nifty IT, which was one of the gainers in trade today, actually raised all of its gains in trade, and that was not all of the gains. I mean, it did see some surge, but it erased the opening gains. CLSA spoke about downgrading all the large cap names. So yes, it was an outperformer, but some of the gains were erased from the morning gains that we saw as well. Capital goods did not do so well, but we did have individual names which were in focus on the back of news updates and some order wins as well. We'll keep discussing all of that, but let's tell you what is in lineup for you that we have on the show today. We start with top movers and shakers of the day with Hormuz Fatakia from Shiprocket. Stellar debut to government boost to city gas distributors. We decode the big market moves today. Last but not the least, we delve into the key market events to watch out for tomorrow's trading session.
All right, well, on to our first segment of the day. We have Hormuz Fatakia who joins in now from the wall with all of the top movers he's watching out for today. Hormuz, over to you.
Day 7 of the markets slowly but surely grinding lower in today's session. So yet another forgettable day if you are a bull. But IT was one segment that you can say bucked the trend, if you could call it that. Coforge, HCL Tech, Persistent Systems, all of them doing well in today's trading session. So IT was one such name, was that pocket that did well. You take a look at some of the others that did not have a very good day in today's trading session. Of course, but one such name other than IT that stood out was ICICI Prudential, AMC, not life insurance. That's the AMC is the stock that I'm talking about. Motilal Oswal came out with a note earlier in the day, and that also projected some 23% upside for ICICI Prudential AMC. That was the stock that I wanted to highlight. You'd go on to further and see some of the other names that were in the spotlight in today's trading session. Sugar stocks were some of them. The crude prices going higher, prices also rising in the domestic markets. Dhampur, Dwarikesh, Bajaj Hindustan, all of them saw gains of anywhere between 5 to 10% in today's trading session. What was some of the other top movers in the space today were the capital goods names which did not have a very good day. Hitachi Energy was one such name. Siemens Energy India is the stock that I wanted to highlight, and CG Power also seeing losses of anywhere between 3 to 4% in today's trading session. Now I take a look at the newsmakers. L&T Finance had an initiation note from Macquarie earlier in the day, but the stock was already up 7% in yesterday's session. The stock saw some profit booking today. Zaggle, after a sell-off on Monday, continuing to see some gains, 12% higher today. NetWeb, the QIP is in progress, some profit booking from higher levels, so 5.5% lower on NetWeb, and Chennai Petro at record highs as well in today's session. What is also at record high levels, RR Kabul was one such name. Karnataka Bank did well, and Tourism Finance too, around 6.5% higher, another record high for this one as well.
Okay, all right. So some stocks which were buzzing in trade today. Let's talk about city gas distributors as well. The stocks did well in trade today, especially MGL and IGL, because now the government has unveiled the latest plan for domestic PNG expansion. And what they are doing here is they have provided 200 SCM of domestic gas to city gas distributors so that they can convert that to PNG. Now, what that does is it's a 2-point positive plan that they are planning for the city gas distribution companies. It improves their PNG volumes. They have been trying to increase PNG network in the country since the time we have seen that LPG crisis brew during the West Asia crisis. And the second is it will help their margins because this is a low gas cost in form of raw material which is coming to city gas distributors, and that is something they will process, which will mean better margins for these companies as well. Remember, PNG is around 10 to 12% of volumes for both these companies, not a bigger part. Most of the margins are coming in from CNG volumes. But remember, imported LNG is much more expensive, so a domestic gas procurement will mean better margins for these companies. More positive for IGL and MGL and not so much for Gujarat Energy, because remember that depends more on industrial volumes, that is the Morbi volumes, and that's why these stocks were buzzing in trade today for two reasons. Valuations have been quite low, and second, this is a positive sentiment rub-off that we have seen on these two names.
Okay, all right. So city gas distributors in focus in today's trading session. Sonal getting us that story. But to take this discussion forward and the overall outlook on the markets, we have with us Mayuresh Joshi from Mark Smith India and Shrikant Chauhan from Kotak Securities. Gentlemen, welcome to the show. Well, Mayuresh, I'm going to start with you. It was another dull day for the markets. How would you approach the overall sentiment that the market is working with at this point, considering that Brent crude is stubbornly above $90 per barrel?
Afternoon, Sonal, afternoon, Shrikant as well. No, I think two things. One, I think with the spike that you're probably seeing in Brent crude prices and no end to the escalation as far as the West Asian crisis is concerned, obviously I think the risks are getting flagged off by bond yields globally. We look at the 5-year, 10-year, 30-year in the US markets, they are all at all-time highs as we speak. Probably anticipating inflationary-led risks and demand-led risks as far as the US markets and the global markets are concerned. And therefore, from a macro standpoint, if this prolongs for longer, I think the expectations in terms of inflationary-related, risk-related environment might start tapering off, might start petering out. At the same time, I think Q1 numbers were expected to be relatively softer. I think companies have given a very, very resilient show. But my own sense now suggests that the entire argument that Q2 might be soft, both in terms of the low-cost inventories that a lot of companies had at their PS getting over, and the escalated input costs might actually start hurting margins, is something to be watched out for. So I think the markets are trying to juggle through macros, the implied micros on the same, and our earnings will play out in Q2. And therefore, the kind of reactions that you're seeing on the
Okay, all right. Shrikant Chauhan is joining us as well. Shrikant, what is now an important support? Do you expect it to break below the 24,000 mark? Because today it consolidated 24,050, 24,060. That's where Nifty been at.
Yeah, absolutely. I think the way the market is correcting on a day-to-day basis and the way it has broken the short-term averages as well as the important support line at 24,200, we are of the view that we may even see the levels of maybe 23,800 or 23,900. But while looking at the overall participation and the way there is a gradual downward activity in the market, we are of the view that after hitting the levels of maybe 23,800, 900, we can expect a quick rebound in the market. So even if it falls to the next levels of 23,800 or maybe 23,900, we are not expecting market to sustain around those levels because on the short-term charts, the markets have already reached to their extreme oversold levels, and most of the Nifty 50 stocks have also fallen to their important support levels. So broadly, I'm of the view that we may see a market breaking the level of 24,000, but after hitting the important support levels, again, we can expect a rebound in the market.
Okay, all right, Shrikant. Well, end-to-end logistics platform Shiprocket listed at a 35% premium to its issue price of 97 rupees a share and gained another 13% post-listing. Other debutants, including Dhoot Transmission and Bihari Lal Engineering, have also delivered strong gains since listing. Sudarshan joins in now with the IPO report card.
If anyone has got the allotment in the recent IPOs, he or she would have made huge returns, because most of the companies listed in the recent past, in the last few weeks, have seen major returns, and most of the companies, except few exceptions, have seen returns of more than 20%. On top of the list is Indomim. Stock has almost doubled, up 100% from the issue price of 485. Today's intraday high was of 990 rupees per share. Next one, Dhoot Transmission, up more than 50% against the issue price of 870, and today the stock has crossed 1300 rupees per share. Molbio Diagnostics, returns of almost 40%, issue price was 807. Now trading above 1100 rupees per share. MV Electro 2 has seen returns of more than 35% from the issue price of 425. And now Milky Mist Dairy, returns of more than 30%. Issue price was 140 rupees per share. Now the stock is trading around 200 rupees per share. Manipal Health as well has seen returns of more than 20%. Issue price was 590, and now stock is trading above 720. The stocks that have underperformed or have given flat returns, Leap India, returns have been almost flat. Issue price was 159, and current price is also around the same level. SBI Funds, negative returns of around 3 to 4%. Issue price was 574. Now the stock is trading around 550 rupees per share. So overall, it's been most of the companies have given more returns than the few ones which have disappointed.
Thank you so much, Sudarshan, for joining us with all those interesting details. In fact, earlier today, we spoke to the management of Shiprocket and Gaja Capital. Gaja Capital's IPO opens today for subscription, on the outlook ahead and understanding their business.
Essentially, every piece of revenue growth that we see will keep adding to the bottom line. We are not, folks, we are not just looking at this 2 lakh base or a 6 crore vision, but our aim over the next 5 years to get to $1 million plus MSMEs, and that is the number that we want you to, we want to tell you that we are all committed for and we want to go for.
Take our current net worth, we have 600 crores. The bulk of it is deployed in our own funds. For a fund manager to put money in its own funds and alternatives, it's called skin in the game. We have a big chapter on it in the RHP, is a regulatory requirement. What we've done is we've gone beyond that and we've subscribed to global benchmarks, global best practices. We are at an average of 6.4%. Our last fund was 8.5%. We want to take it up to 10%. So the bulk of the fresh capital basically goes into helping us build a platform. 80% is going into funds as sponsor commitment, in line with what we've done in the past.
Okay, all right. It's a very active IPO market. Mayuresh and Shrikant are still with us. Well, Mayuresh, what's your sense? Any of the picks? Did you look at the Shiprockets of the world? Anything that you're recommending to clients?
The Shiprocket moved like a rocket extra. And again, I think Indomim also had a stellar listing and gains after that. I think Indomim, Dhoot Transmission, Shiprocket obviously stand to gain quite significantly over the next few quarters as their business model keep evolving. In the case of Indomim, again, I think vertical integration of their operations, they've got a dual shore production model, which probably ensures supply chains as well as the end products, which probably have a better realizations as well. They're getting into better aspects as well, like investment, precision casting, which probably is a very high margin business. Similarly, for Dhoot Transmission, I think a large part of their business is coming in from wiring harness. But as they go ahead, I think because they have agnostic products across the entire powertrain mechanism, the expectation largely is that as the product mix improves, and as they probably start catering to a larger amount of OEMs, I think the product mix will ensure better margin, better profitable growth. So I think, interesting listings that we've probably got. So Indomim, Dhoot, Shiprocket, probably interesting listing. Let's see how the numbers go.
Okay, take that point. Shrikant, we'll come to you in just a bit, but let's go to our colleague Rima, because CLSA has issued a note on the Indian IT sector. The brokerage believes that mid-tier firms are better positioned to navigate the technology transition versus large caps. Rima, what does the report say? Rima?
Thanks so much for that. So CLS's main point is that this technology transition is going to create winners and losers. And the winners are going to be the mid-cap IT companies, better positioned to navigate it. They're better placed to take advantage of the changes, stronger management, execution, and the ability to pivot faster, which is why CLSA maintains a high conviction outperform on both Persistent and Coforge, and they've got an outperform rating on Hexaware and LTIMindtree. But for large caps, they say the picture is tougher. They are dealing with AI-led deflation in their legacy business, and plus there are macro headwinds. One of the key takeaways is, and by the way, for the large caps, they've also downgraded a TCS, Infosys, Tech Mahindra to a hold, while Wipro and Mphasis have been downgraded to an underperform. But I think this part is the most important part of what CLSA has to say. I think everyone's dealing with the question is about this AI inflation. When will the net benefit from AI offset the net loss on account of AI? And CLSA's view is that AI volumes could supersede the deflationary impact by FY30 only by FY30, which basically means the industry could be stuck in a period of subdued growth before AI volumes are large enough to offset the revenue deflation. Remember, FY24, 25, 26, FY27, they all have been low growth years for the companies, and now CLSA is saying that this could extend till FY30. Look at the numbers now. And for the first time, we have a brokerage calling out the kind of AI revenue contribution. So currently, for the large cap IT companies, AI is about 6 to 10% of their AI revenues, of the total revenues. According to CLSA, this goes up to 30-35% by FY31 in the next 4 or 5 years. And only when that happens will the revenue growth for the large cap IT companies expand from low single digits, from a 1.9%, a 2%, it will go up to mid single digits. So basically, double-digit growth rate is not in the picture. So the message is very clear. The opportunity is real, but the gestation period is going to be very long. The industry will have to wait till at least FY30 as it moves from low single digit to mid single digit kind of a revenue growth. Valuations, they say, are fairly it's balanced. Risk reward is favorable. There are 3 structural headwinds though. One is GCC. They're not gaining market share over global peers, and services are losing out to hardware and software companies on account of the global AI rollout.
Okay, all right, Reema. Thanks very much for that. Well, from Jubilant Ingrevia's acquisition to SpiceJet's NCLT relief and a slew of other order wins, there was plenty of stock-specific action on the block today. Divyani joins in with a wrap. Divyani, over to you.
Well, let me start with Jubilant Ingrevia. Now, the company is acquiring a 40% strategic stake in Zeta One Technologies for about 189 crores. Zeta One is an electronics design and manufacturing services player with exposure to electronics as well as semiconductors. Next up is SpiceJet. Now, NCLT says it was unable to pronounce orders on insolvency pleas by 7 other lessors due to last-minute settlement between SpiceJet and Aviator ML. So this comes as a big relief for the company. Next up is Astra DM. Now, TPG-backed Centella Mauritius was looking to sell up to 7.2% equity at 766 rupees per share, roughly at a 6.3% discount. Now, on the back of order wins as well, we have a couple of companies that were in the news today. Now, Interage Building Solutions won an order of 128 crores from a major global FMCG player for pre-engineered steel manufacturing facility. Now, this is to be completed within 10 months. Next up is EMS Limited. It emerged as an H1 bidder for 2 NHAI toll plaza contracts worth roughly around 42 crores combined. Next up is HG Infra. Now, the company received an LOI from REC Arm for 2 substations and associated lines in Uttar Pradesh. Now, next up is L&T Tech. Now, the company has signed a 5-year international agreement worth over $75 million for digital engineering services. And last up is Atlanta Electricals. Now, the company won an order worth roughly around 194 crores from Aptransco for transformers.
All right, thank you so much for bringing us that summary, Devyani. Let's go back to our guest. Shrikant, coming to you this time, Nifty IT. What do you make of that? Which are some of the triggers and not so much of a trigger for this index chartically?
So yeah, there is like a lot talk on the Nifty IT index as well as stocks. In the recent time, we saw a very sharp bounce back from the lower levels. But at the same time, around its important resistance level, again, we saw some profit taking, and now again, they are moving down. So while looking at the large cap stocks, the way they are shaping up, I am of the view that in the near term, we can see some more correction in large cap companies, especially TCS, Infosys kind of companies can come down from current levels. But select stocks can do really well. In that, we like Coforge, Persistent, Fractal Analytic. I think these are the stocks where we can see some more upside in the near term as well as in the medium to long run. So in case if there is any correction, we should look for buying some mid-sized companies. And for the very short-term view, we can take some trading calls on IT companies, on large cap IT companies. But for IT index, I am of the view that it is going to spend some more time within the range of 31,000 on the higher side and 28,000, 29,000 on the lower side.
Okay, all right, Shrikant as well as Mayuresh, we're going to leave it on that note. Thanks very much for joining in and giving us all of that perspective. We'll take a short break now, but we'll get you the top corporate voices along with the key market events to watch out for on the other side.
Welcome back. You're still tuned into Markets Forward. Let's get you some corporate voices of the day. Supreme Industries maintain its FY27 volume growth guidance with overall volumes expected to grow nearly 13%. The management also maintained margin guidance of around 15%. Exports are expected to rise to $150 million over the next 7 years.
Siegel Engineering has clarified that the cancelled Delhi PWD order was relatively small and has now been sent for rebidding. The company says its legal team is reviewing the decision. It adds that it has received additional orders worth around 2,400 crores while maintaining its FY27 revenue growth guidance at around 15%.
Speaking to CNBC TV 18, Indomim management said it expects margins to remain at the 28 to 30% range with revenue growth of around 20% in FY27. The company is also expanding its manufacturing footprint with a new facility in Karnataka expected to be commissioned by June 2027.
All right, and before we wrap, we'll bring you some key market events to watch out for. Devyani standing by to tell us more.
Well, let's start with the domestic events first. In India, the core July infrastructure and core sector growth data is set to be released at 5 p.m. tomorrow. Now, from an IPO perspective, the Tempson's Instruments 650 crore IPO opens for subscription tomorrow, while Sunshine Pictures 282 crore IPO closes for subscription tomorrow itself. Now, coming to the global events, the US macro data of weekly jobless claims and Philadelphia Fed manufacturing index is due at 6 p.m. IST, while from an earnings perspective, Walmart's Q2 earnings are set to come out tomorrow. Now, this is a key read-through on US consumer spending as well as retail demand, so this will be a key event to watch out for. So does the DRAM company's Q3 earnings, which will give us important cues on the agricultural and industrial equipment demand in the US itself. Now, coming to the other important events, India and Singapore's ministerial roundtable is set to happen tomorrow with senior Indian ministers set to attend this particular event, which with trade and investment cooperation in focus tomorrow. Now, Rajnath Singh is also set to meet Shinjiro Koizumi in Delhi with defense cooperation in focus in the India-Japan defense talks.
All right, Devyani, thank you so much for joining us again with that list. And with that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side.
welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Crude oil prices climb as US and Iran continue to make contrasting claims on the Strait of Hormuz. UAE snaps trade ties with Iran over alleged missile attack. Iran denies the charges. Israel bombs an airbase in Syria, drawing condemnation from the US and Turkey. The United States remains India's largest export market despite Trump's tariffs. The US accounted for about 20% of India's exports in July amidst the government's diversification push and exporters looking for newer shoes. Commerce Secretary says India is focused on exports to economies who account for two-thirds of the world's GDP. US President Donald Trump announces a 3-day pause on 50% tariffs on Canada just hours before they were set to take effect. Trump says the two nations are nearing a deal. The White House says Canada has agreed to make certain concessions. Sensex and Nifty decline for the 7th straight session. Nifty manages to stay above 24,000. Rupee weakens against the dollar and moves closer to the 96 mark. NSE expects SEBI to approve its IPO papers in 2 weeks. Sources say the issue is likely to be launched in the second half of September, valuing the exchange at more than 5 lakh crore rupees. 2026 has been the year of mid-sized IPOs. So far, 70% of the sub-1,000 crore listings this year have given positive returns. The last 6 listings on Dalal Street, including Shiprocket, gave an average listing premium of over 35%. Do not try to manipulate to defame the new closing auction session, warns SEBI Chairman Tuhin Kanta Pandey. Says the new system is intended to improve transparency and any attempt at manipulation can be detected relatively easily. National Company Law Tribunal imposes a 15 lakh rupee penalty on SpiceJet and its lessor Aviator ML for a last-minute deal to settle the 60 crore rupee case. 7 other lessors have claims of around 500 crore rupees against SpiceJet, and those cases will now need to be heard once again. A landmark child safety trial against Facebook and Instagram begins in California. 29 US states are seeking damages of about $200 billion, claiming the social media companies are addictive by design and harmed children. All right, to the top story this evening, Iran-US talks stuck at an impasse. Iran has tensions escalate amid attacks on the UAE. The United Arab Emirates said it was cutting all economic ties with Tehran after accusing Iran of firing ballistic missiles at its territory, ramping up regional tensions. One of Iran's main commercial partners said it would halt trade and financial transactions with Iran until further notice. Tehran has denied that Iran's parliament speaker Mohammad Ghalibaf has accused the US of trying to force more concessions from Iran. Meanwhile, Iranian Foreign Minister Bazar said the US is now begging to negotiate on Iranian conditions. This after US President Donald Trump said no talks are underway or scheduled with Tehran. The Financial Times reported that Iranian officials have weighed the possibility of targeting US military assets based in Europe. Crude oil prices remain above the $90 mark as tensions remain high in the Strait of Hormuz. Kepler data shows that traffic through the strait dropped significantly last week. Confirmed crossings fell 19.5% to 95 transits. Data also shows that more than 80% of vessel transits through the strait over the past 2 weeks have taken the Omani route. The US condemned Israel after reports that it struck a Syrian military airbase near the Turkish border. Washington called the attack an unnecessary escalation. 8 airstrikes hit an airport runway and storage facility in the country. Israel said Syria was on the verge of breaching the security status quo. Tel Aviv also accused Damascus of allowing Turkish troops to deploy to the airbase. From one war-torn region to another, former Defense Minister of Ukraine, Mikhailo Fedorov, is calling for elections even as the war with Russia continues. Now, Fedorov warns a legal, safe and realistic way to restore Ukraine's democratic process while raising concerns over governance and corruption. Fedorov was removed as the Defense Minister in July, 6 months after taking charge. His removal led to protests in Kiev. Ukraine has not held elections since Russia's full-scale invasion in 2022. Meanwhile, a drone strike near the Zaporizhia nuclear power plant has killed 1 nuclear specialist and injured 17 people. Russia has blamed Ukraine for this attack. US President Donald Trump announced a 3-day pause on the 50% tariffs on Canada just hours before they were set to take effect. In a post on Truth Social, Trump said Washington and Ottawa had reached a deal subject to finalizing documents. Canadian Prime Minister Mark Carney said the two sides had made substantial progress, but important work remained. The tariffs would have hit around $20 billion worth of Canadian goods. All right, on to the day's market action. The last street ended lower for the 7th straight session. Nifty managed to hold on to the 24,000 mark with at least 34 stocks closing lower. Sensex fell over 300 points and the Midcap index slipped over 130 points. Financials relatively outperformed with Nifty Bank closing near flatline. The IT index batted for the bulls, ending over 0.5% in the green. SEBI Chairman Tuhin Kanta Pandey has warned that any attempt to defame the closing auction session through manipulation will be dealt with sternly. Speaking at an event, Pandey said that the new system is intended to improve transparency and any attempt at manipulation can be detected relatively easily.
सिस्टम में मैनिपुलेशन पकड़ने के आसान मतलब जो हमारा वो है वो ज़्यादा अधिक है हमारी कैपेबिलिटी पुराने वीवैप सिस्टम से की अपेक्षा जो कैश सिस्टम में हम रिलेटिवली इजीली मैनिपुलेशन को पकड़ सकते हैं तो इसलिए ये आपको ये देना होगा कैश ट्रांसपेरेंसी के लिए है और वो ले लेकिन यदि कोई ये समझ रहे हैं कि हम उसका कैश को नाम बदनाम करने के लिए मैनिपुलेट कर लेंगे तो वो बहुत ही धोखे में होंगे.
Logistics giant Shiprocket has made a bumper debut on the bourses, listing at a 35% premium. The 1,600 crore rupee IPO was subscribed nearly 100 times on the final day of bidding. Speaking to CNBC TV 18, company CFO Tanmay Kumar said the company plans to tap over 1 million MSMEs in the next 5 years.
Essentially, every piece of revenue growth that we see will keep adding to the bottom line. We are not, folks, we are not just looking at this 2 lakh base or a 6 crore vision, but our aim over the next 5 years to get to a million plus MSMEs, and that is the number that we want you to, we want to tell you that we are all committed for and we want to go for.
And staying with IPOs, the National Stock Exchange expected SEBI's approval for its public issue within the next 2 weeks. Sources have said that the price band may be launched early next month, with a launch expected in the second half of September. This has come after the stock exchange received a no objection certification from SEBI. 2026 has so far been the year of mid-sized IPOs, with 70% of listings below 1,000 crore rupees delivering positive returns. The last 6 IPOs, including Shiprocket, have also given an average listing premium of over 35%. Over 54 companies have raised close to 7,000 crore rupees this year. Hormaz is here to decode the IPO trends so far. Hormaz.
Well, we are at that stage of the year where the IPO activity has started to pick up again, and based on the number of IPOs that are set to open at least until next week, the number of IPOs this year have now reached 50% of what it was in 2025. So we had over 100 IPOs last year. We have now reached 54. That is until the IPOs that are set to open until the 24th of August. Now, if you take a look at the number of IPOs, the relatively quiet first half of the year in terms of the IPO market, 20 IPOs between January to June, then we have already had 34 that have opened or are going to open going forward in the next couple of and over between this month and of course until August. Now, if you take a look at the number of IPOs in the size wise, according to this data from Prime Database, we have not had an IPO that has been more than 10,000 crore in size. The number of IPOs, the smaller ones are the ones that are garnering the majority. 34 IPOs out of the 54 have been sub 1,000 crore and so on. But this is not a new trend. If you take a look at the last 5 years as well, the number of, on an average, at least 2/3 of the IPOs every single year have been less than 1,000 crore in size. But it is this 1,000 crore IPOs sub 1,000 crore IPOs that have had better returns in terms of the value that has been created for these. Now, if you take a look at the average listing, the number of IPOs sub 1,000 crore, 28 of them have been completed and listed so far. And out of them, 20 of them have delivered positive returns and only 8 have delivered negative returns. Now, take a look at the average listing premium. For a sub 1,000 crore IPO, the average listing premium has been 8.3%. But for a more than 1,000 crore IPO, the average is 11.7%, but there's a catch here which we'll get to in just a bit. But take a look at the last 6 listings. The last 6 listings have all been sub 1,000 crore and the average listing premium has been 35%. Now, why I spoke about the catch is because for IPOs more than 1,000 crore, if you exclude Bharat Coking Coal, which listed at a 96% premium, the average of that drops to 5.9%. So it comes down to the fact that the sub 1,000 crore IPOs have a healthier average listing premium compared to the greater than 1,000 crore IPOs. Now take a look at the best performing small IPOs this time around. Omnitech Engineering is up 150% from its IPO price. GSP Crop, One EMI Tech, Gaudium IVF, Laser Power, all of them have seen gains of anywhere between 50 to 90% in comparison to their issue price. Now take a look at the worst performers as well. Of course, it does not mean that the smaller IPOs have all delivered outsized returns. There have been some that have underperformed as well. Shriram Twistech, it's down 62%. Innovision, Astha Spintex, Amirchand, all of them have declined anywhere between 15 to 50%. But the IPO pipeline is only picking up. The activity is only picking up in the primary markets, even though the secondary markets have not gone anywhere. Gaja Alternatives IPO has opened for subscription today. Tencent's Instruments will open for subscription tomorrow. And we have 2 already that are lined up to open next week with Skyways Air and Symbiotech Pharma. And then, of course, the 2 mega IPOs that the street is awaiting with bated breath is the IPO from Reliance Jio and, of course, the big NSE IPO as well. So the IPO activity has only started to pick up as we draw closer to the end of the year. And, of course, there's some mega fundraising activity lined up going forward as well.
Right, thank you, Harmaz. Moving on, US remains India's largest export market despite the 10% tariff blow. As per latest available data, share of exports to the US have stayed unchanged over the past year and stood at 20% in July. Abhimanyu Sharma joins us now. Abhimanyu.
Well, the total share of exports which the US market comprises of India's total exports is around 20% in the past 1 year. Now, this is despite the levy of tariffs, which ranged from 50%, then dropped to 18%. And currently, 10% plus MFN tariffs continue to apply on India's exports to the US market. Now, in a bid to diversify into different markets, not just to hedge risks due to tariffs and other uncertainties, but also to expand opportunities for exporters, India is already in talks and has also signed and finalized several free trade agreements in course of the past few years. Now, speaking about the past 1 year itself, several free trade agreements have come into operation. The first was the FTA between India and the European Free Trade Association, which comprises of Switzerland, Norway, Liechtenstein, and also the other FTAs which came into force included the FTA with the United Kingdom and Oman. FTAs which already have been finalized include the ones with the European Union and New Zealand, which are yet to be implemented. They are yet to come into force. Again, talks have already concluded between India and the United States, but the FTA, the BTA rather, the first tranche of that is yet to come into force. So clearly, the government is making all efforts to expand the overall export market, not just to hedge risks for exporters, but also to ensure that there is an overall export market which opens up even for products which are not being exported for now. So the government has also come up with a plan in which they are supporting exporters through the export promotion mission, through RODTEP and through several other schemes in order to ensure that any levy of tariffs and also other uncertainties which have prevailed in the past 1 year due to either the crisis in the Strait of Hormuz or other global uncertainties do not adversely impact the profile as well as the overall impact on India's exporters.
All right, thank you, Abhimanyu, for that. Moving on, the government has approved a new incentive scheme to fast-track piped cooking gas connections. The scheme will come into effect from the 1st of September. City gas distributors will get an extra 200 standard cubic meters of cheaper domestically produced gas for every new build household connection above a fixed threshold. The government said this could cut companies' payback period on PNG infrastructure from 10 years to just about 3. Aster DM fell over 2% after nearly 6 crore shares changed hands in block deals worth nearly 7,800 crore rupees. The shares changed at just over 769 rupees apiece. In some relief for SpiceJet, aircraft lessor Aviator ML has withdrawn its insolvency plea after the two sides reached a settlement over dues of around 60 crore rupees. The move has forced the NCLT to hold back verdicts in 7 other pleas worth over 500 crore rupees. The tribunal called the last-minute settlement a fraud on the court and fined both SpiceJet and Aviator ML. Now, Ashmit Kumar is here with the details. Ashmit, please take us through what transpired in court.
Well, a big relief coming in as far as SpiceJet is concerned. Bear in mind, the NCLT was supposed to pronounce judgment in a case of 8 petitions, 8 insolvency petitions against SpiceJet. However, as this matter came for pronouncement before the NCLT, SpiceJet appeared, their counsels appeared, and they informed that they've managed to settle the payment dispute with one of the 8 lessors. That one lessor was Aviator ML. The amount in question was about 60 odd crore rupees. They've managed to agree on a settlement. Aviator ML withdrew its petition. But what's interesting is that the NCLT noted that, look, this one petition, the Aviator ML application, was interconnected with the remaining 7. All 8 were interconnected, and because of that, the NCLT said that because there is a settlement that is reached with one of the parties, they cannot pronounce their orders on insolvency against SpiceJet in all 8 of them. So essentially what has happened is that one petition has been withdrawn after a settlement. There are 7 others that were due to have orders today. They will now be reheard afresh because one of the 2 judges hearing this matter in the NCLT is due to retire today. So a new bench will be constituted. The 7 of them will be heard once again. And bear in mind, this is significant given as how while Aviator ML had dues of only about 60 odd crore rupees, the remaining 7, their aggregate claims add up to about over 500 crore rupees. So to that end, SpiceJet buying itself time. The orders being deferred right now, the cases to be reheard once again. And again, aggregate claims over 500 crore rupees. SpiceJet managing to defer the judgment by settling with one lessor for a settlement sum of about 60 odd crore rupees.
Right, thank you, Ashmit, for that. We'll take a short break. Coming up next, a landmark child safety trial against Facebook and Instagram begins in California. 29 US states are seeking damages of about $200 billion. That and much more once we return. Welcome back. You're watching Business 360. At least 9 people died after a massive fire broke out in a building that housed several hotels in central Kolkata. The deceased include a 4-year-old child. Authorities say Bangladeshi nationals were among those killed, with some reportedly in Kolkata for medical treatment. Preliminary investigation found that the hotel lacked basic fire safety measures. At least 34 children fell ill after eating a midday meal in a Bihar school where detergent was reportedly served instead of salt. The children complained of a burning sensation in their throats and stomach pain, causing panic within the school premises. Political tensions escalated in Bihar after RJD leader Tejasvi Yadav was detained by police during his party's Raj Bhavan march in Patna. The protest was organized to demand answers from the government over the alleged use of an AK-47 rifle during a student protest in Siwan district last month. RJD supporters were seen climbing onto the roof of the police vehicle in which Yadav was detained. Vijay-led Tamil Nadu government has withdrawn an order directing colleges to prevent students from joining protests organized by political parties. The now withdrawn circular had specifically referred to protests conducted by left parties and the Tamil Nadu Cockroach Janata Party. Andhra Pradesh IT Minister Nara Lokesh has assured the Assembly that Visakhapatnam's data centers will not affect the city's drinking water supply, calling concerns over their environmental impact deliberate misinformation. He said the center's water needs will come from the industrial allocation of Polavaram project water with dedicated pipelines. A landmark child safety trial against Facebook and Instagram has begun in California. 29 US states are seeking damages of about $200 billion, claiming the social media companies are addictive by design and harmed children. Rachna Dhanrajani joins us with more details. Rachna.
That's right. Overnight in a federal courtroom in Oakland, California, Meta walked into the most consequential legal test big tech has faced. 4 American states, California, Colorado, Kentucky and New Jersey, are among 29 that allege that the company deliberately engineered Facebook and Instagram to addict children, then concealed what it knew. California's Deputy Attorney General put the alleged business model in 4 words: hook the users, hold them as long as possible, harvest their data and hide the truth in public statements. Meta rejects all of it. Its counsel told the court there is no clear link between adolescent social media use and poor well-being, and pointed to teen accounts and parental time limits introduced 2 years ago by the company. The company calls the states' financial demands vastly disproportionate. Those demands are extraordinary. The states have signaled a figure near $200 billion. A theoretical statutory maximum runs to $1.4 trillion. That's close to Meta's entire market value. Though the judge has wide discretion and legal experts consider anything near that unlikely to happen. The first witness was a former Meta safety engineer, also one of the whistleblowers, who told the court move fast and break things was the internal mantra, and that products shipped without safety as a consideration. Mark Zuckerberg and Instagram head Adam Mosseri are expected to take the stand soon. Now this trial has a jury, but it's advisory jury. Judge Yvonne Gonzalez-Rogers decides this case herself. 6 weeks of testimony is still ahead of us. The stakes for India are also direct here because this is Meta's largest user market. So if the court orders design changes, be it to defaults, to age checks or to the algorithm itself, those changes will have to be shipped globally. Meanwhile, the company is expected to appeal to the Supreme Court, but we'll see how the trial goes. Today was just first day.
All right. Thank you, Rachna, for that. We will keep a track on these developments. With that, it's a wrap on this edition of Business 360. Thank you for watching.
Hello and welcome to this edition of Editor's Playbook. I'm Shireen Bhan. Gen Z would say no cap. From healthcare to aviation to insurance, several sectors are staring at sweeping regulatory changes. Their entire business model could be threatened with just a stroke of a pen. Now, a parliamentary panel wants to impose limits on healthcare costs, including room rents and surgical procedures. While the move may be well-intentioned, is the price cap the right remedy? Will it scare away investors in a country that desperately needs more hospital beds and better infrastructure? Now, top hospital operators believe price caps will not solve the affordability problem and may in fact make it worse by hampering expansion plans. This view is prevalent across sectors. The government is also drafting rules to potentially impose limits on airfares. In fact, in a sealed cover, something has been proposed to the Supreme Court. Now, the promoter of India's largest airlines argues that the cost of a ticket is not determined by airlines alone. There are many other factors at play. Rahul Bhatia of Indigo told me recently that the responsibility of the current cost structure lies with the ecosystem, which includes airport charges by the airport operator, user development fee, landing charges, and much more. Take a look.
The industry always gets, again, I use a word and you'll hang on to it, hammered for airfares. And this, again, something that I think we have not done a good job in educating the world at large. UDF charges at airports have gone up to 95%. Landing charges at airports have gone up to 34%. And the reason I make this point is this is not being critical, but I think if we truly want India to become a major global aviation market, I think the whole ecosystem has a responsibility to make sure that we have a cost structure that will allow us to compete.
Well, that's Indigo's Rahul Bhatia there saying that by focusing merely on the airline's responsibility when it comes to pricing, we're addressing the wrong question. The issue of price cap is not limited to just healthcare or aviation. Several sectors are grappling with the possibility of regulatory action that could significantly alter their models. To discuss all of this and more, we're joined by Prashant, Nimesh, Ekta and Sriram. Guys, it's great to be here, sitting with all of you after a long time.
No cap, Shri.
No cap. No cap is right. No cap is right. But, you know, Ekta and Prashant, you, of course, just put together that stellar starcast of all the hospital operators to discuss this issue of price caps. And it's not just hospitals or healthcare. As we pointed out, it's a whole bunch of sectors that are dealing with the possibility of the stroke of pen risk today. Prashant.
Absolutely, Shireen. And first of all, great that you're here. I think we should fly down every editor's playbook, I think.
We will then definitely need a price cap. We'll definitely need a price cap then.
But I'll tell you, just to give an example, Shireen, I think this was last week, right? There was CNBC TV 18 has been conducting this risk awards with, ICICI Lombard, and I was at that event, and there was a Q&A, and these were all the risk leaders across, all listed companies, large companies, some 200, 250 people in that room.
Across sectors.
Across sectors, right? And there was this sort of, there was a screen, and they were asking questions about, just a Q&A. And one question was, what is the one biggest risk that you worry about? And there was regulatory risk, there was geopolitical risk, and there was a bunch of other options. And I thought it would be because of Trump and whatnot. Perhaps people will say geopolitical risk is a big one. Regulatory risk was by far the one which kind of sort of, won out, right? And I think that kind of speaks to what we are talking about here, which is the fact that, as you I think put it very well, which is stroke of a pen. The risk of just changing regulations on a stroke of a pen. I think businesses are quite worried about. Yeah. I'm going to list out across the board maybe which are the sectors most impacted. But just a caveat before I do that, which is that the case here is not that regulation once set is set in stone, right? You set up an industry and the government wants private capital to come in, and that's the philosophical argument behind. I think if you're a regulator, you'd say, well, it's not as if we want private capital to come in. We want the industry to grow. We want players to come in. Yeah. But at some point, we have to ask who is actually benefiting, and I think that's how the regulators look at it. So it's not the case that, well, these are the rules of the game, and they should never be changed. I don't think that is the point. But in any case, I think we'll get into some of this stuff in greater detail. But just to list out some of the top ones, right? Hospitals, I think Ekta will talk about in much greater detail. It comes up every now and then. I think this is the fourth or fifth instance, but this is in a parliamentary panel report, which is, cap room tariffs. There's, of course, procedure costs, etc. A whole bunch. I mean, I think Ekta has been talking about 300 plus pages as she's gone through all of them.
Probably the only person in the country who's gone through all 300 pages.
and that's a big one, right? And I think we heard from CEOs, etc., which perhaps we play some sound bites out of as well. Airport operators, I think we just heard from Mr. Bhatia, which is, I mean, and of course we can discuss and debate and what's the global experience, etc., the pros, cons, how this happens, and is it a strict no? Is it or I mean this is allowed? So we can go into it. Insurance, right? And some of on the distribution side, there is a fair bit of thing which comes up. We're waiting for the distribution reform paper from the IRDAI. It's a little delayed. Dark patterns is something which I think the regulator has been talking about. But again, I mean,
some action also.
Not action yet. It's still in the deliberation stage, but we will see if something does come through there. Power exchanges, right? I mean, I think exchanges are supposed to be a dominant monopoly business and they're supposed to be money spinners. They are money spinners. IEX is the clear leader, but we've seen what happened. Coupling is essentially, so the nature of how price is discovered is proposed to be changed with the coupling norms. Again, something which we can go into. F&O norms, I mean, again, this is in the interest of public shareholder, the interest of retail investors. I think this week we will get the F526 report on what SEBI's own report about their assessment of retail loses money, not loses money, that famous 90% lose money kind of report. So, I mean, some of this stuff is, of course, intended to protect retail investors and, I mean, consumers in that sense. But again, I mean, this has an impact on businesses, which is the exchanges, the brokers, etc. Many of them which are listed. Most of them, the bigger ones, are all listed. The one positive thing, which I think is interesting, is this MDR and UPI, which I think perhaps goes the other way, which perhaps will open up a new revenue stream, which was not there till now. And again, I mean, I think we've seen what's happened with share prices of Paytm. So it works the other way as well sometimes. But of course, I mean, it's more negative than positive when some of these regulatory changes take place. Quick commerce, gig workers. Again, it's an evolving issue. There are lots of consultations which are going on. It's not kind of, set in stone. But I think, there are pros and cons. Convenience, perhaps it costs more if you kind of go in for some of the stuff which is being proposed versus, of course, protecting worker rights, rider rights, etc. So I think whole host. Autos is another area, right? I mean, I think which is, there's the CAFE norms, there's the mixing of ethanol. And, and of course, I mean, there is a pushback against consumers themselves in this particular case, right? So yeah, I mean, so this seems to be this seems to bear out that poll that I started by saying, which is regulatory risk across sectors, perhaps the number one.
No, absolutely. Regulatory risk is real, and we've seen that play out. As far as the online gaming sector is concerned, I mean, with one stroke of a pen, that was the end as far as online money gaming is concerned. And you want to talk about Delta Corp, Nimesh, and what's happened there?
As what Prashant pointed out, not only Delta Corp. So Delta Corp was one stock. Even IEX for that matter. So Delta Corp, I was just looking at the share price from a high of 350, it's quoting at 60 now. And that's across the board. Look at IEX, it was quoting at 300, now back to 125. Across even the insurance companies that he's talking about, from the recent peaks, all the insurance stocks in the last 3 years are down 35-40%. And this in the context that the markets have gone up and these stocks have underperformed. So clearly, wherever there is a risk of regulatory overhang, it actually, shakens the investors as well, and people have lost money. Investors have lost big amount of money in all those names.
Yeah, and again, as Prashant rightly pointed out, we're not saying that no regulation, or we're not saying that there should be regulation, cannot change or it cannot be dynamic. I think the question that requires an answer is to do a cost-benefit analysis based on data, because very often what may seem like well-intentioned moves or well-intentioned regulation may in fact end up having unintended consequences, which are then hard to reverse. And that's, I think, the argument that the hospital operators are making, Ekta, that look, don't go by anecdotal evidence, go by what the data is telling you.
Yes, absolutely. But, you have to ask that fundamental question that why exactly does the government want to regulate the healthcare space? That's because private healthcare is basically, bearing bulk of the burden right now. That's around 60% of healthcare is private at this point in time, and the prices are 7 times what you get in public hospitals. So that is the key reason. 70 to 80% of what you spend in terms of cancer care is out of pocket. Your average expenditure is 7.5 lakh rupees. So now patients have weak bargaining power, because if it's an emergency, you're not going to check which hospital you're going to. Neither do they have any kind of pricing transparency. It's all opaque. You go into a suite, it's a different pricing. You go to a double occupancy, it's a different pricing. So what the government is saying is that there should be transparency, there should be some standardization. It shouldn't cost you so much to get a PET a PET or a PET CT or an MRI if you have cancer, because that is all out of pocket at the end of the day. That brings you to the question about insurance, because there is this missing middle, 40 crore people, 30% of the population, which are not covered by either government or private insurance. So if you have some kind of cover for them, maybe that would be helpful. And that's what they're proposing, 4,000 to 6,000 rupees in terms of a bracket. Now, the other thing is, the key contention point is there's too much foreign capital which is coming into the entire hospital space, 51%. They're looking at some kind of maybe capping. They are okay with other sectors such as medtech getting, a lot more capital, but they are worried about hospitals getting so much capital. So that is the key reason. Now, we do need them. That's a simple debate that, the bed count is much lower than what the WHO has said.
Exactly. What is the bed count to start with? I mean, the kind of infrastructure build-out that is required to service the needs of the country, I mean, we're significantly lower in comparison to all the global averages, right?
Yes, absolutely. So we are currently 15 beds for 10,000 people. The WHO recommendation is 30 beds for 10,000 people. So who's providing those beds? The private space. By FY30, they're saying 20,000 beds will probably come about. After FY30, there will be more beds which the private space is providing. So they are doing the heavy lifting. What the public or the government probably wants is some kind of guardrails that, yes, you do the heavy lifting in terms of capex, but there should be some guardrails to provide an essential service at a subsidized rate.
Yeah, but I think that begs the question, right? I mean, yes, hospitals, education, an essential service, how do you price it? Can you leave it completely to the market? Or do you need some safeguards in place? But to the point about, how much foreign capital is coming in, the color of money, given the fact that you require all of this infrastructure build out, can we actually take that position of this is how much foreign capital we want in this sector, or this is whether there should be a cap on private equity ownership, which is again something that is being discussed at this point in time?
At some level, capital, I mean, it's not to make this or that, right? I mean, it's not as if private capital, local private capital is very different from foreign private capital. Capital is looking for a return.
Exactly.
They look for profits. It's looking for returns. The point is...
It's not more benevolent or less benevolent. Yes, they're all looking for returns.
Absolutely. And I think, as Ekta pointed out, which is the big issue is this insurance, which is that if you're paying everything out of pocket, then it kind of pinches more. And this, look, healthcare is also, because inflation has been such a big issue for the middle class. You started by Ekta saying that, I think, compared to government beds, I mean, public hospitals, insurance costs, hospital costs, private hospital costs, some 7 times higher. But the quality of the care or the experience or whatever, right? I mean, you want to call it at the end of the day, which is, I mean, it's just instructive to look at, and I was saying this on the program as well when we had all the hospital CEOs. So we got so much feedback on that parliamentary panel when, I mean, we put out details of what the recommendations were. Our audience, people perhaps who would be watching this, they're all saying, I mean, the feedback was, don't, this is working. This is costly, this is expensive, but this is working. This is all we have. So don't make this not work. Don't break what is not broken. You may fix it and the solutions. And I think all the hospital CEOs made that point, Ekta, which is that, maybe something is required to be done, but is this the way to do it?
Is price cap the way to do it is the question. Nobody is saying that, look, you should be able to charge whatever prices you want. But I think that comes back to the supply-demand issue as well, Ekta. If supply were to outstrip demand, the commercials, the economics would be very, very different. Today, the fact that hospitals are being able to charge a premium, private hospitals are being able to charge a premium, is because you have such a significant supply-demand mismatch, right?
So there are certain pockets where there is a strong amount of demand coming through. So there's Delhi, there's Mumbai, there are a couple of these smaller pockets. But if you look at it, Abhay Soy mentioned that the median age currently is 29. So you will, at eventually those people will become 40 plus. Those are the people who will need those hospital beds. And at that point, that supply will even out. So as of now, you might face a little bit of overcapacity, but that might even out eventually. We do have doctor shortages, we have, you know, nurse shortages. All of that needs to be sorted in the next couple of years for us to have that kind of accessibility, affordability, and that kind of capping in terms of rates because of the demand-supply situation.
You know, I've always, I mean, education and health, right? I mean, it's not about this government or that government. But the point is, I mean, these are, if you're going to end up spending, I mean, look at the uproar every now and then on social media we face on the cost of education, right? Schooling, which has gone through the roof. I mean, you know, we can do a whole program on that. But I think it is something similar, which is the fact that if you don't have the state offering quality education and healthcare at a certain...
And the state cannot abdicate these spaces. The state cannot shirk its responsibility. I mean, we've been talking about this healthcare budget going to 2.5% of GDP for every budget for the last 20 years. And we're nowhere close to that number. Similarly for education, I mean, we did that story the other day where the government's own data is telling you that in government schools, the dropout rate at higher, you know, secondary education is significantly higher than what we're seeing in the private sector. So the government, part of fixing this problem is also to fix government infrastructure, whether it's education or healthcare. But, you know, that apart, let's talk about aviation. And you know, we're 2.5 airlines virtually at this point in time. And as Rahul Bhatia was saying that, you know, you're only looking at what the airline is charging. You're not looking at ATF, you're not looking at UDF, you're not looking at landing charges, which is not what the airline is making at all. So sometimes we're addressing only part of the problem and trying to fix responsibility on one player, whereas it's an ecosystem and a holistic sort of assessment that you need to do.
I mean, I think... I'm not the aviation expert, but I think the aviation fare issue pops up
only when there
is like a crisis, or there's a crunch.
And you've also had checks and balances coming in as far as surge pricing is concerned. The government has stepped in and then it's stepped back as well. So there is a way of dealing with it, and we've seen that that play itself out, as opposed to having a sort of blanket, you know, let's come in and have a sledgehammer approach there.
I think there is a. I mean, I think we're all in agreement here. No cap.
Yeah.
But the point that the government has to.
Does it mean the same thing, by the way? In Gen Z, does no cap mean the same thing or not?
For no cap for real, I guess. But the point, like you said, I think each case has to be looked at it very differently. Hospitals, I think. What is happening is that there is an acknowledgement. I see what the parliamentary panel report has said, and the government's approach towards this is an acknowledgement of a problem that exists.
Yeah.
So I think to that extent, it's welcome. What do you do about it is, like you said, increase supply. And increase supply how? I think it has to come. And I think oil and gas gives us a very good sort of example of an essential sector where you can't let the pricing control go completely haywire. The government has to remain a significant stakeholder in the space and make sure that, it can control prices by being a player, by providing that supply at a reasonable
So
place.
that's what we're saying.
Yes, exactly.
So look, oil marketing companies. They're government companies.
Correct.
We are talking about.
So every time there is an election, they can cap the prices the way they want
So
to.
that's for the government
That's for the
company.
government.
This is for the private companies.
Those are 51% plus owned by government.
Correct. So,
Government of India.
similar model needs to come into healthcare and education, both, is what
But
I'm saying.
I have a slightly different view on healthcare. What people are missing out. Infrastructure is getting built by the government in some states for sure. Even for that matter, I mean, Ekta, you can say more about it. Look at the scheme that the government has put out on generic medicines. Okay, today I can see there are at least 2 or 3 private players who become really big in the generic market.
Yeah.
And they're actually providing drugs at 80%, 90% lower than the branded price.
Yeah.
Nothing changes. Only the brand, is on the cover and the prices changes, right? So even like for a state like Gujarat, I can tell you with my experiences, places like Baroda, places like Surat, Ahmedabad, the public, the government infrastructure and medical is very, very strong.
Same is true for
and very
Tamil
good.
Nadu and Kerala also.
But again, the problem is because of the perception, a lot of people don't want to go to government hospitals.
Yeah.
Though they are good, though they are well equipped.
This is a very interesting
So
example.
again, this is a problem as well. There are some good infrastructure created, but people don't want to use it. And they still want to go to the private place because they feel...
There is a perception problem as well. And that is
there are operational issues also.
So what I'm saying is we should not lose the sight on the fact that the government is serious and they're actually providing a lot of supply.
No, and I think you
bring
up a valid point there that look, the government needs to intervene to create an enabling environment to facilitate more investment, to facilitate more players to come in, and that is where the government should actually focus its bandwidth and its resources as well as its stroke of pen possibilities.
In fact, I believe if the government run organization which is into generic medicines, if they get listed, you'll get a huge market cap for that company.
But Nimesh, the generic medicines, you're absolutely right? I mean, they cost 1/10 of the cost of the whatever branded one, etc. But the point is that where is the delivery of the generic medicine happening? It is still happening through private hospitals. It's happening through public hospitals also. But I'm saying that we don't have enough of those in size,
and there is shortage of supply as well. So I'm not saying that there is enough supply as well, but I'm saying that one leap of faith that government has taken, private is also pulled in. Couple of players have come in and they're actually expanding big time into the generic markets as well. So
I don't think
it's going to be an
medicines is a problem at all.
No, I know it's not a problem, but I'm saying
India has a problem in terms of the cost of medicines. There might be some medicines which cost a lot, but normally all medicines are very cheap in India.
Compared to global markets, of course, it's cheap.
Yeah, so
but generic is
we've had price caps.
Even there we were discussing about price caps.
For medicines now for years now, for many years. Yeah, stents came in about 10 years ago.
2017. So it's stents, cardiac stents, knee implants, all of them have been price capped, but then the procedure costs go up if the cardiac stent prices go lower. So that's basically what the government wants to rectify. That if a person has a cardiac issue, needs a stent, if it's costing 25,000, you can't make up the cost in other ways. You should allow the cost to be low and allow him to have the stent, which is 25,000 rupees, and the entire procedure should be a reasonable cost.
But one interesting question I have. So we are obviously, we don't agree with price caps imposed by the government. But if you have an insurance policy, you know that your insurance provider puts a price cap on a lot of things, right?
In most of the
so when in such situations, how do we why should that cap? I mean, that's a market determined cap. Why can't this become a benchmark and something government builds along those lines? Why is that not acceptable? I'm just thinking out loud here.
This is an important conversation to have. We're keeping it going here on CNBC TV 18. We just had the CNBC TV 18 Market Forum take this up with all the top players in the healthcare sector in the country. We are going to continue to have these conversations. So if you have feedback, if you have suggestions, if you have recommendations on what you believe the government, the private healthcare sector, the private education sector, insurance sector should do instead of price caps, or do you believe that price caps are the answer? Write to us, tell us. We'd like to hear from you and keep the conversation going. But I hope that we don't have to go to a hospital anytime soon or avail of insurance. But on that note, it is time for us to wrap up this episode of the Editor's Playbook. Thanks very much for joining us. Do send us your feedback. We would love to hear from you.
Hello and welcome to News Center. I am Ashmit Kumar. US tariffs have so far not caused a major drop in India's goods exports to US. According to an analysis of trade data following the imposition of President Trump's tariffs, the US market accounts for 20% of India's exports, up from 17.4% in 2022-23. The US remains one of India's top trading partners. An analysis of India's goods exports to the US shows that between July 24 and June of 2025, Indian goods imports into the United States were worth nearly $100 billion. In the following 12 months, from July 2025 to June of 2026, the figure stood at about $97 billion, a decline of just over about 2%. This suggests that India's goods exports to the US have remained largely resilient. So while the tariffs have raised costs for several Indian exporters, overall goods exports have held up relatively well. The bigger question now is whether that resilience can hold if the tariff uncertainty persists. Trade talks between the two nations remain deadlocked, with the final 1% of the negotiations proving to be the most challenging bit. At the same time, India has signed trade agreements with several other countries as it continues negotiations with the US. Now, Bloomberg reports that it could take several years for this market diversification to deliver meaningful results. And well, joining us now to discuss this further is with us Ambassador Meera Shankar, former ambassador to the US. Also with us, former ambassador Ambassador Anil Trigunath. To both our guests, thank you so much for joining us. Ambassador Shankar, let me come to you first. Let me get your thoughts. Indian exports holding up firm, just a minor deviation of about 2%. There are two ways to look at this. I'll get the first perspective from you. Does this indicate that the Indian exporters are holding firm despite Donald Trump's tariffs?
Well, I think the tariffs have also fluctuated. I mean, it's in the middle of last year that tariffs shot up to 60%, to 50%. And then after that, the interim agreement on the principles that would govern trade agreement did away with the additional 25% tariffs on Russia. So we were broadly on par with a number of other developing countries. After the Supreme Court struck down those tariffs, which were imposed by President Trump under the International Economic Emergency Powers Act, the tariffs which apply to Indian goods are MFN plus 10% today. And there is tariff uncertainty because there's another 301 investigation which is going on. The 10% is on account of forced labor. The 301 investigation on forced labor, the outcome has been 10% tariffs. Now, with the additional 301 investigation on surplus capacities, particularly in areas such as solar panels, there is tariff uncertainty whether this is going to be the final shape of tariffs, MFN plus 10%, or will there be additional tariffs? And for India, the difficulty in finalizing a trade agreement is that even though the earlier agreement was unequal in the sense that India would be reducing tariffs, US would be increasing tariffs, but relative to tariffs imposed on other countries, there was a marginal preference that India got. Now that preference has come into uncertainty because there are no, 301 investigations against many of our neighboring countries or other developing countries under the surplus capacity clause. So it could end up that India has higher tariffs. I think what we are seeing is that trade remains resilient, but tariff uncertainty can impact the pace. And what we are seeing is that products which continue to go to the US market are broadly those which were not covered in the initial tariffs. Electronic goods, pharmaceuticals, generic drugs. These were all products which were not covered in the initial tariffs which were imposed on India, which covered about 40% of trade. The labor-intensive products, I think, have suffered somewhat. So we are seeing a shift also in the pattern of goods which are exported to India.
Right,
but
Ambassador.
The fact that trade is still resilient is good.
The fact that it's resilient, it's holding up, it's good. And that's where I want to bring in the other perspective with you, Ambassador Trigunath. One way, of course, is to look at it that the Indian exporters are holding firm. Again, that share of India's total exports to the US continues to be around 20%. But does this also indicate that despite earnest efforts by India to diversify its export markets by signing a whole host of FTAs, it's not quite yielding the kind of results? The idea was to de-risk Indian exports, to look away from the US as a market. That's not quite yielding the desired results. Would you say that?
Well, USA has been, as Ambassador Shankar has brought out all the points, the USA has been our largest trading partner for many, many years. And there have been a lot of complementarities and comfort level at the same time. And Indian exporters are also pretty smart. They also diversified into the areas in which there were less tariffs, or the others were basically trying to, before the tariff date was imposed, they tried to import much more quantities And therefore the storage was done in the US by various companies that were importing also. Because see, the American companies also wants to diversify their sources. For them, India is an excellent bet if you are going to diversify from China, for example. So despite these tariffs, and there has been mentioned that the tariff was graded and in different sectors, so not all sectors were impacted. Some of the sectors that were of use to the United States were not impacted that much. Of course, threats of tariffs and increasing them continued. There was a lot of vacillation on the part of the United States as well. That, you're buying oil from Russia for 25% more tariffs that had not directly impacted. So it was not a trade embargo per se, but definitely a lot of difficulty levels that were increased. Secondly, we were also talking all along. We were the first country to start talking about the trade agreement with the United States. Until now, we have not been able to complete that. But the fact that you continue to talk also provides you a certain kind of a cushion. Secondly, during the Iran war, we have seen that the Americans lifted even the sanctions on the Russian oil. And so I think that there are so many factors that have not really greatly impacted our exports. The services sector generally is broadly immune, and our half of the trade is in the services sector as well. So I think that that has also cushioned it to some extent. And that's why we see that. Secondly, you asked about the diversification. So while our businessmen have diversified within the US trade basket, a lot of countries, as you mentioned, we have about 8 or 9 FTAs that we have signed, or 10 more in the kitty that are likely to happen. But these have a delayed impact. It doesn't happen overnight. And I must tell you that the diversification as far as India is concerned, and I personally feel it is very good that President Trump has started on this track of putting more tariffs, that at least a wake-up call for you, that you can't take any relationship for granted. And it is important for us, and that's why India has gone ahead and diversified large, whether it's energy imports from Middle East or for that matter, exports or trade with the United States. So we are continuing to diversify. It will show its result. It will increase the resilience of the Indian trade market. And overall, you have seen $863 billion trade, which is the highest this time as far as the figures are concerned. So I believe that now India is running its rope much faster.
Sure. Ambassador Shankar, let me come to you then. Mark Linscott, the US TR under Trump 1, he wrote an article not very long back, just a few hours back, where he said that, look, maybe perhaps there is some kind of initiative required on part of the two leaders to actually build more momentum into these talks. Is that what's required, or is there flexibility that India needs to show on a few counts, US needs to show on a few counts for there to be a realistic deal going forward?
I think India has shown quite a degree of flexibility. I don't think there's much scope for more. But the US, I think, has to be pragmatic about what it is possible to achieve, because any trade agreement to stand the test of time must be seen as fair by both sides and yielding outcomes for both sides. So I think that it's something where we will persist in our talks with the US, but it is the US Supreme Court judgment which introduced this element of uncertainty, because you have these 301 investigations going on. So there is tariff uncertainty, which I think we would need to have settled and to be clarified before any deal can be finalized. And B, we need to have certainty that the preferential nature of tariffs, even though it was not very great, remains for India. I think these two factors would be critical as far as India is concerned. But yes, our efforts to diversify markets, to explore other large markets like with the EU, certainly, I think, give us more options. But, as was mentioned by the earlier speaker, Ambassador Trigunayar, there is a certain synergy which has developed between Indian companies, particularly in the services sector, and the US market. It's difficult to explore and build new markets. Plus, I think you have to create capacities in India which cater to those markets. And unfortunately, not much domestic investment has been taking place in expansion or in developing globally competitive areas of new industry. I think Apple is a remarkable success, but we need to multiply that manyfold.
We need to build more on the successes that we've seen. I'd like to thank both of our panelists, Ambassador Shankar, Ambassador Trigunayat, for their key insights. The Indian exporters holding up firm at this stage, but how long can that continue? Will there be a need for clocking some kind of interim agreement in the near future? A question that many exporters will find themselves asking. With that, it's time now for slipping into a very short break. But coming up next, Tamil Nadu Chief Minister Vijay has announced that all the state's 234 MLAs will get a car, a 75,000 rupee allowance for fuel, driver and maintenance expenses. They will also be given 25,000 rupees to hire a secretary for official work as well. We discussed that on what that implies for the state administration on the other side. Welcome back to News Center. Now, Tamil Nadu Chief Minister Vijay has announced that all the state's 234 MLAs will get a car, a 75,000 rupee allowance for fuel, driver and maintenance expenses. They will also be given 25,000 rupees to hire a secretary for official work. Now, justifying the expense, Chief Minister Vijay said that MLAs need to travel to their constituencies frequently to address people's problems. He added that many of the MLAs have been elected for the very first time and come from very humble backgrounds, so they need an official vehicle to discharge their duties. Now, Vijay's announcement came after VCK MLA Jyotimani requested cars, saying that they cannot work effectively without the required logistics support. Several legislators welcomed this move. School Education Minister Raj Mohan said that the provision would also create employment opportunities for drivers and assistants. The news garnered a lot of traction, with many netizens questioning why this was necessary. Many even shared a clip of Manikarkari MLA's S. Kamaraj, who said that some MLAs have 3 to 4 cars of their own, but they would be happy to travel in a car provided by the Chief Minister. The move comes months after CM Vijay took oath as Chief Minister. During his oath taking, he accused the DMK of emptying the coffers of the state. Now, earlier this month, TVK's first budget pegged the revenue deficit for FY27 at 1.37% of the gross state domestic product. That's an increase of 1.2% from the interim budget tabled by the DMK before the elections. Now, Tamil Nadu's total outstanding debt is expected to reach 10.98 lakh crore rupees by 2027. This translates to about 27% of the GSDP. So what will these perks, MLAs, mean for the state's coffers? Well, joining us now to discuss this further is with us Shabir Ahmed, senior journalist. Also with us, Sumant Raman, political analyst. To both our guests, thank you so much for joining us. Shabir, let me come to you first. When we first saw the election campaign by TVK Chief Vijay, at the time he came to power, he led the campaign by saying that this will be a case of clean governance, that the TVK will ensure that it will serve the people. Now we have the optics being reversed where he's seen by some as rewarding his own MLAs. Will that work against him, against his government going forward?
Ashmit, I don't think so, because this is a scheme that has been announced for all the 234 MLAs. It's not only for TVK party MLAs. It's a demand that was placed by an MLA who is from VCK. Because what has happened in Tamil Nadu is that there are a lot of MLAs who have been elected to the assembly from a very humble background. They do not have caste. And they have been finding extremely difficult to, to visit their constituency or even other parts of their constituencies. That is one of the reasons why they have been asking that caste should be provided to them. In fact, in the past, there have been several schemes that have been announced for MLAs. Like even now, MLAs would get a lot of concessions in terms of travel allowance, in terms of even if they want to buy a new car, there is a concession for MLAs that is available. But in this case, there was a demand that was that came in from MLAs from different quarters. Some of the MLAs are still using public transport. So I think based on that, the chief minister had decided that a car and also an allowance of 75,000 rupees for the maintenance of the vehicle and the other expenses, and also 25,000 for a personal assistant is required, because I think this is reasonable. If you give them these amenities, maybe the MLAs will be able to work even more better, and there'll be more accountability, because if they don't have these facilities, these basic amenities, they will have to look out for other sources of income. So that is that.
Briefly interject there. I'll just briefly interject there. The Tamil Nadu Payments of Salaries Act, under that, the MLAs are entitled to a salary, a constituency allowance, vehicle allowance, telephone allowance. That adds up to over 1 lakh rupees. That's over and above, of course, there's a travel and housing and medical benefits as well. This is before today's announcement by Chief Minister Vijay. So the question that many are asking is that they were already getting a lot of entitlements. Why are we giving them more?
That's absolutely right. They were getting a lot of entitlements. Now, when it comes to their travel allowance and car, I think there's going to be some kind of change. If the government is going to provide them with, with a vehicle and a personal assistant, I think there'll be changes that will be made in these allowances that they have already been getting. As far as ministers are concerned, the ministers have a bungalow here. They have been provided with different set of concessions. So I think the MLAs were also asking for some basic amenities to be provided so that they can work effectively. I think that was one of the reasons why the government decided that providing a car and an assistant and 1 lakh rupees is not a big deal. Is what I think that is something that the government has thought. But if you want to make it even more accountable, then there has to be some kind of guidelines, some kind of SOPs, to ensure that this is not misused. I think that's the larger question, because MLA is getting a car.
Speak on the
which a lot of people say it has become a basic necessity now.
Sure. Let me also get Sumant Raman, he's joining us now. We were trying to get him on a video line, but it was slightly patchy, so we have him connected on an audio line. Mr. Raman, thank you so much for joining us. We were going through your Twitter posts. You've done some back-of-the-envelope calculations. What, in your estimate, will be the annual impact of these provisions, these entitlements now that have been announced by Chief Minister Vijay?
Yeah, I think the initial cost is about 50 to 60 crore for procuring the vehicles. Thereafter, the allowance of 1 lakh means 234 into 1, that's 2.3 crores. Approximately, that would be around 28 crores a year. So over 5 years, that comes to about 140 crore. Overall, this scheme will cost the government about 200 crore over the 5 years. Now, 200 to 250 crore is not a big sum for the government. It's not that. It is the fact that the vast majority of these MLAs already have vehicles. Many of them have SUVs. Many of them have. In fact, the MLA who stood up and said, I don't have a car and the Chief Minister has given me. I just went through his election affidavit, which shows a Tata Tigor vehicle mentioned as in his affidavit. So I'm a little surprised that this has happened. Now, every state MLAs will start asking for this. And the fact is, some of the richest men in the state are sitting in the assembly. They may not be part of the TVK, but certainly the DMK, some of the DMK MLAs are among the richest in the country. So to give them a car and 75,000 rupees allowance.
Mr. Raman, the question being raised is that the traditional politicians, the ones with the AIA, DMK, seasoned politicians who've been there, who've done that, they may have the financial backing, but the newer faces in the assembly, the newer MLAs may not have that financial backing and therefore they need that support. That's the argument being made by Chief Minister Vijay.
By all means, give them a grant. Let them get themselves a vehicle, give them the allowance. Nobody is getting a fuel allowance being given to MLAs. But the point is, most of them already have cars. Now, this is supposed to be a second car for them. I'm not able to understand the logic behind it. If 20 MLAs don't have a car, then logically you would say you either give them some kind of grant, and if it is a small number, they would even have been given cars from the party. Why would the government have to do it? This is not all states in the country.
I'll just have to interject there, Mr. Raman. We have you on a patchy line. We'll try to restore your connection on a better line. But until we do that, let me get across to Mr. Ahmed. Mr. Ahmed, again, the question that Mr. Raman is saying that, look, the very MLA that raised this question that I need a car already has a vehicle against his name. Why do we need MLAs having 2 to 3 vehicles?
No, I absolutely agree with what Sumansi Raman is saying, because even if you look at councillors arrive for council meetings in a swanky SUV. So there are MLAs who have, more than one car. And in fact, to talk about DMK and AIADMK MLAs, both DMK and AIADMK MLAs have, declared in their affidavits that they all own vehicles, and they are one of the richest MLAs in the country, richest politicians in the country. So, as far as if you just compare that with the TVK MLAs and their background, whether they have the required infrastructure to discharge their duties as a member of Tamil Nadu Assembly, probably I would say, they don't have the required amenities. As of now, it looks like that, and that is one of the reasons.
That's an interesting data point that will emerge. A comparison of the assets disclosed by the two sets of leaders there in the assembly. But before we end, Mr. Ahmed, I'll come to you for a quick question, a broader point. Is there a case to be made that these are our electors, they represent us here in the assembly? Should they be paid even better to ensure that they don't fall prey to quid pro quo, they don't fall prey to bribes? Should we pay them even better? Right now, before these benefits, they were entitled to about salary dues of 1 lakh. Should that be increased exponentially to ensure that our leaders who are in power, who are representing our interests, perhaps don't fall prey to corruption, to bribery?
Well, Ashmit, that's a larger debate. Like, if you ask me, whatever they are being provided now is more than enough for them. In fact, they have allowances for almost everything. They have a quarters here, they have hostels, and offices are provided to them. All they require is some sort of basic amenities to which are mandatory, I feel, because if you want to discharge your duties as MLAs, like you will be having to travel, crisscross the entire constituency. You will be having several official events and other events, and you will have to attend all these events. And I think, the MLAs, they are under some kind of pressure because, the amount of money that is required to even, do the basic thing in your own constituency for your own expenses. I think that cost is a lot, and something that I've been hearing from all these MLAs and ministers is that on a daily basis they are forced to spend a lot of money, to even be there as MLAs.
That's the argument that Chief Minister Vijay and his party will be making on the floor of the House, on the floor of the Assembly. Whether or not it evolves into some kind of political conspiracy, we'll of course have to wait and watch. I'd like to thank both of our panelists, Mr. Raman, Mr. Ahmed, for joining us with your valuable insight. With that, it's a wrap on this edition of News Center. More news and updates will continue right here.
distinguished guests, colleagues from banking and financial industry, ladies and gentlemen, namaskar, and very good afternoon to all of you. It is a privilege to address this distinguished gathering at the 4th edition of CNBC TV 18 Banking Transformation Summit. This year's theme captures, I think, exactly the right subjects for our times. Scaling Bharat, banking with responsible AI. And it gives us a timely opportunity to consider how responsible innovation, governance, prudence, and trust might define the next era of Indian banking. Let me begin with a story. One I return to wherever I think about what it means for banking to serve a country like ours. More than 3 decades ago, NABARD, with support of the Reserve Bank, launched a modest pilot linking about 500 self-help groups to the formal banking system. Their members had little conventional collateral, no credit history, and barely any documentation of income. And yet, their repayment capacity turned out to be strong, borne out month after month in the performance of those microloans. This savings-led microfinance model has now become the largest coordinated financial inclusion program in the world, covering almost 100 million households in the country, with more than 84% of the groups being exclusively women groups. The program has provided much-needed push to empowerment of women in the country. The point I wish to draw from this is not that the program succeeded, though it did remarkably. It is that the information relevant to lending was never actually absent. It was there all along in the discipline of savings, in the rhythm of regular meetings, in how closely members knew one another's circumstances, and in mutual accountability. What formal finance lacked was not the information, but a means of using it. And even today, in far more sophisticated markets, economic capacity often exists quietly, waiting for formal systems to develop the means to recognize it. And today, the means have arrived in the form of artificial intelligence. The question before us is how well and how responsibly we choose to use it. 4 days ago, from the rampart of the Red Fort, the Prime Minister spoke of training 1 crore young Indians in artificial intelligence within the year, so that India leads rather than follows in this field. I read that as a statement of intent and exhort you to ensure that innovation is rapid, at the same time accompanied by robust safeguards applied with judgment, and underpinned by accountability. That, in essence, frames the three themes I want to speak on this afternoon: growth and capacity, intelligence and prudence, and trust and responsibility. With responsible AI adoption, which the governor spoke of so lucidly at the last FIVAC last week. Let me turn to my first theme, growth and capacity. Let me start with where we stand. India's banking system today is well capitalized with a capital to risk-weighted assets ratio of 17.7%. It is profitable, with profit after tax exceeding 4 lakh crore. And it is healthy, with gross non-performing assets down to 1.8%. Stress test suggests that the system is well placed to absorb adverse shocks. Why does this matter? Because this strength is not an end in itself. It is the capacity that allows the system to support a larger and more complex economy. And here I would enter a caution. The contribution of banking to growth should not be measured only by expansion of aggregate credit or by the size of balance sheets. It must also be judged by whom finance actually reaches, whether rising consumer expectations are met, and how banks support the wider economic activity. On this count, there is a real progress to report. The Financial Inclusion Index rose to 70 in March 2026, up from 67 a year earlier, an improvement driven largely by usage rather than by mere access. Inclusion acquires real economic value only when consumers can understand the financial choices before them, manage their finances, appreciate the risk involved, choose credit and investment products suited to their needs, and know their rights and responsibilities. The Reserve Bank, for its part, continues to advance this agenda through the National Strategy for Financial Inclusion and the National Strategy for Financial Education. Financial inclusion remains, I believe, one of the India's remarkable achievements. Its next phase must deepen digital inclusion while ensuring that those who need assistance or other modes of access are not left behind. AI has a meaningful role to play here, helping the system recognize capability wherever it is expressed differently across language, location, livelihood, gender, and channel, and using the data prudently to make financial services more accessible. Consumer expectations, of course, are not uniform. A younger, digitally confident customer in a rapidly growing economy such as ours may prize speed, convenience, and real-time information. An older customer or one less at ease with technology may value assisted access, personal interaction, and reassurance on security. A retail customer may want simplicity and predictability. A small business may need timely credit, flexible servicing, and products built around uneven cash flows. Banking, in other words, must scale across channels and across forms of engagement. Growth also brings greater variety and greater complexity in products, technology, in delivery arrangements. A single deposit or loan relationship today may involve digital onboarding, consent-based data sharing, automated and increasingly model-driven assessment, partnerships with other banks, non-banks or fintechs, and servicing through apps or third-party providers. These arrangements widen reach and convenience considerably, but they also demand clarity. Clarity about who is responsible for product suitability, for the use of data, for service quality, and for continuity across the entire delivery chain. As banks grow, as their reach, their transaction volumes, and their delivery arrangements expand, their capacity must keep pace. Systems that perform well at today's volume may behave quite differently at tomorrow's scale, and that calls for timely upgrades in technology, in processes, in oversight, all of which innovation can help deliver. Banks should focus, in particular, on the function critical to their resilience and on those that matter most directly to their customers. Resilience, I would argue, should be built into design of growth, not bolted on after the expansion has already happened. And this requires people as much as requires technology. Institutions need people capable of understanding new systems, of challenging models rather than simply trusting them, of overseeing external providers, and of connecting technological change to financial and conduct outcomes. As machines take over more of the routine tasks, what becomes indispensable is human judgment, validating a model, assessing its outcome, and stopping it when it begins to go rogue. And this shift requires institutions to reskill and to grow their capability. Let me turn to my second theme, intelligence and prudence. Growth of this kind, capacity that keeps pace, that reaches wider, that serves better, is, in substance, not merely a growth of bank's balance sheet. It is the emergence of stronger and more capable financial system, one that truly supports customers and the economy. And this is precisely where intelligence comes into play. Like growth, intelligence has wider connotation than artificial intelligence alone. I would think of it as at four levels which are symbiotic in nature. First, analytical intelligence of data, models, and technology, where AI certainly belongs. Second, human intelligence of experience, knowledge, and judgment. Third, governance intelligence, the ability of boards and senior management to oversee an institution wisely. And fourth, collective intelligence, which emerges at the level of system when information is pulled across banks. The value lies less in any one of these than in how well they are combined. Let me offer a slightly different perspective on credit growth because the numbers are telling a more complicated story. In 2022-23, 52% of fresh businesses entered the formal credit system. By 2025-26, the figure had fallen to 42%. Even as outstanding commercial credit grew by 14% over the year. This did not happen for want of information. Lenders today have access to rich data and materially stronger analytical capability than at any point before. It points to something more structural, that our data and our technology may be getting better at serving those the system already understands, faster than they are developing the capacity to understand those it has never served. This is not a new problem in economic thought. In 1970, George Akerlof showed how information asymmetry can produce adverse selection and shrink a market below what the underlying economic opportunity would justify. Extend that insight to credit. Where a lender genuinely lacks a reliable information about a borrower, the absence of information should not, by itself, be mistaken for adverse information. Treating "we don't know" as though it meant we know it's bad leads to a credit being denied where it need not be. This is precisely where banks must put their technological capability to work. So there is that intelligence. So where is that intelligence to come from? Traditional lending leaned heavily on collateral, financial statements, and credit bureau history. That world has expanded considerably. Cash flows, GST filings, utility payments, e-commerce records, mobile usage, agricultural and geospatial data. These alternative data offers a genuine opportunity to bring credit invisible into the formal system, and AI can help close that gap. The challenge lies in transforming conventional systems so that they can interpret information that does not arrive in readily usable form. An audio recording in which a borrower describes the purpose of a loan and the revenue of her business in the language she is most comfortable with, an image of a crop, an inventory or a physical asset, weather patterns that shape seasonal cash flows. Captured with consent, tested for reliability and bias, and used responsibly, this can become evidence that strengthens human judgment. Much is made, and rightly so, of the productivity these technologies promise. Work that once consumed hours of skilled attention, reconciliation of records, summarizing a credit file, answering a routine query can now be compressed into minutes, releasing capacity for judgment-intensive work that only people can do. But I would ask that we be careful how we measure that gain. Productivity in banking is not merely output per employee or the cost-income ratio. It is whether the same institution with the same resources reaches a borrower it could not reach before, resolves a grievance that would earlier have remained pending, prices risk more accurately. If AI compresses costs without widening reach or improving customers' experience, we shall have automated the existing system rather than improved it. A more consequential use is pattern recognition. AI can read not only structured indicators, but audit observations, incident narratives, customer complaints, and system logs together, identifying connections that may not be visible to single function, and so help a bank act as emerging weakness in fraud, conduct, operations, or cyber risk before it becomes a disruption. As adoption of AI increases, banks must retain the judgment, the capability, and the alternative arrangements needed to intervene when systems fail or behave in a ways that were not anticipated. The ability to remain resilient in such circumstances is itself a critical organizational capability, form of intelligence. The ability to recognize, adapt, and respond when the unexpected occurs. AI can improve consistency, cut processing time, surface patterns that conventional analysis might miss.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Crude oil prices climb as US and Iran continue to make contrasting claims on the Strait of Hormuz. UAE snaps trade ties with Iran over alleged missile attack. Iran denies the charges. Israel bombs an airbase in Syria, drawing condemnation from the US and Turkey. The United States remains India's largest export market despite Trump's tariffs. The US accounted for about 20% of India's exports in July amidst the government's diversification push and exporters looking for newer shoes. Commerce Secretary says India is focused on exports to economies who account for two-thirds of the world's GDP. US President Donald Trump announces a 3-day pause on 50% tariffs on Canada just hours before they were set to take effect. Trump says the two nations are nearing a deal. The White House says Canada has agreed to make certain concessions. Sensex and Nifty decline for the 7th straight session. Nifty manages to stay above 24,000. Rupee weakens against the dollar and moves closer to the 96 mark. NSE expects SEBI to approve its IPO papers in 2 weeks. Sources say the issue is likely to be launched in the second half of September, valuing the exchange at more than 5 lakh crore rupees. 2026 has been the year of mid-sized IPOs. So far, 70% of the sub-1,000 crore listings this year have given positive returns. The last 6 listings on Dalal Street, including Shiprocket, gave an average listing premium of over 35%. Do not try to manipulate to defame the new closing auction session, warns SEBI Chairman Tuhin Kanta Pandey. Says the new system is intended to improve transparency and any attempt at manipulation can be detected relatively easily. National Company Law Tribunal imposes a 15 lakh rupee penalty on SpiceJet and its lessor Aviator ML for a last-minute deal to settle the 60 crore rupee case. 7 other lessors have claims of around 500 crore rupees against SpiceJet, and those cases will now need to be heard once again. A landmark child safety trial against Facebook and Instagram begins in California. 29 US states are seeking damages of about $200 billion, claiming the social media companies are addictive by design and harmed children. All right, to the top story this evening, Iran-US talks stuck at an impasse. Iran has tensions escalate amid attacks on the UAE. The United Arab Emirates said it was cutting all economic ties with Tehran after accusing Iran of firing ballistic missiles at its territory, ramping up regional tensions. One of Iran's main commercial partners said it would halt trade and financial transactions with Iran until further notice. Tehran has denied that Iran's parliament speaker Mohammad Ghalibaf has accused the US of trying to force more concessions from Iran. Meanwhile, Iranian Foreign Minister Bazar said the US is now begging to negotiate on Iranian conditions. This after US President Donald Trump said no talks are underway or scheduled with Tehran. The Financial Times reported that Iranian officials have weighed the possibility of targeting US military assets based in Europe. Crude oil prices remain above the $90 mark as tensions remain high in the Strait of Hormuz. Kepler data shows that traffic through the strait dropped significantly last week. Confirmed crossings fell 19.5% to 95 transits. Data also shows that more than 80% of vessel transits through the strait over the past 2 weeks have taken the Omani route. The US condemned Israel after reports that it struck a Syrian military airbase near the Turkish border. Washington called the attack an unnecessary escalation. 8 airstrikes hit an airport runway and storage facility in the country. Israel said Syria was on the verge of breaching the security status quo. Tel Aviv also accused Damascus of allowing Turkish troops to deploy to the airbase. From one war-torn region to another, former Defense Minister of Ukraine, Mikhailo Fedorov, is calling for elections even as the war with Russia continues. Now, Fedorov warns a legal, safe and realistic way to restore Ukraine's democratic process while raising concerns over governance and corruption. Fedorov was removed as the Defense Minister in July, 6 months after taking charge. His removal led to protests in Kiev. Ukraine has not held elections since Russia's full-scale invasion in 2022. Meanwhile, a drone strike near the Zaporizhia nuclear power plant has killed 1 nuclear specialist and injured 17 people. Russia has blamed Ukraine for this attack. US President Donald Trump announced a 3-day pause on the 50% tariffs on Canada just hours before they were set to take effect. In a post on Truth Social, Trump said Washington and Ottawa had reached a deal subject to finalizing documents. Canadian Prime Minister Mark Carney said the two sides had made substantial progress, but important work remained. The tariffs would have hit around $20 billion worth of Canadian goods. All right, on to the day's market action. The Dalal Street ended lower for the 7th straight session. Nifty managed to hold on to the 24,000 mark with at least 34 stocks closing lower. Sensex fell over 300 points and the Midcap index slipped over 130 points. Financials relatively outperformed with Nifty Bank closing near flatline. The IT index batted for the bulls, ending over 0.5% in the green. SEBI Chairman Tuhin Kanta Pandey has warned that any attempt to defame the closing auction session through manipulation will be dealt with sternly. Speaking at an event, Pandey said that the new system is intended to improve transparency and any attempt at manipulation can be detected relatively easily.
सिस्टम में मैनिपुलेशन पकड़ने के आसान मतलब जो हमारा वो है वो ज़्यादा अधिक है हमारी कैपेबिलिटी पुराने वीवैप सिस्टम से की अपेक्षा जो कैश सिस्टम में हम रिलेटिवली इजीली मैनिपुलेशन को पकड़ सकते हैं तो इसलिए ये आपको ये देना होगा कैश ट्रांसपेरेंसी के लिए है और वो लेकिन यदि कोई ये समझ रहे हैं कि हम उसका कैश को नाम बदनाम करने के लिए मैनिपुलेट कर लेंगे तो वो बहुत ही धोखे में होंगे.
Logistics giant Shiprocket has made a bumper debut on the bourses, listing at a 35% premium. The 1,600 crore rupee IPO was subscribed nearly 100 times on the final day of bidding. Speaking to CNBC TV18, company CFO Tanmay Kumar said the company plans to tap over 1 million MSMEs in the next 5 years.
Essentially, every piece of revenue growth that we see will keep adding to the bottom line. We are not, folks, we are not just looking at this 2 lakh base or a 6 crore vision, but our aim over the next 5 years to get to a million plus MSMEs, and that is the number that we want you to, we want to tell you that we are all committed for and we want to go for.
And staying with IPOs, the National Stock Exchange expected SEBI's approval for its public issue within the next 2 weeks. Sources have said that the price band may be launched early next month, with a launch expected in the second half of September. This has come after the stock exchange received a no objection certification from SEBI. 2026 has so far been the year of mid-sized IPOs, with 70% of listings below 1,000 crore rupees delivering positive returns. The last 6 IPOs, including Shiprocket, have also given an average listing premium of over 35%. Over 54 companies have raised close to 7,000 crore rupees this year. Hormaz is here to decode the IPO trends so far. Hormaz.
We are at that stage of the year where the IPO activity has started to pick up again, and based on the number of IPOs that are set to open at least until next week, the number of IPOs this year have now reached 50% of what it was in 2025. So we had over 100 IPOs last year. We have now reached 54. That is until the IPOs that are set to open until the 24th of August. Now, if you take a look at the number of IPOs, the relatively quiet first half of the year in terms of the IPO market, 20 IPOs between January to June, then we have already had 34 that have opened or are going to open going forward in the next couple of and over between this month and of course until August. Now, if you take a look at the number of IPOs in the size wise, according to this data from Prime Database, we have not had an IPO that has been more than 10,000 crore in size. Now, the number of IPOs, the smaller ones are the ones that are garnering the majority. 34 IPOs out of the 54 have been sub 1,000 crore and so on. But this is not a new trend. If you take a look at the last 5 years as well, the number on an average, at least 2/3 of the IPOs every single year have been less than 1,000 crore in size. But it is this 1,000 crore IPOs sub 1,000 crore IPOs that have had better returns in terms of the value that has been created for these. Now, if you take a look at the average listing, the number of IPOs sub 1,000 crore, 28 of them have been completed and listed so far, and out of them, 20 of them have delivered positive returns and only 8 have delivered negative returns. Now, take a look at the average listing premium. For a sub 1,000 crore IPO, the average listing premium has been 8.3%, but for a more than 1,000 crore IPO, the average is 11.7%, but there's a catch here which we'll get to in just a bit. But take a look at the last 6 listings. The last 6 listings have all been sub 1,000 crore and the average listing premium has been 35%. Now, why I spoke about the catch is because for IPOs more than 1,000 crore, if you exclude Bharat Coking Coal, which listed at a 96% premium, the average of that drops to 5.9%. So it comes down to the fact that the sub 1,000 crore IPOs have a healthier average listing premium compared to the greater than 1,000 crore IPOs. Now take a look at the best performing small IPOs this time around. Omnitech Engineering is up 150% from its IPO price. GSP Crop, One EMI Tech, Gaudium IVF, Laser Power, all of them have seen gains of anywhere between 50 to 90% in comparison to their issue price. Now take a look at the worst performers as well. Of course, it does not mean that the smaller IPOs have all delivered outsized returns. There have been some that have underperformed as well. Shriram Twistech, it's down 62%. Innovision, Astha Spintex, Amirchand, all of them have declined anywhere between 15 to 50%. But the IPO pipeline is only picking up, the activity is only picking up in the primary markets, even though the secondary markets have not gone anywhere. Gaja Alternatives IPO has opened for subscription today. Tencent's Instruments will open for subscription tomorrow. And we have 2 already that are lined up to open next week with Skyways Air and Symbiotech Pharma. And then, of course, the 2 mega IPOs that the street is awaiting with bated breath is the IPO from Reliance Jio and, of course, the big NSE IPO as well. So the IPO activity has only started to pick up as we draw closer to the end of the year. And, of course, there's some mega fundraising activity lined up going forward as well.
Right, thank you, Harmaz. Moving on, US remains India's largest export market despite the 10% tariff blow. As per latest available data, share of exports to the US have stayed unchanged over the past year and stood at 20% in July. Abhimanyu Sharma joins us now. Abhimanyu.
Well, the total share of exports which the US market comprises of India's total exports is around 20% in the past 1 year. Now, this is despite the levy of tariffs which ranged from 50%, then dropped to 18%, and currently 10% plus MFN tariffs continue to apply on India's exports to the US market. Now, in a bid to diversify into different markets, not just to hedge risks due to tariffs and other uncertainties, but also to expand opportunities for exporters, India is already in talks and has also signed and finalized several free trade agreements in course of the past few years. Now, speaking about the past 1 year itself, several free trade agreements have come into operation. The first was the FTA between India and the European Free Trade Association, which comprises of Switzerland, Norway, Liechtenstein, and also the other FTAs which came into force included the FTA with the United Kingdom and Oman. FTAs which already have been finalized include the ones with the European Union and New Zealand, which are yet to be implemented. They are yet to come into force. Again, talks have already concluded between India and the United States, but the FTA, the BTA rather, the first tranche of that is yet to come into force. So clearly, the government is making all efforts to expand the overall export market, not just to hedge risks for exporters, but also to ensure that there is an overall export market which opens up even for products which are not being exported for now. So the government has also come up with a plan in which they are supporting exporters through the Export Promotion Mission, through ROTTEP and through several other schemes in order to ensure that any levy of tariffs and also other uncertainties which have prevailed in the past 1 year due to either the crisis in the Strait of Hormuz or other global uncertainties do not adversely impact the profile as well as the overall impact on India's exporters.
All right, thank you, Abhimanyu, for that. Moving on, the government has approved a new incentive scheme to fast-track piped cooking gas connections. The scheme will come into effect from the 1st of September. City gas distributors will get an extra 200 standard cubic meters of cheaper domestically produced gas for every new build household connection above a fixed threshold. The government said this could cut companies' payback period on PNG infrastructure from 10 years to just about 3. Aster DM fell over 2% after nearly 6 crore shares changed hands in block deals worth nearly 7,800 crore rupees. The shares changed at just over 769 rupees apiece. In some relief for SpiceJet, aircraft lessor Aviator ML has withdrawn its insolvency plea after the two sides reached a settlement over dues of around 60 crore rupees. The move has forced the NCLT to hold back verdicts in 7 other pleas worth over 500 crore rupees. The tribunal called the last-minute settlement a fraud on the court and fined both SpiceJet and Aviator ML. Now, Ashmit Kumar is here with the details. Ashmit, please take us through what transpired in court.
Well, a big relief coming in as far as SpiceJet is concerned. Bear in mind, the NCLT was supposed to pronounce judgment in a case of 8 petitions, 8 insolvency petitions against SpiceJet. However, as this matter came for pronouncement before the NCLT, SpiceJet appeared, their counsels appeared, and they informed that they've managed to settle the payment dispute with one of the 8 lessors. That one lessor was Aviator ML. The amount in question was about 60 odd crore rupees. They've managed to agree on a settlement. Aviator ML withdrew its petition. But what's interesting is that the NCLT noted that, look, this one petition, the Aviator ML application, was interconnected with the remaining 7. All 8 were interconnected, and because of that, the NCLT said that because there is a settlement that is reached with one of the parties, they cannot pronounce their orders on insolvency against SpiceJet in all 8 of them. So essentially what has happened is that one petition has been withdrawn after a settlement. There are 7 others that were due to have orders today. They will now be reheard afresh because one of the 2 judges hearing this matter in the NCLT is due to retire today. So a new bench will be constituted. The 7 of them will be heard once again. And bear in mind, this is significant given as how while Aviator ML had dues of only about 60 odd crore rupees, the remaining 7, their aggregate claims add up to about over 500 crore rupees. So to that end, SpiceJet buying itself time. The orders being deferred right now, the cases to be reheard once again. And again, aggregate claims over 500 crore rupees. SpiceJet managing to defer the judgment by settling with one lessor for a settlement sum of about 60 odd crore rupees.
Right, thank you, Ashmit, for that. We'll take a short break. Coming up next, a landmark child safety trial against Facebook and Instagram begins in California. 29 US states are seeking damages of about $200 billion. That and much more once we return. Welcome back. You're watching Business 360. At least 9 people died after a massive fire broke out in a building that housed several hotels in central Kolkata. The deceased include a 4-year-old child. Authorities say Bangladeshi nationals were among those killed, with some reportedly in Kolkata for medical treatment. Preliminary investigation found that the hotel lacked basic fire safety measures. At least 34 children fell ill after eating a midday meal in a Bihar school where detergent was reportedly served instead of salt. The children complained of a burning sensation in their throats and stomach pain, causing panic within the school premises. Political tensions escalated in Bihar after RJD leader Tejasvi Yadav was detained by police during his party's Raj Bhavan march in Patna. The protest was organized to demand answers from the government over the alleged use of an AK-47 rifle during a student protest in Siwan district last month. RJD supporters were seen climbing onto the roof of the police vehicle in which Yadav was detained. Vijay-led Tamil Nadu government has withdrawn an order directing colleges to prevent students from joining protests organized by political parties. The now withdrawn circular had specifically referred to protests conducted by left parties and the Tamil Nadu Cockroach Janata Party. Andhra Pradesh IT Minister Nara Lokesh has assured the Assembly that Visakhapatnam's data centers will not affect the city's drinking water supply, calling concerns over their environmental impact deliberate misinformation. He said the center's water needs will come from the industrial allocation of Polavaram project water with dedicated pipelines. A landmark child safety trial against Facebook and Instagram has begun in California. 29 US states are seeking damages of about $200 billion, claiming the social media companies are addictive by design and harmed children. Rachna Dhanrajani joins us with more details. Rachna.
That's right. Overnight in a federal courtroom in Oakland, California, Meta walked into the most consequential legal test big tech has faced. 4 American states, California, Colorado, Kentucky and New Jersey, are among 29 that allege that the company deliberately engineered Facebook and Instagram to addict children, then concealed what it knew. California's Deputy Attorney General put the alleged business model in 4 words: hook the users, hold them as long as possible, harvest their data and hide the truth in public statements. Meta rejects all of it. Its counsel told the court there is no clear link between adolescent social media use and poor well-being, and pointed to teen accounts and parental time limits introduced 2 years ago by the company. The company calls the states' financial demands vastly disproportionate. Those demands are extraordinary. The states have signaled a figure near $200 billion. A theoretical statutory maximum runs to $1.4 trillion. That's close to Meta's entire market value. Though the judge has wide discretion and legal experts consider anything near that unlikely to happen. The first witness was a former Meta safety engineer, also one of the whistleblowers, who told the court move fast and break things was the internal mantra, and that products shipped without safety as a consideration. Mark Zuckerberg and Instagram head Adam Mosseri are expected to take the stand soon. Now this trial has a jury, but it's advisory jury. Judge Yvonne Gonzalez-Rogers decides this case herself. 6 weeks of testimony is still ahead of us. The stakes for India are also direct here because this is Meta's largest user market. So if the court orders design changes, be it to defaults, to age checks or to the algorithm itself, those changes will have to be shipped globally. Meanwhile, the company is expected to appeal to the Supreme Court, but we'll see how the trial goes. Today was just first day.
All right. Thank you, Rachna, for that. We will keep a track on these developments. With that, it's a wrap on this edition of Business 360. Thank you for watching.
So as a journalist, I'm not artificial. Very tough to be artificial. Intelligence is not my forte, so I will stray away a little from artificial intelligence. This gathering of bankers and NBFCs have some very important questions for the Reserve Bank. One of them is this revolving credit draft that has come. You know, you'll say revolving credit should not be allowed to NBFCs, but you don't define revolving credit, you define actually term loans, saying that they shall issue term loans. So what exactly will be forbidden? Even loans against shares is not a term loan. Even loans, inventory funding is not a term loan. Supply chain funding is not term loan. So what is forbidden, sir?
I think most of you are aware, those who are practitioner NBFC, actually this is not a new regulation. It has been there all along. Okay. Revolving credit as such was not permitted even now for NBFCs. But what we are proposing in the draft is we are trying to bring more clarity. And so that's why the definition has been emphasized in the draft regulation. And with this, we feel it will help better compliance. That is the idea. But nevertheless, as you are aware, like this is a draft only. Okay, we welcome any suggestion and any practical issues which the regulated entity might face. Those kind of feedback are welcome, and like I said, this is a draft only.
Okay. So can NBFCs assume that most of the activities that they now do, like loans against shares or loans against mutual fund units or inventory funding, all that will continue to be allowed? Since
obviously, see, our regulation will not come on the way of any business activity. So that is very, very important for all of us. The idea is not to prevent anything. Idea is to do business in a certain way, keeping in mind the risk. So what we are trying to do is bringing more clarity. But as far as operation is concerned, I think it will not cause much problem.
Okay. Now, to address what the bankers are always worried about, deposit growth. At the moment, because of the FCNR deposit flow, the worry about deposits has been postponed a bit, maybe by a year. By the way, sir, why was it stopped early? Any guess you can give us?
About what? About FCNR?
Why was the FCNR deadline advanced?
See, I cannot give you exact answer to that, but I can only generalize my response, saying that, see, we have to respond to the situation. So there is nothing early or late. We have to be able to respond to the evolving situation. As you know, things are very dynamic. So what holds today may not be true tomorrow. Even 7, 8 days is a very long period given the kind of uncertainty around us. So coming back to your deposit growth, I don't think any banker is worried about deposit growth.
No, now because of FCNR, they are not.
I don't ever they are worried about, because that is where they start with their banking. And they are very comfortable with any sorts of challenge when it comes to deposits. And they are very, very, I think they are very, very capable of responding to the situation. And they have been able to do that. And right now, there is no such challenge. Whatever you are referring to, some time back, there was the difference between the credit growth and deposit growth was a little wider. But I think hopefully things are improving.
So as recently as April, there was a 6 percentage point difference. Deposits were like at 10% and credit was at 16-17%. So it was a wide one. The FCNR from June 20th onwards has given the hope, and now it is a reality that deposits have really grown. So, you know, you all had that rule that you can give bulk deposits at different rates to a retailer, to a financial institution, depending on the runoff of the deposit. See, that, should we expect more?
Yeah,
that was...
Yeah. No, what we have been trying of late is basically to bring down the frictions and to bring more flexibility and more operational flexibility for banks. So ultimately, these are the commercial decisions. How you raise deposits, how you price deposits. So what we have been doing of late is to give them more flexibility. So with that, I think bankers are well placed to basically, if you call it a challenge, to meet that kind of challenge.
Okay, we were hoping like that bulk deposit, more such steps of flexibility will come. I mean, I was just wanting to know if any more such steps will come.
No, as and when any new steps comes, like it is a part and parcel of our public consultation, so you will be fast to know it.
Okay, sir. We always know it only from the website. You don't give away. Sir, coming to the MDR, is there any guess you can give us as to what will it be? Say 2,000 crores, 2,000 rupees as minimum. Will it be 2 crore merchants, people with sales above that? Any guesses as to where the threshold will come and when?
See, I will not hazard a guess, but it will come definitely now that what we hear. See, we are as much as we have got as much as information as you might be having in this area, because this is work in progress.
The rules will come from you or NPCI?
See, it will come from NPCI. Okay. It will come from NPCI, but we are part and parcel of the discussion, like we have been discussing. So government, RBI and NPCI. We are discussing on this, but definitely directionally, you know, now that the enabling provision has come in a weight. So it is going to come, and what shape and how the distribution, all these things, finer points have to be worked out.
Okay. So finally, there was a buzz. You know, one small finance bank has become a universal bank, but the other small finance banks still are like microfinance institutions. They don't seem to be scaling up. Any move to consolidate them, change regulations?
No such things.
Okay.
Yeah.
Okay. So a final question, since I'm a reporter, I cannot not ask that question. Will you postpone the decision on Tata Sons exemption because there is a lot of confusion? Or will you advance the decision?
You have been asking this question, I think, in every
as long
policy.
as the exemption was applied.
We are giving the same answer only.
Okay. Thank you very much,
Thank
sir.
you.
Thank you very much for your indulgence. Mr. Tiwari, Mr. Chandra, Rajiv and Mr. Agarwal, thank you very much for joining us at the Banking Summit. This is quite clearly a very, very important panel because we are in the contours of a changing banking system. The way in which people are saving has changed. More and more people have become investors. But before I come to that dreary question, just because of the changed notification we got a few days back, Mr. Tiwari, are you very angry with the Reserve Bank because they shut the FCNRB? Mr. Murmu has left. That's why I'm boldly asking you.
This is a recorded telecast event, so I would leave it at that.
No, but did it come as a surprise, and will that change your plans?
Not really, because we had
you're the biggest.
No, we had an internal target, and we are close to achieving that. So I don't think we were really too much perturbed by the stoppage. This was under discussion that if the flows are really strong, then maybe an early call can be taken, which is what he was alluding to. That's a dynamic situation. So for us, it has not made a material difference. We'll still achieve the target which we had set.
Okay, so what do you think may be the full amount by when August 31st? There were about 17 days after the announcement of the advancing of the deadline. We did 52. You think the pace looks like we may hit 70? Because with each passing deadline, it seemed to pick speed.
Yeah, it might, because the flow has been really strong in the last 15 days and more. So therefore, the number you talk about may be achieved, but I'm really not sure about the pipeline with different banks. We know our number, but surely other banks, I can't hazard a guess.
Fair point, sir. Rajiv, do you think this makes for better margins for the banking system? Because this, steady deposit is now there with you all. And for some banks, it may be a little cheaper. I don't know how it is. But will FCNR be a reason for easier margins?
I think, one of the messages that we got when we met RBI was that we're doing this for the nation, and this is not really about, making more money. But let's work hard to, get the dollars in from a national perspective. But having said that, I think there is dispensations on CRR, there's dispensations on SLR, and also dispensations on the lending side from a PSL perspective.
Yes.
Put it all together, it makes a very compelling proposition for all banks.
Okay, fair enough. Mr. Chandra, would you say that loan growth and margins can be helped? You've got more to lend. You've got a steady money, 3-year or 5-year, which you didn't have. Term deposits were not coming. So should we expect both loan growth and margins to help?
Yeah, to a great extent, definitely towards the deposit side. Definitely it is going to ease the cost of deposit, no doubt about it. Because one is that interest rate with what cost of deposit was coming. And second is the CRR, SLR exemption which has come. So definitely the cost of deposit because of this inflow which has come in the system, I think it will be reduced. Now, once that money has come, definitely it is going to be utilized for the lending purpose. So to that extent, I think credit growth is also going to happen in the system. So from both the angles, the deposit side and the lending side, definitely all the financial institutions are going to be benefited about that.
Sanjay, you want to add to that? You think if you started the year, you gave a guidance of some number, it can be increased by 1 or 2 percentage points because this is quite a bit, 70 billion if it is.
I think, Lata, this is all for big daddies, We being a bank, small finance bank, we were not playing this game at all.
You have become an adolescent now.
No, I know you asked this question to sir, but we didn't play this game at all because being an SFB, it was difficult for us to get the guarantees on board and all those things.
Sanjay, but the ecosystem has more money.
I know the SBIs and the PNBs should grow more because of that money.
No, I mean...
I'll just add a couple of things. See, margin-wise, it's neutral. Because there is a...
neutral?
Neutral in the sense that there's a lesser margin on the deposit itself because what we are paying on that. But it is balanced, as Rajiv explained, by the CRR, SLR and PSL. The important thing is liquidity. So this is in turn replacing those high-cost bulk deposits and all. So overall, it should be good for the banking system.
No, it also makes you all more competitive vis-a-vis the bond market. Bond market is running away with the price of crude and the US yields. So that's why I was asking whether you're at a better position.
I think for us, what we are betting on is this, that SBIs will not raise money, more costly money, and indirectly, to help us, and so if big daddies are safe, they are having a lot of money, so the people like us will take rest and can do our business.
I know a few foreign banks are lending to a lot of other smaller banks, so...
But maybe not us, sir.
I'm missing a foreign banker here.
No, one important aspect, in fact, that also we should look into that. This entire activity has brought a lot of foreign investors into picture now. Now you've seen almost all the leading banks, publicity banks I'm talking about, they went to the overseas market, they have raised the dollar bond, they have raised the overseas lending. I think to that extent, that much exposure has gone to the world. And I have seen that a lot of foreign banks, they have shown a lot of interest in participating in that, whether it is a dollar bond or the overseas lending. So to that extent, the market has become very, very wide. And we were able to expose ourselves to the world platform now. I will talk about Punjab National Bank. For the last almost many years, 20 years, we had not gone to overseas to raise the fund.
What may you end up, 31st August?
See, we had given the commitment and we were very firm in the very beginning, around 2 to 2.5 billion. And we are still holding to that position and we are going to cross that here.
Okay, and after that you will go for an OFCB?
Yeah, in fact, we have already initiated the process. We have already filed to the SEBI also that we are going to raise MTN, $500 million. And 500 plus 500 green shoe is also there. And that somewhere between 10th to 15th of September, we are going to do that. And we have already raised 1 billion foreign lending through the syndication. And that too, we went to the Taiwan market, where many Taiwanese bank, Japanese bank, and Korean bank, they participated. And very successfully, $1 billion we raised and plus 500 green shoe also. So to that extent, the market has become very wide. And all the publicity of bank, we were able to expose our presence to showcase the Indian growth story. See, if the publicity of banks are able to raise that much fund in the Indian market, it shows the resilience and the strength of the Indian economy.
Of course. No two ways about that. People were willing to take exposure to Indian banks. So the end amount will be much more than 70 billion if there are going to be OFCBs following. Will you all do more?
That, of course, was always the additional amount. So the ECBs and other things are being raised. And people have preponed that decision to take advantage of this window. So that obviously will be an additional number.
Okay. Rajiv, will you all also do that? Going to the global market?
There are three pieces within the FCNR puzzle, so to speak. One is the plain vanilla retail money. I think currently the rates that are being offered by all Indian banks is very attractive, and even for us, we're seeing a good inflow into plain vanilla retail money.
Attractive for the depositor.
As a depositor. Then there is leverage that we are providing through from our balance sheet, and obviously that has we've been able to get funding through through bilateral transactions. But Mr. Tiwari mentioned some foreign banks are lending. Yes, they have lent to us as well. And the third piece is where we are working with partner banks as well. So there is good traction on all three platforms, and our overall market share on the FCNRB is around 3%. And so therefore we think that we should be getting whatever that number is, we should get about 3% of that.
Okay, let me come to the other thing that has just hit us, the fact that banks now will be compensated somewhat for some UPI payments, P2M, as they say, payments to merchants. Rajiv, what is in your mind in terms of how much? Will it be 30 basis? It will be less than debit card, we were told. If it is as much as a debit card, what are your best guesses in terms of the split and the amount?
No, first let's split the transactions. P2P is out.
Yes.
P2M up to 2,000, 2,500 rupees, that's out.
They haven't said
right?
so,
and then,
but
so therefore it is really the higher value transactions that we could effectively get paid on. And I think if you look at the credit card business, the classic four-party model, there is an acquiring bank, there's an issuing bank, there's a customer in between, and there is a network, there the customer pays, and that income is split between the acquiring side, issuing side, and the network. We will come up with a model of a similar nature for that chunk of P2M that could potentially get paid. I mean, I think you don't want to kill the goose at the same angle as well, and so therefore that amount has to be. The good thing is that the habit formation has happened. That more and more transactions are going through UPI. That habit formation has happened. The ability of the merchant to absorb 15, 20, 25 basis points, I think, certainly exists. Because you have to also see it relative to the cost of cash.
Yeah.
It's not as if cash transactions are free.
No,
I mean, there is the risk of it sitting in the store. There is a cost by the time you deposit it in the branch, etc., etc. And so therefore, all merchants will look at it relative to that as well. So I would imagine 20, 25 basis points.
Okay, overall, it'll be charged about 20,
that
25.
would be split between
And
the acquiring, issuing, and the network.
The banks may get a third or half of it. How much is the system paying actually for it? I mean, either of you, since you all are the bigger banks, is the system paying what, 10,000 crores at the moment?
I think it is a substantial amount. And see, it is not like we are paying or we are reimbursing. It is basically the architecture and the infrastructure which the banks have created. That is the thing it is now.
So you think it will become a no profit, no loss for you all at least once the payment starts?
As of now, we are already doing it without any charging anything.
Now you're paying for it.
So we have already created the infrastructure. Let us wait and see. I think DG has also told that RBI, NPCI and the government, I think all three are engaged in that particular activity. So let us wait and see that how it pans out and what is the final outcome it comes now. So I will be still holding to that position.
Okay.
That let it come from the other side now.
Sanjay, what are your thoughts? Do you think you can do creative things? One bank was saying, we can give, say, I as a parent am able to do UPI with the merchant. I can delegate some of it to my child. Do you think innovative products like that will come?
No, I think, first of all, I think it's a very welcoming move because something is being now started, from years, and we had our own cost, be it infra or recurring cost, we had to pay to our tech guys, So, and I started putting QR codes in 17, to the merchants, and they were not making any money out of it, so we actually wind down in 2021, right? But I think we should really start because we are not playing a game of POS now. POS is heavily done by big banks. So I think this is an opportunity where people like us, being a small finance bank, we should go merchant to merchant, put QR code. And I believe if the baseline is 2,000 because we are expecting that same line as a credit card using that QR codes, right? So I believe it's a game will be played again. And it should be a favoring bank, and if a bank plays their strategy well in terms of putting the infra first and then the QR codes, creating new innovative models or giving even credit lines to those merchants, it can play a holistic game.
Net, I feel would you say banks are in a better position today than they were even 3 months back?
Correct.
I mean, you all are having this bhandar of FCNR flowing. I mean, there's more liquidity. And there is possibly, for the system, you benefit from the system.
Yes, of course.
And, probably some OPEX is going to be paid back.
Yes.
So is that a better position, better spreads than you envisaged a quarter ago?
But I think, Lata, banking is always like this, Some years they will give you back, some years they will take back, Okay. I have seen from last 10 years. So we should not become more happy about it. I think regulators always want to build a very resilient banking system. So, and of course, the entire ecosystem. So somehow, some days we'll be benefiting, or some days, it's all right. So
at the moment, I am told, I read through the minutes of the RBI, and it does look hawkish to me, more than what the statement was. So rate hike possible, sir?
So before answering this, I would suggest that one very simple solution which has been around for a long time, which will control all our costs on infra, is the UPI wallet. Now, perhaps the NPCI should look at making a smaller value, let's say up to 100 rupees mandatory through the wallet, because that will really reduce the small value transactions. And that is something under discussion. If that gets done, I think this will make a far more difference than any MDR share which might come to any of the banks.
including software, tech, and AI, and at SIBO in Chicago.
Very few of the NTLFs that have always been virtually a permanent fixture there. So it's great to be back here in partnership with NASSCOM to address an issue that is causing significant anxiety at this point in time. But as Naushir was pointing out, it is also an era of opportunity. The question, though, is will Indian IT services make the pivot that is necessary as of today? You know, there's been a lot of talk around the market cap erosion that we've seen from the 2024 peak. We're down 15 lakh crore rupees for the IT services industry in terms of market cap. And the question that's being asked is the market mispricing the anxiety at this point in time? Is there something that Indian IT knows that the market doesn't seem to know? Because when you talk to these guys, they're all basically telling you there is that $300, $400 billion opportunity, and that's the kind of value creation that we hope to accrue. So where is the dissonance is the question that we want to talk about. The other aspect that we do want to address is that if there is this $300, $400 billion opportunity that opens up by 2030, which is estimated, where does the value creation lie for the Indian IT services sector, and what changes will they need to make structurally in order for them to be able to leverage and gain momentum of that market opportunity that presents itself? There is, of course, the issue that Naushir mentioned, and that is the decoupling that we are seeing between revenue as well as headcount growth, and that has been something that we've seen accentuate and accelerate over the last few years, and it is flat as as Noshir pointed out at this point in time. The other big question, though, is growth. And are we in this single-digit growth trap for the foreseeable future? Are the double-digit days, is that era a thing of the past? And do we need to recalibrate the growth aspiration that we have? There is, of course, the global story that's playing out, the OpenAIs and the Anthropics of the world and what that potentially means in terms of this industry specifically. AI monetization, how quickly will that be able to outpace seat cannibalization? I think that's one of the big issues up for debate and discussion. Well, I've got a fabulous panel here to address those issues. So without further ado, Rajesh, I want to start by talking to you. 15 lakh crore rupees gone in market cap erosion since the 2024 peak. What is the market not appreciating about the story? Indian IT, as Salil Parekh told me in our interview recently, Indian IT abhi zinda hai. Why is the market not appreciating that?
Absolutely zinda hai, but I think it's important for us to note a couple of things. One, if you ask anybody in the room, and if you look at the last quarter results of all the companies, the top one included, the medium ones, of course, grew. When you look at the top ones had about 3% year-on-year growth, the medium tier, and many of the companies which actually did fairly well at 9 to 12% of growth, and the smaller ones actually even had higher growth. But more importantly, when you go back and look at the order books, almost all of them had the largest order book ever in the history of this industry. So they've all been doing really well. On the contrary, as you rightly mentioned, all of them had a headwind from the stock market point of view. I do not know how the stock market valuation happens, so I can't really comment on what they do. But I can always tell you one thing. They always price for the worst case, and then when they look at the terminal value, they want to make sure that whatever they are seeing on the order books, whatever the story that we've been sort of saying for the last 1 or 2 years, holds good for the long term. I know that they're sort of looking at these numbers, and occasionally you'll find that because of the green shoot that we produce as an industry, there's suddenly a sort of a shoot up of our numbers and so on.
Yeah,
but that is what
you're
it is.
18% off your lows.
There you go.
Yeah.
There you go. So that is, in some sense, so I think quarter on quarter, if they are able to put the proof points on the board, I personally believe that. Will you see an aberration? Absolutely, yes. I think there is going to be a bit of an aberration when you see that this industry will go through bad times before it gets better, as I always say. So I think we're going through that turf at this point in time. But I think, in my mind, if you're what we are seeing around the order books and the opportunities that we are seeing, and of course we'll talk a little bit more in detail as to what exactly is the opportunity. And Noshir put some really good data around. People always ask me, will the industry pivot? The industry has nothing to pivot here. I think the individual companies will pivot. Will all the industry players will pivot? Probably not. 80% of them will pivot. Maybe some of them will not pivot. But the opportunity you saw in those charts, the TAM that we are talking about, the opportunities that for the services company to truly cross the chasm, if you may, that's for real. And I don't believe that the markets have actually priced in yet.
Okay, so that opportunity is real. Amit, let's talk to you now in terms of recalibrating growth. And as I said, is the era of double-digit growth something behind us? Do we need to recalibrate ourselves into appreciating the fact that at least for the foreseeable future, for the industry, for companies like yours, it's likely to be low single-digit? And what does that then mean for the next 5 years as far as this sector is concerned?
I think I tend to take a pretty bullish approach on things, and possibly by nature an optimist. But if we look at how things are shaping up, we look at a few transitions, and possibly our industry is experiencing one right now. And it's a transition of two pivots. I think that was also spoken about in the first presentation of what's under pressure and what's new. And the growth of opportunity in the new is something that we have been reporting quarter on quarter. It's been last 3 quarters we've been reporting, and that's a mark of confidence and conviction. The path that we have taken, the path that we have chosen. The transition on anything to do with operations is expected to be pushed for efficiency and productivity always, with or without AI. That has always been the candidate, and it will always remain a candidate. But the pivot towards new opportunity is what we are seeing more and more. What used to be an industry known for effort, largely our industry has always been known for how much effort we have put in. I think that pivot is moving from effort to intelligence. Our industry is getting redefined for intelligence. Our industry is getting recalibrated for intelligence, and that's the transition that we are all experiencing right now. But a huge opportunity ahead of us.
So let me double down on that. If you're making this transition from, to intelligence, what then happens as far as pricing is concerned? And I think that's the question. And Naushir mentioned that you're moving now to outcome, and everybody's talking about the outcome model and outcome pricing. What does it mean in terms of pricing deflation at this point in time? And, how quickly are you likely to see this model shifting? And two, on the headcount front as well, as we move into this agentic future that everybody is talking about and so on and so forth, what will it mean essentially as far as the current model of headcount is concerned?
I think second question first. If we look at operating model, headcount has been part and parcel of an operating model to deliver services to a customer enterprise. Deliver services in an output, in an effort, or an outcome-based model. It's been a combination of all three. The percentage variation has been very different. Now, when you look at the operating model shift, you'll have a human and AI agent collaborate and coexist in different capacities, in different natured roles, and different skill sets. The ability to price for outcome becomes more profound now because you're committing to what the end experience the customer will gain, rather than the effort that you'll put in. But hand on heart, I don't think so the industry has transitioned to an outcome as yet. We are clearly seeing a shift of effort moving to output, but very small percentage still moving to outcome. But that's a big opportunity in front of us.
And the timelines that you believe that you are likely to see the inflection point as far as this shift is concerned?
Tough to predict. I think if we go back in history, we always take inspiration from history. So if you go back in history, when the mobile era was introduced, say, the consumers have huge excitement around it. Enterprises took a long, long time to come around that space. I don't think so it will be any close to that lead time, but there is a lead time that is always expected from consumer excitement to being ready for enterprise grade.
Okay, Arundhati Bhattacharya, let me address the big question with you. And I think every headline has been screaming about the SaaSpocalypse. Now, how do you, sitting at Salesforce, deal with this?
I think, our results are expected very shortly. So really can't speak about that in as clear a language as I could. But I think that that narrative has already been proven false. The thing is, we are all in a stage of transition. And let me make this comment regarding this outcome-based pricing. When this outcome-based pricing really starts working, they want to go back to the license-based pricing, okay? Because the outcomes are so many, they don't like it then. Then they want to go back to the early one. But having said that, this is a real case.
Yeah.
So, but having said that, on the SaaSpocalypse, you have to understand one thing. The frontier models, you just can't put them somewhere and expect the entire enterprise problems to be solved, okay? Whenever you're deploying something new, there has to be governance, there has to be auditability, there has to be observability, there has to be, the various regulatory and other compliances have to be correctly recorded. Not only that, in the architecture that you already have, you don't have a clean slate. You're putting in something where something else is already working. So putting all of that together in order to have the best outcomes, it needs a lot of engineering. It's not something that happens on its own. Neither is it something that, any of the frontier models will resolve on their own. And therefore, the requirement for companies such as either ours or even the service companies, that requirement still remains. And the fact is the industry is beginning to realize that piece of it is still very, very important. And therefore, I don't really think the SaaSpocalypse stuff was sort of, I don't know, it was stocked up maybe a little because there was so much investment going into the other companies and they had to take it out from somewhere and probably we were sitting ducks on it. But whatever it is, I don't think that narrative really makes sense. And I've not been seeing that in actual on-the-ground requirement or even in the order books like Rajesh said. We are not seeing that anyway.
Well,
the narrative was built by the stock market enthusiasts.
The narrative was built by the stock markets, but you're right in saying that you did see these massive amounts of capital going into companies like OpenAI, Anthropic, and of course, but what I do want to understand from you is what are you seeing in terms of demand? Because I understand that you're in a silent period, so you cannot comment or make any future projections, but look at your agentic ARR, up 200%. What is the sense that you're getting in terms of demand at this point in time?
So, let me just talk about our own company. We are, by the way, customer zero. Like Noshir said, we are not holding back. We are willing to cannibalize ourselves. We are customer zero on our own platform. And even there, if you see, I had started with my own vertical with a project for creating 3x productivity. In a matter of 90 days, I had 99 applications, okay, where in certain cases, they were giving as much as 27x productivity. Some cases, it was lower, it was as much as 1.5, but it depended from case to case. So the fact remains that there is definitely a huge amount of demand. But I think even if there is demand, people have a lot of queries still. The queries on trust, queries on security, queries on cost. There is something that has evolved called token economics.
Yes.
Okay, so that's an entirely new field of expertise.
We've gone from token maxing now to token impacting.
Exactly.
Token impacting is the buzzword today.
That's right. So that's an entirely new area. And in fact, Noshir didn't mention some of the roles. Some of the roles are in that area. How do you maximize the usage of tokens in order to ensure that you get maximum impact and lowest costs? So there are a lot of things that people are still trying to get their arms around. If you ask me whether there is more interest, yes, hugely so. If you ask me, have we seen that actually come down to numbers? I think we are getting there, but not yet there.
Puneet, as I was saying, the only person on this panel who doesn't have a stock problem is Puneet. Microsoft is still
so glad
is still holding up, but the massive capex spends that we're seeing globally at this point in time, almost $700 plus billion between the hyperscalers put together, almost $200 billion for Microsoft alone. Now, when we look at this capex build out, and I'm asking this in the context of what the opportunity is for this sector here in India, how does this sector benefit from this kind of massive capex build out that we're seeing happen globally? Where does the value creation for this sector lie when we talk about this capex build out?
Listen, I think first up, the reason for the amount of investments that you're talking about is, and we were having this discussion outside, this is unlike anything else we've seen in our lives. It's the most consequential technology of our lifetimes. And a lot of this capex is going into manufacturing intelligence. And intelligence has always been linked to biology. We've always carried intelligence in our small heads. For the first time, we're making compute become cognition, right? For the first time, we're manufacturing intelligence. So that is the race we're on, and that's the reason the investments will continue to go on. To your question on where the value is, and I was with a client recently, and he said, some of these frontier models that I'm working with, they're like brilliant strangers. And I said, can you explain this to me? He said, they're brilliant strangers. They know everything about the world. They know nothing about me. Can you get me a familiar friend? Can you get me a child who grows up in my organization, understands my context, the knowledge turns, what does the good work look like, and then get that to answer questions or do work for me, which is where the new value pool is, and Noshir spoke about, right? Which is translating this enterprise ontology, the enterprise context into these frontier models. And getting these models to work for you on your own terms versus the other way around. Satya spoke about the reverse information paradox. Don't pay for these models twice. So I think that is where the real value pool is. And I don't think there's anybody better positioned than the services companies in India who have the context, who have the domain knowledge, who know how to do this at scale.
But let me push back, because this is the fear, right? That given the intelligence that these guys are sitting on, how quickly can the beautiful stranger become your beautiful friend? I think that's the concern, that's the anxiety.
I think the transition from this brilliant stranger to a familiar friend has to be done by the Indian IT services companies, because this this is not trivial. We've all seen this, and Naushad spoke about the 3 things that are true in life. The 4th thing is the enterprise tech debt. There's a ton of tech debt that's sitting there, and it needs to be modernized. It needs to be translated into these models. And again, I'm sure we'll talk about ROI, right? But eventually it comes down to 2 things, Shireen. First is intelligence, which is intelligence in your own context. Second is trust, to Arundhati's point. We all have agent sprawls in our organization. How do we make sure that we get the intelligence that we want in on our own terms, in a trusted way, which is where the service providers are best positioned to go and play.
And I didn't pay him to say that, so
I'll still charge you later. You can buy me a dinner, Rajesh. No, but I mean it. I genuinely mean it. I think this is where there's a massive opportunity for all of us.
No, and I think Satya has been at the forefront of this business of the limits as far as renting intelligence is concerned, and something that Palantir, Alex Karp has also been carping about, particularly on CNBC. So we'll get into that discussion in a second. But Srikanth, regretting listing?
Not yet.
Not yet. But would it have been better? Were you still private?
See, I think this, like Puneet has just mentioned, this is the most transformational tech that we have seen in our living memory. And to think of this as just one more small wave that'll pass by is, I think, a big mistake. I think whether this on this panel or anywhere else, if you're making that assumption, it's going to change the world in very significant ways. And 2026 is just the beginning. We are at that point where recursive self-improvement is beginning to happen in the models. These models are already building the next wave of the models. The models are getting better at a rate that's unimaginable. They're doing long horizon tasks. So they're not just being part of your tech budgets. Tech budgets are increasing, as Naushad was saying. Yeah. They're going from 4.5% of revenue to 6% of revenue. So there is a certain increase in tech spends that's happening, and many of the service providers can benefit. But if you look at the other side, the labor budget, 20 to 40% of revenue of a company is the budget on human resources. And that budget can also be now exposed to tech disruption, which means that the overall pie that a tech company, whether anybody on this panel or anywhere in this room, can address is a much larger number than ever before. With that massive addressable market, the sky is the limit in terms of how companies like Fractal can perform, or even any of the people in this room can perform. So eventually the world is moving to more tech dependence. Yeah. Now, coming to the tech services companies that are currently struggling a little bit for growth, it's also something we have to understand as a S-curve that is saturating. So if you look at all the tech companies, tech always goes through these S-curves. We have completed the previous S-curve, the era of sort of doing social, cloud and stuff like that. That S-curve is saturating. The next S-curve comes with an AI wave, right? And companies like here have to reinvent themselves to be relevant in the new S-curve. Fractal is natively there. And secondly, all the companies that are potentially clients of this have to also reimagine their work and workforce with AI, right? So whether it is transforming every business process with AI, building the ontological foundations in their data to be ready for that transformation, or reimagining the talent and workforce so that they are relevant for the new generation. This is not just a tech services or tech companies problem or a SaaS-apocalypse problem. It is all companies in the world will have to address this sooner than later to be relevant in the next 20 years.
So that's what I want to double down with each one of you. Let's pick up on this issue of reinvention. And as you pointed out, everybody needs to reinvent, everybody needs to rewire, everybody needs to reimagine. Now, at this point in time, if I were to ask you to pin down for me the 3 strategic imperatives of where this reinvention ought to start, what would you put down?
I would say pick the place where you have the greatest inefficiencies in your organization, or which is your North Star, or where you feel like an important metric that you chase. You pick that part in your organization and see if you can work backwards and redesign the processes to gain traction. That's number 1. Number 2 is that you must look at the data that you're collecting, the system that you've created, and how to harness that data, create that layer of context in your organization so that you can leverage it. And 3, you must activate your talent to think AI native. Everyone in the organization. It's not just tech people who need to learn AI and get better. It is every employee in the organization has to start using AI in a much more effective way. So I would look at these three massive opportunities inside every large company, and you can see that the ones who have cracked this problem are already moving faster than the others.
Rajesh, let's pick up on that. The NASSCOM strategic review said that the need of the hour is to focus on value and innovation. Now, those are large, generic terms. What does that mean specifically as far as the actionables for Indian IT services? Noshir talked about R&D. R&D spends have been woefully, abysmally low, less than 1% or just about 1% as far as the industry is concerned. The big criticism is you guys keep doing dividends and buybacks and so on and so forth. You're not spending enough as far as IP creation is concerned. Does that need to be the big shift? Does that need to be the big priority at this point in time? If so, on what exactly?
So first of all, I'll give it that there is a serious issue with R&D spend. Overall in India, as you know, that as a country we spend 0.7% of our GDP, whether an advanced nation would spend something like a 2.6 to 2.7% of the GDP on the R&D. So there is no question that as a nation we are spending less, as an industry we are spending less, as companies we are spending less. But having said that, for the tech services company, what gets counted as R&D is often, when we talk about R&D, there's always a product mentality around some of this. And I want to put that rest once and for all if I can. See, when you have products and services, the traditional way of looking at what is innovation is a little different, right? I mean, of course you need to spend on building IP and all of that, but let's not forget that, let me see if I can give you an analogy. I mean, I think flying is a great analogy. To have a great flight, you need to have a good aircraft and you have a good airline. The aircraft manufacturers have never been able to run an airline, and the airlines have never been able to build an aircraft. So Boeing makes the aircraft, let me pick a good airline here. Singapore Airlines probably flies it nicely.
I like the fact that you dumped all of the Indian carriers, right?
I don't want to say anything at this stage, but especially given where we are today, I want to be very careful. But that experience, so you have a product plus service combination, if you may, delivers that kind of experience for the end user. So being that the case, of course you need to have core products. I'm not arguing by any means that you have to do less of R&D. You need to do more of this. Tech services companies have really not spent enough. They're beginning to realize that. They're beginning to create a lot more IP. I think it'll improve over a period of time. So that's one. I think they'll have to be a lot more innovative. But let's not forget that what is the biggest... Arundhati and I were together in a different podcast this morning, and we were talking about the enterprise context which the services companies have today are valuable so much that, starting all the way from Y2K and today, you really see they understand this enterprise context of all the corporations around the world, especially the Fortune 1000 and so on. They need to leverage that fully at this point in time, because to truly deploy AI, and then we all talked about as to how critical it is for them to sort of truly get into the bandwagon and take advantage, not just for productivity gains, but also to enterprise transformation. So the second piece of the, how do you really move the needle? These companies have phenomenal opportunities. So all of them, I mean, TCS is on the panel and many of the other companies are not. But if you really see the AI services service line, if you may, is actually focusing on that aspect of it. But you have a lot more